And I'm not saying that it's right. I'm just saying this is kind of where I'm at in my head right now. And I mean, the more I learn, the more I'm starting to see things like this.
Sure.
So let's say you've got a particular setup or you've got a strategy. Okay, so you can look at a chart and you can say, this is where I would have entered, this is where I would have exited, and that would have been a winning trade, right? Following the rules that you've mentioned in your trading plan and your setup, that would have resulted in a winning trade right there. But if you were to take that same strategy and that same setup and look at 100 other charts, you're going to see that strategy and that signal, whatever you want to call it, where it's triggered and it would have resulted in a losing trade. So how do you know if there's a genuine edge to that setup if you don't have numbers to put to it? So you don't know how many times that setup is expected to result in a profit, how many times that setup is expected to result in a loss. You have no idea. You know that sometimes it works and sometimes it doesn't. But I'm just very unclear on how you know if there's an edge in that setup.
Mm-hmm.
Does that make sense? I don't know if I explained that very well.
No, I know what you mean. Most traders exist in this like state of unknowing. And then, so it's a commonplace of, I've seen great examples of success on the charts in front of me. I've also seen terrible failures. I kind of believe that I'm going to intrinsically find more successes than failures. But if I don't really know with what likelihood I'm going to find a winner or a loser, I can't really calculate a viable risk reward that'll generate profit consistently for me. That state of unknowing is what keeps people from being quantitative traders. They're afraid of, what if I'm wrong? What if I find out I have no edge? But I'd always ask, what if you find out you do have an edge? We talked about this before, the inescapable truth of quantitative trading. You have to know one way or another. If you have an edge, you deserve to be trading with that confidence. And if you don't have an edge, you have to know that right now. You have to find that out as soon as possible to avoid future losses.
Yeah, so that particular, swing trade setup that I kind of mentioned before, that I'd focused in on and just trading that particular setup with a couple variations. Like, I knew that sometimes resulted in a very nice winning trade, and I knew it also resulted in losses, sometimes. So
sure. I
didn't know without knowing if I was to trade that 100 times, where I would stand at the end of that 100 trades. I don't know if I'd be up or down. You know what I mean?
It's like you're talking about the difference between belief and knowledge. When you believe that something is going to be good, that's fine, right? But if you know it's going to be good, I mean, it's a very different, you operate from a different point of confidence and clarity. You kind of remove the emotion when it's not you're hoping for this to work out because you don't know, but rather you've already asked and answered those questions.
Yeah, so this kind of led me into wanting to learn how to code, and kind of led me in that sort of quantitative direction of trading. So, I mean, still in the very, very early stages of that. And I mean, you were partly responsible for sort of leading me into in that direction, just to a certain extent. With
I'll take the credit or the blame, whatever it ends up being.
Like, you sort of introduced me to ThinkScript at least, and we sort of started going through some ThinkScript documentation. I started reading up on the ThinkScript manual on the website.
And just a little context for people who may not know, ThinkScript is a JavaScript derivative used by TD Ameritrade's Thinkorswim. The reason why I thought this would be a good starting point for someone like Aaron is it's free, it's pretty accessible, it's well documented, and I happen to know it inside and out. So I felt like it was a good starting point for us. But I got to be honest, Aaron, I've never seen anybody take to code like you have. And I know you're going to be humble and say, well, I'm still working on it. But I've been very impressed. I gave you the assignment, quote unquote, of looking at the manual. 3 days later, you come back and you're like, yeah, take a look at the script. And I'm just, oh my God.
Yeah, I mean, I think that's partly because I come from having the knowledge in web design. So, I mean, I know a little bit of CSS, I know some basic HTML, but I mean, I know you don't build an algorithm out of CSS, but it's sort of, I'm not completely code illiterate, if that makes sense. So, I mean, I've got a little bit of an understanding on how you might kind of put something together. Even though when we start dealing with languages like ThinkScript, and I've more recently started getting into Python, which is pretty exciting, well, for me anyway. It's a very, very steep learning curve, but I think that's having that sort of web design background. I don't know that's a huge benefit, but it just sort of made me think that,
Well, it sounds like organizationally that would benefit anybody, just to have considered, well, what components am I going to need to build a web page? And I don't know if you can code an algo in CSS, but if you did, it'd be a beautiful and well-organized cascading algorithm. No, I'm just kidding. No, I'm certain that helped you. Having a predilection or predisposition is really the right word to code. You've seen it before. You've experienced it before. You've had errors before. Things haven't displayed properly, and you've had to debug them. So it's like you're talking about the logic of any code as well as a little bit of syntax. And I've noticed the same thing with CSS. There's a lot of parallels between that and JavaScript, which probably led you to your early development in ThinkScript, and now moving, like you said, more towards Python.
Yeah, absolutely. So, I mean, something that I haven't really, obviously we speak quite often, but I haven't really spoken to you too much about this topic, and that is how I have been getting quite deep into Python, or trying to learn it, putting a lot of time into it. And I've sort of set a goal for myself to have, I know it's a little bit vague right now, but to have some sort of automated trading signal or setup that is automated in roughly about 6 months. So sort of by the end of the year, I'm hoping that I can be somewhere close to having an automated trading signal. And that signal would look something like this. It would be a swing trade setup. So it'd be based off technical analysis and certain chart patterns. It would probably hold trades for, a couple days to maybe a week or two. And it would run through interactive brokers. So that's kind of how I picture it.
And anybody who's thinking out there, man, 6 months to go fully automated, I think you have to consider how smart Aaron's being about the finite or discrete kind of, not to say simple, but the straightforward nature of what you might define as an automated system. It just has to be something that you trust the output of because you've tested it. It doesn't have to be a 20 component intermarket analysis signal. It can be buying a moving average crossover near the 200 moving average or whatever you want. It can be something very straightforward. So I think it's good on you to keep it limited and gives you an attainable goal, especially early on. You can always expand from there. Yeah.
So something I probably wanted to ask you was setting myself a goal of trying to achieve that in 6 months. I don't know if that's a little bit naive, considering I've never gone through this process of identifying a signal, testing it, and go through the different processes of taking that trade to a level where it's then automated, plugged into your broker. Is 6 months, is that a little bit ambitious, or how achievable do you think that is?
Well, okay, so we have to examine this at the time frame that you're trying to trade. So given it's a swing system, I think that's smart. It's kind of the Goldilocks approach. If you're trying to trade on the shortest of terms, an automated day trading system, you got to consider execution routes, market impact, slippage, commissions, all these things, because you're in a frequently trading system. And that's not even HFT. I'm just talking about an automated intraday system. On the other end of the spectrum, if you're a portfolio manager, you have all sorts of other considerations, fundamentals, intermarket moves, as I was kind of joking about before. I think you're doing it right by approaching it from the most accessible point. You're kind of trying to establish a beachhead of what if I did have a signal that I had vetted, I had evaluated, I had tracked for months, and I understood intimately, I'd feel comfortable deploying that, automatically. That's smart, and it's definitely doable within 6 months. I think if you'd go to portfolio management, that's a million other problems you haven't even considered yet. Intraday trading, another million problems in a different direction. So you're riding the knife's edge of potential here, Aaron. Not to make it sound dire, but I think it's very doable. And also, given your coding background, and you seem to have found a good few dozen expert traders to talk to. One or two of them may know a thing or two about code you could talk to. I'm pretty sure you're gonna bang this out. So,
Yeah. Well, I certainly hope so. I mean, that's sort of why I've been leaning towards Python. Obviously, living outside of the States, I can't fund an account with Thinkorswim, and I believe Thinkorswim do have the capacity to deal with automation. Is that correct?
they do, but here I'll show my true colors. I promise, guys, I'm not a Thinkorswim shill. They are pretty expensive, and so if you're talking automated trading, the biggest worry for me is that you would have 20 trades a day and commissions would eat your lunch. So it's smart of you to probably work with something a little lower commission and a little more flexible that has a good API, like Interactive Brokers. I've heard pretty much nothing but good things about them. I actually spoke to other traders in the past few days who've been working on the IB API, and they had good things to say about it too. So you notice what you're doing is you're trying to do this efficiently. You're not devoting your entire life, 20 hours a day and barely sleeping to learning Python. But similarly, you're not so far removed from it that you're not going to get anywhere. I think you're setting attainable goals for yourself. And look at how this parallels a trader's profit and loss development. When you set unattainable goals, can you blame yourself for failing? Not really. You can blame yourself for setting shitty goals. So similarly, by saying, I'm not trying to develop the next HFT, and I'm not going to build a massive portfolio system, I'm going to backtest a signal. I'm going to evaluate and vet and then approve the signal. And then I'm going to start it, and we'll see where it goes. That could be trading once a week. It could be trading a couple times a week. It depends on how selective you are, but I think you're being reasonable about it. So if nothing else, maybe talking to 25 veterans of the market has aged you a bit and scared you. You're keeping it real, which is smart. So.
Yeah. So, I mean, I'm pretty excited. I mean, learning Python and this sort of quantitative approach, I find it fascinating. It's really interesting to me. So,
let's go back to the thing we were saying before about you have to know one way or another. There's that great Mike Bellafiore quote that you were telling me before. Do you remember it?
Yeah, so when I interviewed Mike, and I was thrilled to get the opportunity to speak with him, Mike Bellafiore, he mentioned a quote which really stuck with me, and that was a lot of traders confuse psychology with a lack of edge. So I'll repeat that. A lot of traders confuse psychology with a lack of edge. And I mean, that just really stuck with me. And I mean, that sort of came back to that point, which I tried to explain earlier. I don't know how clear I was, but how do you know if you have an edge? Mm-hmm. If you can't put any numbers to what you can expect from trading a particular setup, then how do you know if there's a genuine edge to be had in that? And I mean, I'm not saying that you can't make money as a discretionary trader at all. Definitely not saying that. I'm just saying this is sort of the train of thought that I have right now.
It feels like it's more personally exacting. You have to be right. You have to be precise. And I think we were joking about this before. It's like the idea of a tongue twister, right? Humans are not good at being precise and doing these repetitive tasks always, and it's asking too much of us to be 100% right or to be 100% buying the low, selling the top. I think it's very smart to adopt the quantitative approach. You're right, but definitely we both know many successful discretionary traders. So who are we to judge, right?
Totally, absolutely. So yeah, all right. Well, let's keep this moving.
Sure. So it's funny because the next topic I had for you was just tied to the Mike Bellafiore quote. What are some other maybe quotes or episodes that have stuck with you? This is something I've always, wanted to know your view on. What are some episodes that you think people should go and listen to that maybe they may not have caught the first time?
Yeah, so probably a couple of the interviews which I feel probably deserve a little bit more attention than maybe what they did receive. Would maybe be Tim Walker's interview. So I spoke with him on episode 6, and funny enough, that was actually the very first interview I ever recorded. So from my side, it's a little bit sketchy, but Tim definitely delivers some great insights, and he is a game trader. But even if you're not interested in that type of thing, I think it's still well worth a listen, because the majority of the interview is based on just sort of general trading foundations. It's really good one to check out. So, and then probably the other one is more recent, and I'm not being biased because I know this is David Bush who mentored you as you were coming up.
Oh, sure.
So his interview I found really, really interesting, especially like a lot of his answers were almost kind of inspiring, from how he's come from sort of like a musician background. He's been a discretionary trader for many years, and then he's gradually taught himself to creating what he described as like a meta system, where he's got like up to 30 to 50 sort of different strategies all sort of tied into one, and how he now uses that to just sort of views trading in a totally different way. So he now like oversees trades instead of jumping on a trade and hoping that's going to result in a profit. He doesn't really care if there's a few losers, just as long as the overall result is positive.
That's that really smart, like, quantitative trader distance that an algo trader will try and adopt. Of this doesn't reflect poorly on me if a trade doesn't work. I'm in charge of overseeing all these things. It's like being a manager. Do you feel bad if one of your employees has to get fired? Like, yeah, look, that's unpleasant, but it's not your fault, most likely, right? It just didn't work out with the employee. And very similarly, having that oversight or overseeing. I've always loved about Dave that he was really articulate. Like, you're right about the answers being almost inspiring. I think about, like, I could take a year to write a white paper that wouldn't sound as good as the stuff he says off the cuff half the time. But yeah, well, you've had so many great traders on. What can I say? I definitely liked Tim Walker as well, episode 6, and of course Dave, episode 23. So
yeah, so those would probably be like the two interviews which I think everyone should probably listen to. I mean, I'm probably saying Dave a little bit more so because he's definitely in that quantitative space, which has really grabbed me right now. So
sure,
I mean, that's another reason why I found that really fascinating. But yeah, definitely Dave's interview and Tim Walker's. And I mean, I don't want to try and like single out those two and say they were the best, but like, yeah, I mean, everyone is like given incredible answers. So I'm really grateful for everyone who's, given up their time and been open for an interview, because everyone's been really honest with their answers. So no one's really shied away from anything and try to, squirm their way out of it. It's been really good.
And credit to you for being humble. So I'll brag on your behalf, but the ebook as well that you recently put out, I'm obviously honored to be in that as well. But some great responses from the other traders. I loved getting to go through and see what other people would have said. It's just such a down-to-earth kind of like, what if you could go back 5 years in time and speak to yourself? What do you wish you could have told her? Not 5 years necessarily, maybe many, many more years if you're a more experienced trader. But just it's cool to hear, how I say this, the insight you would have given to yourself. Or you would have given to others, or you could give to others right now. Yeah,
so. It's like that one lesson that you wish someone would have told you. I mean, that's what the book's called. So if anyone's listening and they haven't had a chance to check that out, just go to, I can't remember the direct link to it, but if you just go to chatwithtraders.com, you'll see ebook as a link in the top menu. So you can go there, check that out, and download that. It's free to download. And this brings us to a good point. So you had a piece in that book, Zach, and that was the one thing that you wish someone would have told you when you were sort of starting out. And that was, you mentioned you wish someone would have said that you need to disassociate yourself from the identity, the image, and the persona of being a trader. So, what exactly does this mean to you? And why is that important?
I just think that so many traders are in this game to tell other people that they're traders. I think so much of it is I want to say like badge of courage. Like, it's the thing we wear, the chip. There we go. The chip of courage that we wear on our shoulders. You know what I'm saying? We've got a chip on our shoulder. Like, it's the ego and mentality. I don't want to say machismo because I've seen it in female traders too, but this kind of uber over competitiveness, feeling that they need to prove it to everyone around them. The truth is that nobody really cares and nobody values it that highly anyway. Most people don't understand what you do. They don't care what you do. They think you're a gambler in any case. It's up to you to prove them wrong. Not prove them wrong like by talking a big game. It's not by prove them wrong by having enough monitors, although I'll be honest, I'm pretty guilty of that. I've got 5 sitting in front of me here. But, it's the trappings and kind of fluff, I think I called it, that we tell ourselves when we don't have an edge about, I'm going to be something one day. I'm so close. I hear that all the time from my trading students. I'm this close, Zach. I just got to get, the next. And everybody is that close to something in their life. Many times with, yeah, go ahead.
Yeah, so let me just cut in there. And
yeah,
for those who do feel like they're so close but just not quite there, I felt like that for quite a while. I'm still not there, but now I've realized that I am quite a way away. But why do they feel like they're so close but just not quite there? Like something's just not clicking yet. Like what's the reason for that? Like why do they feel that way?
Yeah. We were talking about it before with the kind of, I can observe a single chart that works. I will never know about the 99 others that don't. Traders are not pretty honest with themselves about tracking a system or strategy. Cherry picking is prevalent. Curve fitting is throughout this industry, and especially at the retail level, because you get guys who are not knowledgeable enough to backtest or to do an appropriate or robust backtest. They just find anecdotal evidence. And I think I'd said something on my podcast about intuitive, anecdotal, and mathematical. Like, you got to have all three. It can't just be, I've seen this happen before, and therefore it is a rule, and this is my strategy, and I will continue to find great charts like this. You may have found the far right edge of the distribution, let's say. You may have found the best trade, and you're holding that as the kind of most frequent occurrence in the data set. I don't think people have a lot of perspective on how far they might be. And so maybe this is something that I would credit you with. You are humble and self-aware in that by talking to many other expert traders, you realize, like, my God, these guys are still struggling through it and developing. And they're 20, 25 years into this business. If I'm 5 years into this business, how much more development must I have ahead of me? And so you've been humbled without having to pay the tuition. Does that make sense? You've not blown up an account, but you've learned from many others who have. I don't think a lot of traders are aware of the misfortunes of others around them. They're not realistic about how 80% of traders are gone every year. They just stop trading, and a new 80%. I'm definitely kind of incorrect in these statistics, but you see what I'm saying about there's a high turnover rate in this profession. I don't know.
No doubt. I mean, that kind of reminds me of something Adam Grimes mentioned when I interviewed him on, what was that? That was episode 21. And
I forgot. He was another great interview too.
Yeah, no doubt. He was like, you never arrive as a trader. Like, you don't reach a level and you're like, okay, I'm now a trader. I've made it. He's like, you just become a trader. You just always. I'm not explaining this very well. We're doing justice.
No.
But
this ties into what we were saying earlier with the pendulum of development, that it's a never-ceasing swinging of the pendulum. You don't just develop for a year and then go be a trader. You develop, you trade. You develop, you trade. You develop, you trade. And eventually you're 90 years old and you're a multi-billionaire and you stop trading. I mean, that's the plan, right?
That would be the
So
ultimate.
6 months from now, an automated strategy. 20 years from now, the world. Yeah, I think, I don't know. I mean, it ties in perfectly, I think, with what we're saying about it's a continual process. And the people who, maybe that's why people feel they're so close. And think about that. That's actually really funny that it ties in. When you think there's a destination in mind, you're always so close. Just one more day of travel, just one more hour, just one more mile. But what if it was about the journey? What if it really was just about driving? You never would focus on how close or how far you were. You're just driving.
Yeah.
Do you see where I'm kind of going with this? For the sake of the drive. I don't mean to get too cheesy and philosophical. I know we're all here for the money too, and this speaks to why traders often don't get where they're trying to go. The market, and this is a Denise Shull, I believe, quote, about the market as a mirror. It represents whatever you need it to represent. For many of us, it's the thing ever out of our reach. We're never going to master all of the market. We're never going to nail it down. But the challenge, the chase, the puzzle, the struggle, it's all part of some self-betterment process that often parallels what's going on in your life. And actually, we've talked about this on the pre-call too, life and work balance, finding time to be a trader, but also finding time to be a human being outside of trading. I've definitely spent many a month or a week, zoned in on this, and could have done better on the life balance side. So I'll admit to that.
Yeah, it's very easy to do that. It's I think we're all guilty of that to a certain extent.
It wasn't so damn exciting, and then we'd give up on it after a while and go do something normal. But it's you know what I'm saying about the ever further away goal. It's kind of inspiring in a way. It's something to chase after.
Yeah, totally. Well, I mean, we've been chatting for about an hour or so now, so I mean, we should probably start to wrap this up. But is there anything I've maybe missed, or anything you'd like to add to the conversation, and maybe some topics we might have skipped over?
Well, you remember we came up with that really funny kind of 4-stage development of the trader. Guys, before we were on this call, Aaron and I were talking a little bit about how traders develop and the commonality of their development, and how some traders do things very differently. But I don't mean to put words in your mouth there, and I'll take, like I said, credit or blame for this quote. But go ahead.
Yeah, so you were mentioning that, like, a lot of traders, they start out and they make money,
and they have no idea why.
Yeah, and then they lose money and they still don't know why.
Yeah.
And then they're still losing money, but they know why. They realize why.
Yeah, they have some idea of what's going on.
And then eventually start making money and know the reasons for it. So it's kind of like those 4 stages kind of thing. So do you want to just sort of elaborate on that a little bit further?
Yeah. I mean, I just think it's funny, the parallelism of the construction of that phrasing. Like, you make money but don't know why. You lose money but don't know why. You lose money but kind of figure out why. And eventually maybe you make money and know why. Stage 2 is the elephant graveyard of traders. That is where so many careers have ended, in the losing money and not knowing why. I know that's not groundbreaking. I think many people find themselves at that point right now, probably. I hope you're inspired to recognize that, it's minimizing the money lost relative to the amount of experience gained. And so this is kind of like another traderism of, you'll always pay the tuition, but will you attend the class? Do you see what I'm saying? Everybody's going to lose some money. It might take you $5, $500, $5,000, $500,000 to learn the lessons of the market. And everybody's moving at a different speed. I mean, this is like what we were saying about the paralleling of life development too. Everybody is progressing through life at a different speed, and that's okay. It's the people who pay attention and try and learn these lessons early. So, after this interview, I'm going to go hop in a time capsule, go back 5 years in time, and read that entire ebook to myself. Then I'll call you from my yacht in the future, because I'll be a millionaire at that point. So.
If only.
Right. And I'm sure we'll expound more on that in the future. I think that's a great topic. The path of a trader. What is common? What is typical? What should people pay attention to? So often it's like we learn these things after the fact because that's when we build the experience. Man, I'll throw in another thank you. You are doing a great service to the community of traders by putting other great traders and yourself now, finally, out there as an example for others. I mean, it's just brilliant. And like I said, in I think a Twitter message or retweet, where were you 5 years ago? Where were you when I was learning how to trade? Like, why didn't I have this? It would have been phenomenal. So, Aaron, sincerely, man, on behalf of everybody, thank you so much, and thanks for coming on your own broadcast. And it was a pleasure to have you on your broadcast. And no, sincerely, man, it was good fun, and looking forward to continuing conversations and that auto strategy in 6 months' time.
Yeah, for sure. So I'll have to keep everyone updated on now that I've put it out there. I can't go back on it now, so better knuckle down. But yeah, thanks so much for doing this, Zach. It was really good to sort of get you to come in and kind of take my seat and swap sides for this episode. So we sort of changed it up a little bit. But yeah, I mean,
swap sides of the earth. When you said change seats, I was thinking, man, it's going to take me 25 hours to get there.
Well,
we are on diametrically opposite sides of this planet, guys. I'm in Cincinnati, Ohio, and Aaron is in Brisbane, Australia.
Yeah. Well, that's a really good point. But yeah, so if anyone wants to get in touch with you, Zach, how's the best way to do that?
Yeah, sure. You can shoot me an email at Trading Coach Z or Trading Coach Z for those of you in the States. That's TradingCoachZ at gmail.com. Or you can always hit me up on Twitter at Zach Hurwitz.
All right, good one. And if anyone wants to get in touch with me for any reason, more than happy to speak with anyone. I mean, that was partly my reason for starting this podcast, like I mentioned right at the start, that I'm keen to connect with other traders and just build a bit of a community and bounce ideas off each other and just kind of help each other out. So I mean, my email address is aaron@chatwithtraders.com, and my Twitter handle is @chatwithtraders. So you can catch me on either one of those, and yeah, I will we'll have to do this again sometime, Zach, and yeah, drill down on things a little bit more.
I think 6 months and 1 day from now, we're going to have another interview. No, I'm kidding. Don't anyone mark that in your calendars. I'm just giving you a hard time, Aaron. Thank you so much for having me on, man. It's always a pleasure, and anytime.
No trouble. All right, guys, take care, and take care, Zach. We'll speak to you soon.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool.
Like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up? Welcome back to yet another episode of the Chat with Traders podcast. This is episode number 26, and thank you so much for tuning in. At a young age, some people want nothing more than to be a trader. Well, this week's guest is one of those people. Brad Jelinek first started dabbling in stocks during his days in junior high. Then from college, he went straight into a Chicago prop firm. 13 years later, Brad is with the same firm and predominantly trades futures. So during our conversation, I of course asked Brad a bunch of questions around prop trading and futures related topics, which he responded with so many great answers, and I think you're really going to enjoy them. But the part I found to be really interesting was listening to Brad talk about health and well-being and the emphasis he has on longevity in this business. So if you plan on sticking around and really want to make something of your trading career, I suggest you pay extra close attention to this segment. And I also want to bring it to your attention that Brad is on standby and keen to answer any questions you may have about trading. So if you'd like to ask him something, just go to chatwithtraders.com/26, and all you've got to do is just scroll to the bottom of the page and leave a comment. All right, guys, this is the Chat with Traders podcast. I'm your host, Aaron Fifield, and here is this week's guest, Brad Jelinek. All right, Brad, what's up, man? How's your day been going?
Pretty good, Aaron.
Awesome. Thanks so much for coming on the show, man. I'm really looking forward to hearing about your journey and just your views on trading. So let's get this underway by telling us about how you first discovered trading. Like, I believe you were in college at the time, and what was it about trading that really appealed to you?
Yeah, it was actually, I grew up in a small town in northern Wisconsin, and being from that area, there was really nothing about trading around me. So I discovered it before college even. I think junior high probably is when I remember reading Jack Schwager's The Market Wizards. And then I read the other, I think the Stock Market Wizards was another one. And from that day on, I was hooked on it. And I think the credit I would give to my gym teacher. We had to take a gym class. I think everybody did when they were younger. And he would check his stocks every day. And I would always be wondering, what's this guy doing? So I would kind of go over his shoulder, and he explained to me he would, buy this and it would go up and you could make money and you could do research on your own and have your own hours. And I was just fascinated with it. So that's kind of the beginning. And then when I went through high school, it was during the explosion of all the tech stocks, 1998, 1999, into year 2000. So I would spend a lot of my time in study hall in high school trading these tech stocks and just getting on message boards and finding hot ideas and basically momentum trading with no idea what I was doing. I've never even heard of a pullback or a retracement or a trend line. I was just following momentum basically. And I did really well. I think I turned like a $5,000 account into $100,000 or something like that. And then the one smart thing I did was I bought a car. Otherwise, I lost pretty much all that money. I had no risk management principles. I didn't really know what I was doing. So, but I was hooked. At that point, there was no going back. So that was part of my tuition and my early experience. And then I applied. I went to college, got a finance degree, just because I was basically interested in trading, and that was the closest thing I could figure out to do. And then when I finished college, I interviewed with a prop firm, and I was lucky enough to get a job in Chicago with a prop firm when I was I think I was 21 or 22. So that was kind of the start of my journey professionally, and I've been there ever since. So that's where we sit today.
Okay, that's really interesting. So you turned $5,000 into $100,000. That's really impressive. How did you do that? I mean, if you've been so new to trading and not really knowing what you were doing.
Well, it's not really something I would brag about, because it was more dumb luck of the times. It was in that year you could make money buying anything, and if you got in the right NASDAQ stocks that had a lot of hype to them, anything semiconductors, anything that was pushed on a message board that was new. I mean, it was crazy, and that was all I knew. So that's the environment I wasn't professionally trading. That was more trading with my own account without any knowledge from people who know more about what's going on. So, the other side of it was I lost most of that money. So I made it and I lost it. And it was just kind of part of my experience. I wouldn't necessarily call that skill.
Okay. And what would you say sort of caused you to lose the majority of that money? I mean, obviously this was early on in your sort of career, but what sort of led to you losing it? Was it sort of the market changed and you weren't able to handle that? You weren't knowing how to trade in that type of market, or did you just sort of get overly confident, or what sort of happened there?
This is a great question. I mean, that's the learning lesson. All of the above. I think what happened was the market turned, and me being very young, 19, 20, 21 at the time, I didn't really understand what it was like to be in a bear market. I just knew the bull market. So when it turned, I was trying to buy these stocks on the way down, and it's like catching a falling knife. And the fundamentals were against me, the technicals were against me, and I don't think I had a good idea of how to deal with that situation. It had turned to a bear market, and I was caught unaware. underdeveloped, underskilled, and just not. And the market changed. And as I went forward in my career, that's always a tough time, when the market changes. But you develop a base of skills to deal with those things when you make it a profession or a career. And at that time, just didn't have that.
Okay, sure. So you mentioned just before that you went from college pretty much straight into a prop firm. Had that always been your intentions to go in the direction of trading at a prop firm, or were you is it just sort of something that happened? Like, I mean, a lot of traders just want to trade for themselves, you know what I mean? So what sort of led you into moving into a prop firm?
Yeah, I think I kind of had an intention to do it, but it also kind of happened that way. I was seeking it out because, having traded a little bit on my own, I knew that I needed access to capital. I needed access to resources. And I needed access to mentors and people who have come before me and could teach me a lot of things I didn't know. Because I had all the passion in the world and all the work ethic in the world, but you also it needs to be applied in the right way. And there was only so much I could do on my own. So getting into that environment really taught me how to harness a lot of those things from other people and see what people did well, what could I take from their strategies and apply to my own strategy. And eventually I crafted kind of a plan that fit me. But learning from other people was huge.
Okay, so do you think if it wasn't for your experience of trading within a prop firm that your learning curve might have been much more extended than what it was perhaps?
Yes, I think so. I don't want to shortchange myself because I really worked hard to sponge up every last resource and to hunt down people who were successful and to learn everything I could to move me along my path. So I definitely worked very hard at that. However, without having access to that, it would have taken me a lot longer. I would have just had to go a different, probably slower route. It definitely fast-tracked me. Because when you're struggling, you can talk to people who maybe aren't struggling, and they explain to you what they're seeing in the market that may be working, and they can sometimes help you fix things that are wrong. And it's really a nice thing to have.
Yeah, for sure. That's really valuable. So when you initially arrived at the firm, what was the learning process that you went through? Like, what was the education that they put you through?
Sure. Yeah. At first we would have classes and training, just nothing earth-shattering in terms of secrets or things that, just more of a structured environment is what I would call it, where you learn basic principles of risk management. You learned that you had to be accountable to a daily stop limit. You learned from other people who may have the ability to, ride their winners and press their winning trades, and maybe put out smaller feelers on trades that they didn't know and then trade it larger when it started to move their way. Different strategies, mean reverting traders, trend traders, spread traders, things that you might not have known about. You just had exposure. And I think over time, you just start getting in conversations with people and picking a lot of that up. And you kind of get out of it what you put into it in terms of how much you want to learn.
Yeah, okay. That's a really good point. So what would you say were some of the biggest challenges you faced sort of in your first year or so once you got to the firm, which affected your profitability?
Yeah, I think it took me 6 to 9 months to start making money and getting some sort of a strategy that I could have figured out. And what I went through early in my career was I didn't really take off. I would say, I did well my first 2 or 3 or 4 years. I made some good money, but I didn't really take off and kind of come into my own until years like 4 or 5, 6 in that zone. And it just takes time, it really does. And I think what I went through a lot was, and maybe this is my personality a little bit too, a lot of boom and bust cycles where I would do really well and then do really poorly. And I would have to, the emotional roller coaster was brutal for me. And as I've gotten older, it's been 12 or 13 years now, I've gotten a lot better at ironing those cycles out and staying more balanced, more in the middle, and just having an awareness of, that how it used to be for me and how it doesn't have to be that way.
Okay, so where were your sort of emotions coming into the picture as you were losing money? Obviously, when you're making money, you're pretty stoked. But how were your sort of like? How did you overcome the issue of dealing with, you know, the emotions of a losing trade that was leading to the bust?
Yeah, it took time. A lot of personal growth went into that for me, because I think it was part of my personality to be impulsive, which could be a very good thing in terms of reacting properly, not being trigger shy, being willing to take risk. I think those are very important traits of being a successful trader, but they also can hurt you when you're over impulsive, you're over trading a slow range, you're making a big deal out of something that's really not your setup. And that was something that I probably struggled with in my regular life, in my personality, and I brought that into my trading, which is a pattern that I think a lot of people have. So the emotion would come from just having something work for a few months. The market was in a situation that I understood, and then when that situation would turn, it would take me a lot longer than it probably should have to cut my size back and to figure out that things have changed. And then that's when the busts would happen, where I would have, the busts wouldn't ever be as bad as the booms were good, if that makes sense. But they were bad enough where it was part of what crafted me into who I am today, I think. And that was it was painful. And I learned from the pain eventually, but I think it could have probably been shorter than it was sometimes.
Okay, sure. And I want to pick up on that a little bit more as we get into this. But I presume the firm sort of offered you the one-on-one mentoring and coaching, like you've kind of already mentioned. But did you ever receive any help from perhaps someone like other traders who are outside of the firm?
Yeah, I would say that some of the traders inside the firm were my became really good friends and mentors. Outside of the firm, that kind of took time. I've built up a better network now of people, personal friends from outside the firm who I can talk with now about their trading and their views. And that kind of, eventually you meet people through different people and you build that network up over a few years. But I would say the core of my development came from people within the firm, because that was who I was immersed with every day. And that was satisfactory to me at the time.
Okay, sure. So you would say that sort of the guys who you met outside of the firm were sort of friends of friends? Because I'm always curious to know how like other traders meet other traders, because a lot of traders find this a very you could say a lonely kind of journey. So I'm always interested to hear how other traders are connecting and meeting with other guys and sort of doing similar things.
I found the same thing. It is a really lonely journey, and it's very difficult. And I think being in a firm made it a lot easier, because I was able to, use other people's networks. You make friends with somebody in your firm, they have friends who trade at either different firms or on their own. And then you have access, you go out and for drinks, for dinner, to social events, and you meet these people. And that definitely played a role. So that was really big. If I didn't have that, what would I do? I think I would probably try to get involved on some form of social media, follow people who maybe made comments that jived with the way I wanted to trade, comment on niche blogs of people who I enjoyed their content, and maybe strike up a relationship of like-minded individuals. It's hard, though. It's hard work. It's not easy, and I understand the difficulty in that.
Yeah, for sure. Those are some good points, though. So, yeah, we'll definitely take those on board. How would you describe your trading approach? Let's get into that a little bit. So I believe you're predominantly a day trader, but do you want to talk to us in a little more depth about the way you're trading?
Yeah, no problem. Mostly a day trader. Futures markets predominantly. Some stocks I do, and some longer-term swing trading with kind of outside of my firm's business. But for the most part, it's day trading. I would say S&P 500 futures are the majority of what I do. I'm just a point and click trader. I don't have any sophisticated computer systems or anything like that. I trade the euro currency, fixed income products like the 10-year and the 30-year note. I trade those once in a while. And I do a lot of event trading. So, if there's a situation going on in the world, an election, British pound election, or the UK election, I traded the pound. Unemployment numbers, ECB meetings, Federal Reserve meetings, I'll trade the products that correlate with that stuff. But But for my core of what I do, it's looking at equity futures, Europe and the U.S., mostly the U.S. And you can ask me about another question if you want on that, but that's basically what I do.
Okay, sure. And before we go any further, could you just tell us, what is it that attracts you to trading futures over other products such as like individual stocks and that type of thing?
Yeah, that I thought about that because I thought you might ask something like that. And, I think a lot of it is that's the situation I fell into. One of the things I've learned is you just kind of, when you go with a firm, you make the best of what is offered to you and you leverage those resources. So if you have people who do a certain thing well and you have resources in that department, it makes sense to learn from that. And, you hear a lot about trading to fit your personality and trying a lot of different things to find the proper time frame. And I think that's really good advice, and I agree with that. However, when you're in a firm and they do something pretty widespread, it pays to learn. And that's kind of part of what I did. I used what was around me, and that was day trading and that was futures. And there's a lot more leverage also. So for making a lot of money on a little bit of capital, it made sense in terms of especially for a new trader and a beginning trader.
Yeah, okay. That totally makes sense. So in your view, what are the forces that drive futures, let's say a stock index, and how does this differ from the forces that drive perhaps individual stocks?
Yeah, I think the setups and the logic is very similar. By market logic, understanding, taking out technical levels, market positioning, people stuck short or stuck long, markets not reacting to news properly. I think those concepts are valuable in any market. Stocks, you have your earnings reports and your fundamentals, your sector rotations, and then of course the overall market. With futures, indexes, and things like that, currencies, there's more macro related stuff going on. So economic data matters more than it might to a stock, or the unemployment numbers, the inflation numbers, and that stuff keeps coming in and out of flavor depending on where we are in the market cycle. And give you an example of like something the other day, I think it was a week or two ago, there was a U.S. retail sales number, and I was looking to trade the 10-year note. And so if the number comes out strong or high, that would be positive for stocks and negative for the 10-year note in theory. So what we had a situation going into the number was the 10-year note had sold off 2 or 3 days going into the number, anticipating a retail sales number that was going to be a little stronger. So when the number came out, it was a little stronger, but not that much stronger, maybe slightly stronger, I would call it. And what you got was a little bit of a sale in the 10-year right away, and then it rallied all the way up the rest of the day. And that's an example of, in my mind, it'd be market positioning. People expected it to be a certain way. It did come out that way. But once it came out, there was no one left to sell, and then the market reverses and moves higher all day. And I think when you see something like that, you can trade that theme the entire day. So that would be one example of an event trade or a news trade that I would look for.
Okay. And this might be a bit of a newbie question, but you mentioned the number coming out and it's going to be higher or lower. Mm-hmm. How do you know if it's higher or lower? Like, where's the benchmark kind of set?
Right. No, that's fine. That's a good question. That's usually if you just look at, you can Google search any number, and you can get a consensus. Usually there's so many publications that will post economic data calendars with, the number is expected at 1% and the highest estimate is 2% and the lowest estimate is 0%. So you just kind of get an idea. It's pretty public information, an idea of what people are looking at. And then you kind of can form, you can make trades around that if you study the market and you feel like it misses a certain way. That's just one thing I would look at.
Okay. All right. Cool. So how much of your trading is weighted on technical analysis versus the fundamentals and news, which you've sort of just mentioned, but how much of a factor does technical analysis have in your decision making?
I think technical analysis and fundamental analysis are both really important. I think on my bigger trades that I really like, I will have both of those things working for me. I think when I try to do a lot of reading on the fundamentals, since I'm day trading, a lot of times, technicals and market positioning, which I mean, as people stuck long or stuck short, something to that order, have more of a impact than the fundamentals. But when you get a fundamental day or a fundamental theme, it makes it way more powerful to go with the technicals, and that's when I'll trade larger. So that's something I always try to keep my reading up to date and know what may be a surprise or what may affect certain, equity futures, indexes, currencies, bonds, whatever I'm watching. So I know if something shifts fundamentally, now I need to look for technical divergences, technical patterns that I like, and I can get even more aggressive because I have more things in my favor.
All right, great. So just while we're on the topic of technical analysis, what are some of the indicators that you use, or perhaps things that you look for, such as, support and resistance and that type of thing? Like what do you use out of the whole range of different technical analysis indicators?
Yeah, I use price action a lot, and I used to, I'll start off by saying, I guess I used to be able to read the price book a lot better in the futures markets years ago. You could see the order flow. I could tell when there's buying or selling. And with computers, machines, algos, whatever you want to call them, being such a big part of the market now, it's made it a lot harder to read the order book. So that is less. That was one of the big changes I had to deal with and I had to adapt to, was adding another element to my trading, because that kind of got taken away. It became a lot more difficult. It just became noisy. So the market would still move from A to B, but it would do it in a manner that was a lot different than it used to be. And I think that was something that, because of that, I added some more technical indicators. And some of them that I use are just really basic stuff like MACD divergences, stochastic divergences with price. Price makes a low. The stochastic doesn't make a low. Things like that. Now, I'm not trading on that stuff, but I'm using that stuff to get in if I already have an idea. So if I have bullish fundamentals and I feel like I want to find a place to buy, maybe that would be one of the things that would get me in, as opposed to reading the order book, which I used to do, but has become a little more difficult. So I listed those stochastic MACD divergences. I also look at unfilled gaps. So if the market opens higher or lower, I like to use those as targets to later on, when the market moves towards those areas, it likes to fill those areas in. So I will have a marking on my chart where those gaps are. I like to trade into those. I'll draw basic trend lines if they're obvious on the chart. I'm aware of technical analysis patterns just because I want to know, basically, if people are using them and they're wrong, I want to know that they're stuck. If a head and shoulders pattern fails, I want to know that so I can go the other way. It's just that kind of logic is probably as important to me as the textbook logic of technical analysis. Okay.
I really like that point you made there about how, if it fails and you can see that people are stuck in that trade and you're going to go the other way. I think that's a really good point you mentioned. So the other day when we were speaking, I thought it was really interesting because we haven't really discussed on the show too much, and that's hedging positions. So do you want to tell us a little bit about how you hedge positions to reduce your risk?
Mm-hmm. Yeah. One thing I do, and I don't do this all the time, but if I have, so this year I've been doing it a little bit more with European index futures and U.S. index futures. When I want to buy, I'm bullish equity markets. They usually move together, but sometimes you'll see Europe is weaker or the U.S. is weaker. So a lot of times if I see that, I think the overall market's going to move up, but I feel like Europe is going to move up faster than the U.S. What I'll try to do a lot of times is I'll buy Europe in an area on the chart that I like, and maybe it goes my way a little bit, we'll say in this example, but I'm looking for a little bit bigger move. A lot of times I will sell the U.S. against it, put on a spread. And I'm not so concerned about the exact proper ratio of the spread. I just want a little protection because I'm trying to sit through the market noise. And if my analysis is correct, a lot of times what happens is I'm able to sit in my bullish Europe position and sit through some noise, or even have it go against me a little bit because I'm protected in hopefully the weaker product. And a lot of times I will take that hedge off and just use my outright long position in Europe to ride the market higher. And then I might get back into the short U.S. position later and get out of the Europe position and then try to stay short in the U.S. And that would be the perfect scenario that I caught both sides, which doesn't always work that way. A lot of times I also get hurt on both sides. But I think it pays to look at that when you feel like you understand a fundamental relationship about why one product should be stronger. And it can help you sit through a lot and sometimes make money in some choppy markets that you otherwise would be hurt if you were just trading one product.
Okay, and again, this might be a bit of a newbie question, but when you're hedging, is there a chance that you can end up losing twice as much?
Yeah, there is a chance, because if my analysis is wrong and the U.S. is stronger, not weaker, and Europe is weaker and not stronger, they could both go against me. So that's happened to me before. It's definitely a risk. It's something that it's just one strategy I've used, and I use it mostly when I feel like I have a good understanding of why one market should be stronger. But it's not something I think. To answer your question, yes, you could lose on both sides. We'll leave it at that.
Okay. And at what point is it maybe worthwhile for a trader to hedge a position? Like for someone who might be trading a $5,000, $10,000 account, is this an effective strategy, or is hedging more relevant when you're handling larger amounts of capital?
I think when you're trading a smaller account, my strategy would be to keep it extremely simple and find one or two things that you can do well and stick to those things. And as those things become comfortable, you add another thing. So the hedging can sound very confusing, but it doesn't have to be. I mean, it could be something like you want to buy energy versus the rest of the stock market. So you're long energy and you're shorting the overall market because you feel like energy is going to outperform. So you're kind of protected a little bit against the market, but it could be a simple strategy like that. But I think if I was newer, when I'm starting off, I didn't get into this stuff probably until 4 or 5 years in, that it would just help to be very simple and find maybe one or two patterns that you like. And maybe when they don't work properly, maybe that sets up a trade for you. Maybe when we don't react to news properly, that sets up a trade for you. It's just something very simple.
Okay, sure.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So here's a question I'd like to ask you, and it's based around risk. Would you say the way you view risk today has changed from the way you viewed risk in the first year or couple years of your career?
It's funny you asked that, because I have been thinking about that a little bit lately. The answer is yes. I thought that would never happen. You hear about, there's a saying, there's old traders and bold traders, but there's no old bold traders. And I'm starting to feel that a little bit, I think, and I'm not even that old, but just, if when you're younger, you just have this reckless abandonment for taking risk. And I think it's natural when you accumulate a little larger account and you've had a little success, you start to not want to lose what you have, and to be a little more protective. And also it mixes in with just your general makeup as a human being. And as men get older, their testosterone goes down. I mean, I guess for women it'd be a different question, but all of it kind of plays into the fact that your risk-taking gene or whatever ability tends to go down when you get older. It really does, because you know what can happen. You've seen the nightmare scenarios, you've seen the blow-ups, you've seen people around you get hurt, and it makes you a little more risk averse, which doesn't have to be a bad thing. It can end up meaning that you're more consistent and you take less big winners and losers, but you're more steady. So I think that doesn't have to be a bad thing.
All right, cool. So, Brad, if you could share with us, how do you go about reviewing your trades and sort of reviewing your performance, and how often you might sort of take a look at this type of thing?
Yeah, I do a lot of work on this. What I'm currently doing is for 4 years when I first started, I used to plot my trades every day. So I would print out the chart. I would take red and blue pens, and I would do a dot where I'd buy and a dot with a circle where I'd sell. And when I would short, I would do the opposite. I'd do a red dot and then a blue dot with a circle where I would buy back my shorts. And I would go through every day and look at those charts and see, was I getting poor spots? Can I get better spots? And I think it did help. It created an awareness to not be trading in bad areas that carried over into the next day. I eventually stopped doing that because it took so much time, and I thought I was kind of at a spot of diminishing returns. So what I do now is I use Microsoft OneNote. It's kind of like Evernote, if you've heard of that. And it's basically just like an online notebook. And I cut out my chart every day with just like a cut and paste program, and I paste it in there, and I write down. A good friend of mine who's a great trader gave me this advice, and it was some of the best advice I ever got. He said, instead of looking at all of your trades and looking at what you did wrong, only write down what you did right or what you wanted to do right but you didn't do. So now when I review my trades, I just go back and I review the setups that ideally, if I was thinking right, I would have done, or the ones that I actually did. So at the end of the day, I'm just looking at and teaching my brain, this is what I want to do. And the next day, I'm more apt to do what I want to do versus beating myself up because I may have made a bunch of dumb trades the previous day. Because what you're telling your brain when you do that is dumb trades, beating yourself up. And then the next day, you're just attracted to do things that you don't want to do. Even though you think you're helping yourself, I found out that that's just not very effective, at least for me. So this has made I think it's made a big, impact on my results by changing my thinking and kind of tricking my brain into looking for what I want to do.
Okay, I think that's a really interesting way of looking at it. So, yeah, thanks for breaking that down, Brad.
Yeah, and I could like to add one more thing. On the trade review, another thing I like to do is I like to tag. So I'll tag news trades, I'll tag event trades, I'll tag retracement trades, breakout trades with a little, it's a software feature. So then later on I can go search, and I start to build like 10 or 12 trades that I've tagged, and I can search them and see what's working, what's not working. And then I kind of have a little book of trades that way, and then I can kind of go back and see, how I'm doing on certain trades. And then when I struggle, I can go back to what was successful because I've documented that.
Okay, that's really cool. When we were speaking a little bit earlier, you were talking about sort of how the market goes through cycles and, things just change over time. Like you mentioned that computers have become more advanced and you're almost competing against them to a certain degree. Could you give us an example of how you've had to change the way you trade to adapt to sort of new market environments?
Yeah, I think for a trader, that's the challenge that never goes away. We always have to keep adapting to who knows what's going to come next. And market cycles are always there. But I think for a day trader who's been, I used to trade a lot more than I do right now. I think I'm a little more, I sit on my hands a lot more now, because what happened is slowly more and more of the volume was becoming computerized. And I think I touched on this earlier about it still moves from point A to point B, but it does so in a different fashion that's confusing for humans to watch and anticipate. So a lot of times I'll have to pick my areas. I'll have my fundamentals and my, some of those technical divergences that I talked about, and I'll find my areas that I like, and I'll get in maybe a medium amount of size versus what I'm trading. I'll put in a little wider stop, and I'll let that thing work, and I won't micromanage it as much as I used to, because I get shaken out when I try to micromanage it. So that's been, for a long time, I kept doing what used to work, and I was seeing results that were not what I wanted to be. Not as, if I had a great idea, I would look at it at the end of the day and see, I did my idea, I made a little money on it, but I really didn't capitalize on it properly because I was trying to scalp or trade the whole idea, but the order book and the computerized trading made it a little tougher. So sitting in the trade, ignoring the noise, seemed to be a better option for me. And that's something I've done, I would say, the last year especially, and it's helped me a lot. It's made a big difference.
All right, sure. And this is something I heard you mention during an interview you did with Futures Radio. And you were talking about stories and themes within the market. You might have already touched on this a little bit, but would you be able to elaborate on this point and tell us what you mean by sort of stories and themes? And maybe again, if you could share an example if one comes to mind.
Yeah, for sure. I mean, that's a big part of my trading are themes and stories. And when I hear a story, what I mean is something I can understand fundamentally, and it might not be something that's really obvious to everybody. It's just something that I've kind of developed because that's the way I look at the market. And one thing I mentioned was the 10-year trade with the retail sales number. Another thing could be something to the order of, we have a move in the market, and let me think here if I can give you a good example of something that happened. Okay, I have one. I traded an unemployment report in the market maybe 3 or 4 months ago, and we had a really good U.S. unemployment report. And that should have been bullish for the stock market. Non-farm payrolls missed by 80,000 or something like that. And their instant reaction was exactly what you thought. The market moved up. And then what started to happen after that was it started to slowly kind of bleed down, and it felt heavy, and it probably shouldn't have been that way. And the fixed income market, the 10-year note market, it also started acting in a similar way where it wasn't doing what it should have been doing on the news, especially given that the number was pretty surprising in terms of missing analyst expectations. And about halfway through the session, I think it was actually not quite halfway through the session, we got an announcement that I think it was an Apple computer was added to the Dow, and that caused the market to spike up a little bit because that was more people who are in that index have to buy Apple. And right away, the market just popped up and came right back down. And that was two things now that maybe should have been a little positive. The Apple news mattering a lot less than the unemployment news, obviously. And what happened was we started to continue down. And at that point, my theme and my story is kind of in for the day. It's that we got this surprise news. We tried to rally, and we can't rally. And then some other secondary news came out that might have been bullish. It's not being bullish. And at that point, that's where I'm using my technical divergences and other things to just sell rallies all day long. And the market kind of continued to trend down. And so those technical divergences on a day like that, where I feel like I have a story being we're not reacting to news, is more powerful to sell a technical divergence on that day because I have something behind the divergence. Whereas on a regular day, if I'm selling technical divergences, well, if it was that easy, all of us would program a computer to sell technical divergences all day. It just doesn't work that way. So you need something else. So when I say story, I'm talking about something else, and a reaction to something maybe that doesn't add up, or even a reaction to something that does add up. Maybe we get a number that misses, and it's kind of that break the bank number that we've been waiting for, and we rally all day long. Well, that could be a story too.
Yeah, okay. All right, that's really good. Thanks, Brad. Let's move this along a little bit, and I'd like to bring up the subject of health and well-being because I know you're a massive advocate for this. So this course, is important to everyone, but I feel like many traders probably don't give this the attention it deserves. So let me ask you, why is your health and well-being especially important as a trader?
Yeah, I mean, when I first started in my early 20s, I would, I'd be at my desk all day trading for 10 hours, multiple cups of coffee, sitting in my, hunched over at my screen, turning my head at weird angles, having neck aches. And, we can laugh about it, but it's not a good way to do this for a long time. And I think that going through some of those boom and busts and coming home and feeling like I wanted to cancel my evening plans because I had a bad day, or being very happy because I had a good day, is just not a good way to live. And it sows the seeds for misery. And I've figured out that, balance, exercise, moving around, going for a walk during the day, talking to people about other things except for trading, taking vacations. I got into meditation morning and night, have made a huge difference for me. They've kept me a lot more balanced, and I think it's going to give me that longevity that I need.
Okay, great. And this, I presume, includes having a healthy balance between sort of trading and your personal life. So how do you consciously manage this?
Well, I mean, I used to, when you get together with a group of traders, all they want to do is talk about trading. And I'm the same way. I'm always willing to talk about trading. Ask my wife, it's always, when there's another trader around, that's what we talk about. But I think it's important, and it becomes refreshing when you're a little older and you've been doing it longer, to talk about other things, to get exposed to other things, and to just totally get away from it. Take your vacations and just realize that it's like a pendulum. Everything's like a pendulum. If you swing too far to one side, you have to swing back to the other side. That's just how things work. And if you get too into your trading, what happens is you get too connected to the results, and you can't help but be overexcited and over upset depending on good days and bad days. And that the meditation practice I use it's very similar. It's just about observing, but not reacting necessarily to the emotions and the things that come in your experience during the day. And that's helped me maintain this attitude and just keep that perspective as long as I can.
Okay, let me ask this. What are some of the things you do either on a daily basis or regularly to sort of keep yourself both healthy mentally and physically?
Sure. So a typical day would be, I would get up in the morning. I have breakfast, small cup of coffee. I prepare for the market day. And then I go downstairs. I meditate for 30 to 40 minutes. I go up. I trade for 2 or 3 hours. Unless it's extraordinarily busy, I'll stay all day. But I usually leave then in the middle of the day, go for maybe a 45-minute walk, or I'll listen to an audiobook or something, or I'll just walk with no noise. And then I'll grab lunch, come back. I'll watch the afternoon session. Maybe I'll trade a little bit if it's busy. At the end of the day, I'll review my trades for about a half an hour, 40 minutes. I will then usually go to the gym or go to a yoga class, come home, have dinner, try to do a little reading or something not related to trading, maybe watch a TV show, and then meditate again at night and go to bed.
Okay. And I'm not sure quite how to ask this, but a lot of these things, so, you're taking breaks during the day, you're not sort of immersing yourself in trading at night and sort of first thing when you get out of bed in the morning. Is this a lot easier I presume it's a lot easier to do this and be as comfortable to do that once you've reached a level of success and you're much more confident in your trading. Would you agree with that? Like, it's while you're younger and you're trying to, you're really eager to learn how to trade, and you feel like the more effort, the more time, the more hustle you put into it right now, the better the results are going to be. What are your thoughts on that?
Super good, really good question, actually. I mean, when I was younger, it was almost the opposite. I was in front of my screen constantly, watching, recordings of my screen, always hustling and doing stuff like you said. And I think that did help me a lot. But what I've realized is you get wiser as you go along. I realize there's a time for that and there's a time that's not for that. And when it's very busy or in a recession or something's crazy going on and you get the volatility, that's the time for that. When it's not as busy, trading parts of the day, taking breaks, seems like you're not working hard or you should be doing more, but in fact, you're helping yourself because you are saving your energy for a time when you need it more. You are balancing yourself properly, and that's what I've found. I'm not saying that's truth for everyone, but it's really helped me pick my spots because, if you want to do this for 20 or 30 years, you need to pick your spots a little bit. And if it gets very busy, you'll see me move my hours. I'll be earlier. I won't take those breaks as much because the opportunity is so good. But I think the balance takes priority to the market hours for me because I have my strategies and my things I want to do. But a lot of times in the middle of the day, you just don't get a lot of action. So if I'm sitting there, I'm forcing things and I'm feeling like, the temptation to do that is greater. And when I leave and come back, I get that fresh perspective and that mindset that's the mindset I want when I'm trading.
Okay, sure. That's really well said, Brad. So all in all, besides feeling better and sort of being healthier, you would agree that this has had an impact on your bottom line, just sort of tying it back to trading. You've had better results as a trader directly related to sort of your meditation and your just general taking care of yourself.
Yeah, definitely. And I think the big payoff is going to be because as a trader, a lot of the money comes when the market starts to loosen up and you get the volatility. So, the best money will come when you're doing these things, but they line up with that good market. So that's the market is a big part of it because in a good market, average traders do well, new traders make money and good traders do extraordinarily well. And in a bad market, you can take everything down a notch. So I think that's important to recognize that a market can make trading easier if it's conducive. But what it does, the best way to answer your question is longevity. The longer you're in the business making money, the more money you make. So if it prevents me from burning out, well, I can't put a price on that.
Yeah, no doubt. Really well said. All right, Brad. Well, this has been awesome, and I'm sure we could continue for much longer, but I know you've got places to be, so let's sort of start to wind this down, and I've just got a few more questions to throw your way. So,
sure.
I'd like to ask you, what would you say is the number one reason you believe the majority of traders never reach a high level of success? If you had to put it down to, say, one or two things, what would it be?
I think you have to have one thing I would say is that desire and that fight inside of you that you really want to do this keeps you going. Because everyone's going to go through really tough times when they're trading, really dark days when they're trading. But it's that knowingness and that willingness to do anything it takes. You can't defeat someone who keeps getting up, after every setback. So I think that would be one thing. The second thing would be, for me, it was to learn that when I understood something, I needed to trade it larger. And when I was not trading well, I needed to cut my size down drastically sometimes and get out very quickly and learn that if I do that, I'll stay alive. And if I stay alive, I'll be able to figure out something that I can trade bigger again in the future and start to normalize myself. So it was managing myself that way in addition to the desire, I think, are the two things.
All right, both really good points. Is there one book which has really helped you grow as a trader that you would maybe recommend to others?
The whole Market Wizards series. I like the new one the best. Hedge Fund Market Wizards is Jack Schwager's newest book, and that pertains more to recent times. So I listen to those on audio 2 or 3 times. I like audiobooks because I'm walking a lot, so I don't have to sit and read. I can do it while I walk. Those have been fantastic because you hear stories from people who have gone through this stuff. You've heard how hard it's been and how they bounce back, and you've heard, that some of them didn't make money for a few years. Some of them blew out, and it makes you feel, it humanizes things to you a little bit more because sometimes you think great traders just always have success, but nobody always has success.
Yeah, absolutely. And if anyone's interested, I'm actually having Jack Schwager on the podcast in a couple of weeks' time. So I'm pretty pumped up about getting to speak to him. It should be a really good one. Is there any final piece of advice you'd like to leave with anyone listening?
I think seeking out a mentor, seeking out like-minded people who can help you on your journey is always something that you hear that over and over again, but I had that when I started, and it's really helpful. And I think if you're on your own and you feel like you're on an island, making a point to either get into a firm or get with someone who can help guide you along your path.
All right. Awesome advice, Brad. Thanks again so much for coming on. Before you run away, is there any way that listeners can either find out more about you or connect with you?
Yeah, I would give you my email address. It's probably the easiest way right now.
Okay.
It's JELINBRA1@gmail.com.
All right, cool. We'll put that in the show notes. And I should have probably asked you this beforehand, Brad, but if you're open to it, would you be willing to answer questions that anyone might have if they just leave a comment under the interview at chatwithtraders.com?
Yeah, and anybody who wants to email me or ask me questions, I'm more than happy to talk.
Okay, good stuff. So if you've got a comment or a question for Brad that you'd like him to answer, just go to chatwithtraders.com/26 and just scroll to the bottom of the page and drop in a comment there, and Brad will get back to you about it. All right, Brad, this has been awesome. Thanks so much, man. Have a good night, and let's talk soon.
Yeah, thanks for having me on. It was great. Talk to you later.
No trouble.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's up, everybody? Welcome back to a brand new episode of the Chat with Traders podcast. This is episode number 27, and I have a very special guest lined up for this episode. The chances are you're already very familiar with who he is, and if you're not, then I'll probably have to presume you're new to the realm of trading. Jack Schwager is the author of a number of widely acclaimed financial books, including the timeless Market Wizards series, commonly referred to as all-time favorites by many of the guests which have appeared on this show in the past. As well as a best-selling author, Jack is widely recognized as an industry expert on markets, hedge funds, and trading advice. He's also the co-founder of FundSeeder, a platform designed to find undiscovered trading talent and connect successful traders with capital from investors. During our interview, we discussed Jack's lifetime involvement with markets, some of the key lessons he's learned firsthand from interviewing many of the world's greatest traders, and so much more. I hope you enjoy this interview as much as I enjoyed hosting it, because it was an absolute honour to speak with Jack for almost 90 minutes. All right, guys, here it is. I'm Aaron Fifield, the host of Chat with Traders, and here is this week's guest, Jack Schwager. Hey, Jack, welcome to the podcast. How's it going?
Oh, great. Thanks.
Awesome. Well, I must point out, first of all, that I'm not doing quite so great because I woke up this morning with a damn cold. So I'm dealing with a bit of a croaky voice here, which is annoying, but the show goes on. So, Jack, an absolute honour to be speaking with you today. Thanks so much for making the time to come on the show.
Thanks.
So, a few of the topics I'm keen to speak with you about today would, of course, be how you originally got involved with the markets, and also what inspired you to become an author, and some of the key lessons you've picked up from interviewing so many super successful traders. And I'm also keen to find out more about what you're working on these days with Fundseeder and other various projects. So how does that sound?
That sounds good.
All right, great. So, many people recognize you as an author, and aside from your books, may not fully understand your deep involvement with markets. So, winding back time, what was your very first introduction to markets?
Well, other than as a kid, I guess having my little bit involvement in stocks, very minor, not a great interest. My father, bought some stocks sometime, but really trivial. There was no real interest. I wasn't one of these people like the market wizards I interviewed many times. Really had a passion for markets starting in high school. That was not me. My real introduction to markets really came because I was out of graduate school looking for a job. I had a master's in economics and a minor in math, and I, from a good university, and I figured I should have an easy time finding a job. Actually, it wasn't hard, but I kind of expected to have a job the first day I looked. It ended up taking 2 weeks, but I actually found my own job because I got discouraged with dealing with employment agencies. So I put an ad. At the time, there was the New York Times had actually was sort of said the opposite of a help wanted. They had help wanted, but there was a small section where you could post an ad if you were looking for a job. And I did that, and I just put in the 2-line, the cheapest ad I could put in, and it cost me about $15. And basically said something like, major in MA in econ, minor in math, looking for an analytical job. That was pretty much it. And I had about 16, 17 calls. Of those, all but one were really the types of calls where they try to make you think that there's a position, but what they're really trying to do is get you involved in a pyramid selling scheme or some other exploitative thing. And I guess they use those type of ads to find people who they hope will be patsies. But there was one legitimate response, and I called back on that one, and it ended up being the job that I ended up getting, which was for an analyst position in the futures research department. And that was and I knew nothing about futures at the time. I knew almost nothing about markets. Economics degrees, particularly, even today, I guess, maybe today's maybe a bit different, but still probably don't prepare you very much for anything to do with markets. But back in my day, they did, markets were not even on the curriculum. So I really knew nothing. And that's how, but I got into the job because the research director, a fellow by the name of Aaron Shiska, was the writer of a commodity column for Barron's. And he was looking to replace his analyst who was leaving. His analyst who was leaving was, by the way, Michael Marcus, who was chapter 1 of the first Wizards book. That's how I met Michael. Anyway, he was looking for a replacement, and since he had this column, he thought it was a good idea to kill 2 birds with one stone. And all the serious candidates that he got, or I guess he narrowed it down to 4 serious candidates, he had each of us write a column, and I got, to a market that he had to write a column on anyway, and I got assigned copper. So not knowing anything, I basically went to, I lived in Brooklyn at the time, and there's this huge library in Brooklyn called, Grand Army Plaza. And this is way pre, it's pre-PCs, let alone pre-Google. So you didn't have that type of luxury. So I had to go and I had to go to a really big library to find stuff. And they had these periodicals. There was one, there was an American metals market, I think, there was a daily newspaper on metals. And then there was a McGraw-Hill had a weekly or a bi-weekly on metals. And then I found some additional articles. And so I basically did a crash course education. I went back several years worth of reading articles and writing and just reading the background articles I could, and wrote an analytical article on the copper market, which basically is what got me the job. So you could say writing really got me my first job. Well, more than could say. I would make it a definitive statement. Writing did get me my first job.
Okay, right. Well, that's a really interesting sort of intro into the market. So even after you began writing books, a bit later on, you were still involved with other firms. So could you run us through some of the other firms you've worked with over the years and what was perhaps...
Well, I worked for a number of major brokerage firms. Some of the early ones have converged into non-existence. But the last one, the one I left voluntarily about 20 years ago, was Prudential Securities. And for almost all my career, except for the first 2 years, I basically, when I was working for brokerage firms, worked as a director of futures research. So there was, and before that, it was Payne Weber, and before that, Smith Barney. Those were the last three major firms that I worked for. Subsequent to that, I spent a few years starting my own little hedge fund, and that led to getting approached by a London hedge fund advisory group, which asked me to join as a partner, which I did. And I spent about 10 years with them until we got bought out by a London merchant bank called Close Brothers. And after that, I took some more time, wrote a few, and I wrote books all along my career. But after leaving that, I spent 2 years where I mainly wrote books. I wrote 3 books during that period. And then I got involved in this startup, fundseeder.com, which I guess we'll probably talk as a separate topic later on. And I also do one-off topics, as they tasks as they come up. And one was a syndicated project I did for TradeShark. So that's a 40-year career in 2 minutes. I guess that's I can make it.
Yeah, that's excellent. And just before we move on, just one more point I'd like to touch on there. In your sort of research positions, what sort of tasks or what sort of things are you working on a day-to-day kind of basis?
You mean now or previously?
In your sort of research roles when you were working with these firms?
When I was a research director, basically, I was involved in both fundamental and technical analysis. I started out as a fundamental analyst. That was my first job. I didn't believe in technical analysis at all until I had a technical analyst work for me by the name of Stephen Kronowitz, and I noticed that he did pretty well in his calls. Actually, of all the analysts, he was one who did the best. And it may, being not like to believe that I'm not a closed-minded person, sort of, said, okay, tell me about, what you're doing and how you do it. And sort of I got to better understand what the rationale behind technical analysis is, that it's not just a matter of trying to, look at pictures and it's not a black magic art. It's really, the philosophical concept behind technical analysis, nothing more than prices reflect the behavior of all the participants and so the influences on the market. So therefore, there is a logical reason to believe that charts might be helpful. In any case, he was my influence, and after spending up to that point maybe 5, 6, 7 years purely as a fundamental analyst, and discovering that fundamental analysis, while it works for some people, it never worked well for me, because even when you got the even when it was helpful and it gave you the basic idea of whether it's a bull or bear market, it did nothing for timing. I mean, that's one problem. Fundamental tells you nothing about timing. And the other problem is fundamentals sort of have how should I best put this, almost pathological relationship with risk management, in that if you have a fundamental opinion and the facts and the fundamentals don't change, the more wrong you are, the more the fundamentals dictate that you should increase your position, which is the exact antithesis of what you should do from risk management. Whereas, because to explain that a little more, let's say if I decide that wheat is a good buy at $5, if it goes down to $4, then it's a better buy, So if nothing has changed, right? So I should buy more. So the trouble with fundamental analysis, it has no risk management inherent in it, and on the contrary, it has the opposite of risk management. It would cause you to increase your position when you're losing. But technical analysis, by its very nature, if the market goes against you, unless you're one of those rare technical people who are using a counter trend approach, but with that exception, for the most part, virtually any methodology using technical analysis, if the market's going to go against you, the methodology itself would dictate you're getting out. So that was a big advantage as far as trading goes. And when I became familiar with technical analysis, I basically abandoned fundamental analysis as a way of trying to trade. And any trading I subsequently did was always technical oriented, whether it was discretionary chart reading or whether it was systematic, but it was always technical rather than fundamental.
Sure, okay. Thanks for expanding on that, Jack. Now, you've written over 10 books in the time frame of about 30 years. So it's clear you have an undeniable passion and a fascination for markets. But what was it that sparked this? And more so, what is it that continues to intrigue you about markets?
You mean an interest in markets, basically?
Essentially, yeah.
Well, when I got out of graduate school, I was basically looking for an analytical job that was not repetitive. And I guess you really can't get into anything more non-repetitive than markets because it's always changing. And so it was an interesting way to combine analysis and a subject of study that was always challenging and always changing. So I think that's what's interesting about it. It's also a place where your opinions are, you get your grades pretty instantaneously. I should be clear though, and I know your podcast is really a trading podcast. I got to be honest, even though I am probably considered one of the experts, certainly in terms of picking the minds of traders and trading advice, and I do think that what I've written in terms of trading advice is very sound stuff, and I've had so many people tell me it's helped them that I kind of believe that it's true. But having said that, I myself do not really consider myself a trader. I'm not particularly talented as a trader. I don't particularly have any grand emotion or passion for trading itself. I do it, sometimes I don't. It's on and off thing. Sometimes I do it, sometimes I don't. I don't particularly like the emotionalism of trading, which is one of the reasons I don't do it all the time. And also, it's a time eater. If you're trading, then it keeps you from doing other things. And so, for time reasons, many times I don't trade. But for large parts of my adult life, I have traded. But it's never been a main thing. I've never considered myself a great trader. I can basically the most I'll say about myself is I'm net profitable, but I don't consider myself a particularly good trader. Although that has nothing to do with the stuff I write about, which comes from traders who are exceptional and whose advice I think is very sound.
Sure, yeah, well, that makes sense. So, let's talk a little bit about some of the books you've authored and some of the things you've learned and been able to extract from the minds of these insanely successful traders. So, first of all, what inspired you, or where'd the idea come from to write your very first book a complete guide to the futures markets? I mean, what was it about?
Oh, it's very good. You're one of the rare interviewers that finishes that question with a complete guide to the futures markets. Usually the question is finished with Market Wizards, and I have to backstep and say, that really wasn't my first book. So the complete guide to the futures markets, it's going to sound egotistical when I say this, but when I got into the futures research, I kind of was impressed with the lack of quality stuff out there. And I didn't particularly think that I was great, but I thought that I could do better than anything that was out there. So I didn't find what I considered a really good book on the futures markets, and I thought that I could write a better one. And circumstances worked out that I was leaving a job and I would have had no problem going and just finding another job. But I decided, I've wanted to write this book. Why not take the time now? So I took a sabbatical. And so what I was trying to write was a comprehensive text on futures, sort of the definitive text on futures, at least for that time. And it was a serious work. So, I mean, it runs over 700 pages. It covers all sorts of stuff in fundamental analysis. It covers statistical stuff. It covers all sorts of classical chart analysis. It covers technical indicators. It covers trading systems, testing trading systems, trading. Yeah, it's pretty comprehensive. So that's the book. And I did that, again, pre-PC days, pre-computer. I was literally, for those who do stats, you can appreciate this maybe, but I had to resort to doing multiple regressions using a calculator, which is just a great time waster. But it would have been a lot easier to do the book in modern times than it was when I did it. And it was only because I was so enormously focused at that time that I was able to even do it in a year. I also had to hand do the charts, everything. There was no Excel. There was no, or maybe I don't know if there was Excel or Word or any of those things existed, but this is 83, 84. If it existed, I didn't know about it, and I didn't have a PC, and I guess PCs were still probably in their infancy at that point. So in any case, that was a book that required manual labor. And that was the first book that I did. Now, having done that, I really didn't have a great eagerness to do another book quickly, but I did along the way, as I was involved in trading, and I knew some great traders like Michael Marcus and some other people. I was at that Commodities Corp actually for a year. I knew Bruce Kovner and I knew some other people who were great traders. I thought, would be an interesting book to write, going to interview like these great traders and find out what they do and what do they do that's different and why do they excel where so many fail. But I had a full-time job as a director, more than full-time job as a director of futures research, and I wasn't eager to sort of work nights and weekends additionally on a book. So I didn't do anything for a couple of years, even though I had the idea. And then one day I got invited by a publisher to have lunch, and they said, basically the pitch was, we think your Complete Guide's a great book. We'd like you to, we have this idea for a whole series of analytical books. We want to do one on each market, and we need an editor-in-chief, and we want you to head up the project. And sort of having done one of those very, very in-depth analytical books, which, by the way, you only do because you're trying to prove something, and you're trying to prove that you can do a really good book, or just for ego almost, or for self-satisfaction, or to demonstrate, or to just achieve putting out a really good book. But you certainly don't care, or you're certainly not focused on selling because, and I say this only semi-facetiously, it really is true as well, that the amount of books you sell are inversely proportional to the number of equations you put in a book. And by virtue, and I knew I put more equations in than I should put into that book if I wanted to sell a lot of copies. So maximizing sales was never my goal in the complete guide. It was basically to the best book I could that was serious and analytical and could be read by a serious layman. I think it doesn't require really a college degree in math or science necessarily to understand, but you have to be serious. That I only wanted to do once, and the last thing I wanted to do was to do it again. So I said, I'm not really interested in that project, but, because I don't want to do a bunch of books that sell very few copies and require a lot of in-depth work. So I said, I have this idea, which is I viewed more as a mass audience book and more of a book that, could reach, just broader audience and be more entertaining to read and so forth. And I told them about the market wizard concept, and they really liked it. So I wasn't intending to do the book, but they came back with an offer, and sort of that was the catalyst. And that's how Market Wizards got written the first time.
Okay, that's really interesting. It's good to sort of know where the idea for that book came from. And I'd like to quote the opening line from the new Market Wizards, which is the second one in the series, where you said, "The markets are not random." And you made it very clear that this is a statement that you truly believe. But to what extent are the markets not random?
Well, to the extent that they're not random in a couple of ways. And this goes into the whole controversy, which has been going on for decades, between those who believe in the efficient market hypothesis and those who don't. The latter being, at least in serious academia, being behavioral economists. But of course, originally and now as well, the whole sorts of people in a trading community. Now, I felt from the beginning that concept was wrong for many reasons, but two big conceptual reasons. One is I just knew too many people who had obvious trading skill. And it wasn't just they were lucky, they just did too many trades for too long and had results that were too lopsided to be explained in a probabilistic sense that, if you have enough traders, some will get those results. No, I don't care how many, you can have 10 billion traders, you're not going to get those results, So clearly something is going on here where people are getting types of track records that from a simple probability calculation would be impossible if the markets were random. And that's one of the arguments I always have against the efficient market hypothesis. The second thing is, and this big, in both of these are big areas and there's kind of sub parts to them, but the second big concept of why I think people are wrong when they believe the markets are efficient is because prices, very often there's circumstances where clearly the market price is not right. I mean, there's just tons of examples where you can show that to be the case, and there's by no stretch of the imagination can you say the market price is right. So I'll give you. In fact, I wrote a book. My next to last book, and it was a non-market wizard book called Market Sense and Nonsense. And in Market Sense and Nonsense, which I go through a whole bunch of. Each chapter deals with a different set of, different subject of misconceptions. One long chapter, probably I think the longest chapter in the book is debunking the efficient market hypothesis. And one of the things I do in there is I give a number of examples of just come on, in no sane world could this happen if the markets were efficient. And there's a lot of examples. So let's just go, let me take one. I mean, there's so many. So let's say take something like Countrywide. Countrywide, if you had to pick a company that was the worst of the worst, I mean, I don't know who I would pick, this whole 2008 financial meltdown and companies that participated, in my mind, the heads of these companies should have ended up in jail, but they walked away with hundreds of millions of dollars, unfortunately. But no one was worse than Countrywide. And Countrywide literally proved everything. You could not, their people were instructed to give mortgages. If they turned down a mortgage for any reason, like just because a person didn't have a job or income or anything else and was asking for a large amount of money, they would be told to find a way to do it. And that was because Countrywide then sold off they didn't have to keep it. They didn't have to worry about people repaying. They sold it off to Wall Street, who didn't care because they repackaged them and sold them off to investors who didn't know any better. Or I should say, not who didn't know any better, who were relying on the rating agencies, who were either themselves incredibly dumb or compromised and looked the other way and then therefore are guilty in that sense. But they could only plead either stupidity or malfeasance. There's really no other way of explaining it. But in any case, going back to the origin type of company, the ones who produced these really, truly terrible mortgages that just had a very, very poor chance of being repaid, and did so knowingly and had a corporate culture where negligence was encouraged. Nobody, I think, could be worse than Countrywide. And that now, I just try to get people a sense of how bad this company was. So now a company like Countrywide was depending totally on this housing bubble going on. Because as long as the housing bubble goes on, prices are going up, and no matter how incapable people are of paying back a mortgage that you give the mortgage to, as long as housing prices go up more than they have to pay back, it kind of sort of self-sustains. Yet if that stops, a company like Countrywide is going to be in a whole bunch of trouble, right? Not only did it stop, but you can look at something like delinquencies. And delinquencies were sort of, during the housing bubble, were very low at about 5%. And then they start going up, and they go up and they go up, and they went from 5% to 10%. So mortgage delinquencies actually doubled. Now, this should have been like, mortgage delinquencies going up is the type of thing that should be a screaming cautionary note for Countrywide being subject to collapse. And if you look at the chart, and this is why I say, if you tell me the market price is right, you got to be just blind. And I'm just mentioning, I'm going through detail in one example, but there's tons of cases like this. So what did Countrywide stock do? As delinquencies went double from 5 to 10%, it actually went up to a new record high. The record high occurred after delinquencies has doubled, and about a month after the record high, the stock collapsed. It didn't stop collapsing until went out, until the company went out of business. So how could you can't explain that by the market price being right? No, what was going on was there was a bubble. People were just buying. People were buying without real insight. And there was enough dumb money that was willing to go into the stock because it was making new highs, even though it was completely rotten to the core. And the thing that was vulnerable was already blasted out because these are reported statistics. Mortgage delinquencies are reported data. So it's no big surprise. And so the collapse of the stock occurred about a year and a half after it should have. And it occurred right after it made a new high. So that's one kind of example. So my point here is that market prices are not always right. And if market prices can be dead wrong, and you can show many examples where they are, then the idea that underlies the efficient market hypothesis, that market prices are always right and all new information is immediately discounted, doesn't hold water because if market prices are not right, the whole theory falls apart. The one place the efficient market hypothesis is correct, and the reason why there's an illusion that it's correct, is because one of the conclusions that come out of the efficient market hypothesis is that the markets would be very difficult to beat. And that is true. The markets are indeed very difficult to beat, but not because the markets are efficient. They're very difficult to beat because what moves markets are both fundamentals and human emotion. And human emotion is very difficult to gauge. I mean, how far does a bubble go? When does the bubble break? These things are very hard to predict and very hard to trade. So it's not because the markets are efficient that the markets are difficult to beat. It's because there's such a big influence of human emotion that can't really be programmed precisely and is very difficult to gauge. And so there's this conclusion by people who look at the market say, oh, the mutual fund managers always, usually lose to the indexes and markets are really difficult to beat. Therefore, the market are efficient. Well, no, that's not why they're efficient. Yes, markets are difficult to beat, but that does not mean they're efficient. In fact, one of the things I put into Market Sense and Nonsense was that line of thinking actually, it violates a basic rule of logic. So there's a rule of logic that says the converse of a true statement is not necessarily true. So let me explain that of a simple analogy. A true statement is all polar bears are white mammals. That's a true statement. All polar bears are white mammals. However, flip it around, all white mammals are not polar bears. The converse is not true. Like you could have a snowshoe hare. So the thinking that because something is true, if A is true, then B is true, then going to say that B is true, therefore A is true, that's a flaw in logic. And it's done all the time by many people who are arguing the efficient market hypothesis. It's just a straight out flaw in logic. And so what they're saying is if the markets are efficient, then the markets will be difficult to beat, and then give you all these examples of how the markets are difficult to beat, which I totally agree. Yes, the markets are extremely difficult to beat. And then they jump from that back to the markets are efficient. It's a flaw in logic. And I can go on, but I think I've killed it. Oh, there's one, I got to throw out one, which is it's one example which is so beautiful. It's a recent one I came across, and I went to see Richard Thaler, who's one of the pioneers, and maybe the pioneer of behavioral economics, and a long time, disbeliever in the efficient market hypothesis. And he threw out this one example, which I just thought was brilliant. There's a closed-end mutual fund that has the ticker symbol CUBA, Cuba. Now, what it does is it has a portfolio of stocks that are invested in Latin America, South America, not Cuba, by the way, but it does have that because I guess it's a catchy symbol, CUBA. So that's what the closed-end mutual fund is. And like most closed-end mutual funds, it was trading at about, it was trading at a discount. In this case, it was trading at about a 15% discount. Which means that since closed-end fund, you can't do it. But if you were able to liquidate the entire portfolio, you're paying 85 cents on the dollar for what the portfolio is worth. That was on as of a given day. The next day, it goes from a 15% discount to a 70% premium. Okay, in one day. This is like unbelievable. So what happened? What happened is President Obama indicated he could normalize relationships with Cuba. Now, the wonderful thing about this example is they did not hold, first of all, it'd be illegal to hold any Cuban stocks, and they didn't hold any Cuban stock, companies or stocks or whatever. And secondly, there was nothing in Cuba to own. It didn't even exist. Cuba is a true communist country, and there are no stocks to own. So despite the fact there was nothing Cuban in the whole portfolio, it went from a 15% discount to a 70% premium in one day because President Obama took steps to normalize relations with Cuba. You can't make this stuff up. And yet there are people who argue the markets are efficient, to which I would say, give me a break.
All right. Well, thanks a lot for going into so much depth with that answer, Jack. That's really good.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So I'd like to sort of pull this back a little bit to maybe some of the really key lessons and things that you've learned over the years from speaking to the traders that you've interviewed for Market Wizards. So let me ask you, in the first two Market Wizard books, is there a noticeable change in trading styles of those featured in hedge fund Market Wizards?
No, actually, I don't think that's really much. There's not much of a distinction in that. Now, hedge fund Market Wizards came, I guess, at least almost 25 years, I should say, after maybe the first Market Wizards book. So it came much later, but it does include people who were around from much earlier. For example, in fact, it includes, of all the Market Wizard books, the fellow with the longest track record and the earliest, maybe the earliest trader of anybody I interviewed was Ed Thorpe. And he was in the Market Wizards, hedge fund Market Wizards. So although, of course, some of the people, if they're younger in hedge fund Market Wizards, then they are starting in a later era. But I don't think there's really that much of a difference. The only difference is perhaps that in the very first Market Wizards book, and maybe a little bit in the second, there is a larger preponderance of futures traders, perhaps because, and I mean by straight out sort of futures traders, as opposed to people using futures for more complex strategies. And that's simply because back in that day, those were the traders that really excelled, and there were great opportunities in futures, and things like trend following worked much better back in those days before people started using the approach a lot. And the early practitioners of system trading, like Ed Seykota, had these spectacular type of results, which I don't think you could duplicate nowadays. So that's, I guess, one difference between the early books and the latter books. But like in both in the early books and the latter books, you had fundamental traders, you had technical traders, you had people who did both. You had system traders, you had discretionary traders, and you also had a large variety of approaches in any of the books. So I don't think there's a big demarcation really that one can draw from the early books versus the later books. And I should add on that one point. When the 25th year anniversary came up on the original Market Wizards, the publisher asked me to we want to do a new edition. So what I did is I actually wrote an additional chapter. So the volume that came out, I think, was the Market Wizards that was re-released in 2012, has an extra chapter. And in that extra chapter, what I basically do is I go back and I say, what do I believe now about markets? And I have one chapter about all the key points. And I deliberately did not reread the original Market Wizards when I did it. But the point was that I thought that really that my views or my conclusions about what are the important elements of trading success really didn't change from when the first book was written. So that chapter really was probably more intended to make the point that not much has changed when you get down to the important facts.
Okay, sure. And just to elaborate on that, and you kind of touched on it there, as we're now in 2015, do you believe that the same opportunity still exists in today's markets as it did for traders featured in the original Market Wizards? Like, besides their trading approach, is there the same opportunity provided by the markets, or has it become much harder to succeed at trading?
I would say from a logical standpoint, and of course one would have to to give you a correct or absolute answer, you would need data from back then and data from now, neither of which I have. And I don't know of any studies that have ever been done on that. And I assume in all cases, the majority of people, well, by definition, the majority of people lose, but whoever the majority is larger now than then. I don't know of any data that would allow that to be answered. However, from a logical standpoint, I would say I would be surprised if it was not more difficult today than it was then, for the simple reason that you have many, many more professionals in the market than you did then. And I think there's a certain amount of opportunity in the markets, and the smaller proportion of professionals. And by professionals, it doesn't have to mean people working for Wall Street firms. It simply means people who are dedicated to trading and are really good at it and make a living from it. But the larger the percentage of, and of course, those are the people who have skill in the markets, obviously, by definition. But the larger the proportion of those people versus the whole population of traders, the more difficult it becomes to trade. And in fact, I'm sure I have a line somewhere in one of my books, I don't remember where, or maybe I just use it in talks, I don't know. But the line is something like, you could take the 100 best traders in the world, whoever they might be, and you could say, okay, you could have this thought exercise and say, if those 100 traders were the only traders that were allowed to trade the markets, the one prediction I could make is that 80% of them would lose, roughly speaking. And that's simply because if they were the only ones that are trading, we know that there's certain transaction costs involved in trading. So the amount of money that's won has to be less than the amount of money that's lost. So if only the professional traders or the most skilled traders in the world could trade, by definition, a majority of them would have to lose. And that just makes the point very starkly. So it's obvious that if you go from a small proportion of traders as part of the trading population to a larger proportion, you get to a point where it becomes almost inevitable that even professional traders lose. So therefore, it is safe to conclude that the greater that proportion, the more difficult it is to beat the markets. And I certainly think there's a much larger percentage of professional traders today than there was, say, 30 years ago.
Yeah, okay. I mean, that's a really interesting concept and way of looking at it. So thanks for sharing that with us. I'd like to bring up the topic of failure, because this seems to be a common theme amongst many of the traders you've interviewed, where they have experienced failure in one way or another, and in some cases multiple times before actually sort of making it, so to say. So what's perhaps one of the most extreme cases of failure and recovery that comes to mind?
Wow, there's quite a few of them. There's a number of traders who blew up or nearly blew up, some who blew up multiple times in the Market Wizard books. I'm glad you picked that up, because that is a common occurrence, and from which I draw two conclusions before I go to some examples. But let me give you, the listeners, the two conclusions that I get out of that. One is that early failure, or even terrible failure, is not necessarily predictive of future outcome. It doesn't mean if you fail you're going to succeed either, but it does mean that if you have enough confidence, and just because you failed doesn't mean you're doomed to fail. There's plenty of people that I've interviewed who were disastrous in the early years and turned out incredible. That's point one. And the second point is, well, they did ultimately succeed because they didn't give up. So that is an element of excelling, is this spirit or the self-confidence that just doesn't give up. Now, as far as examples, I could give quite a number, but let's just take one. Michael Marcus, who I mentioned earlier, who was the trader whose job I took when he left to become a trader, and who became a phenomenal trader. But his early experiences in the markets, he sort of lost, he had a very little money to start out, lost that, then cashed in his father's the life insurance who died at an early age had left. It wasn't much, it was like $3,000 or whatever, but he lost that. And then he started trading and some more money, and then he kind of hit it, and he built up this small few $1,000 stake into 30,000. And I go through a whole story in the book. I won't go through it here. But he then borrowed some more money from his mother, who was, of not of very good means, barely got by. But he got so caught that he actually then lost all the money he had made, plus a part of her money. So that was his experience, and very few people would have kept on going beyond that. He did, though. And the way that story ends is he eventually did learn how to trade. He did get extremely, extremely good. He was talented. And he ended up going to Commodities Corp. They gave him a $30,000 account as a starting portfolio. And he eventually built that $30,000 account into $80 million over a dozen years. And he did that while they were taking out 20% of his profits annually for expenses. So one of the probably most successful traders of all time. And hard to find anybody who had a more disastrous beginning.
Yeah, that's an incredible story. That's really, really impressive. So let me ask you this. Do you believe that perhaps some of the traders you interviewed almost had some type of natural talent for trading? I mean, I don't know if that's the right word. Or would you say that it really is an even playing field and anyone could reach these insanely high levels of success with enough hard work and the right people around them?
Yeah, no, I would say with fairly strong confidence that not everyone could. For the same reason is not everyone's going to be able to, I don't care how hard you train, you're not going to run a professional marathon time, because most people don't have the body type that will make it possible. Now, can people run a marathon if they've never trained before? Yeah, if you're going to train hard enough, you can eventually run a marathon successfully, maybe even at a decent time, but only a tiny percentage of people will ever run it at a world-class time. And that's just the way most people's bodies are not constructed to make that possible. Can most people become soloists with the New York Philharmonic, if they take up the violin and practice a lot? No, I don't care how much they practice. They may become competent. They may even become, good, but very, very few people will become world-class violinists just because it requires some sort of innate skill besides just dedication. But in all those cases, people can achieve proficiency and success, but not necessarily exceptional success. And that's what I'm saying. And I think the same, why should trading be any different? So I think people can become net profitable, maybe even decent traders, if they have enough devotion and if they have some skill, more than decent traders, but only a small percentage of people, I believe, have the innate makeup, whatever that may be, to become truly exceptional. And I don't think trading is different than any other profession in that regard.
Okay, sure. That's a really good point you make. So, I mean, it's obvious that all the traders you've interviewed over the years were doing extremely well. But even still, did you find that they were constantly looking for ways to improve their trading? Or did any of them ever strike you as having felt like they'd perhaps mastered the market and were really comfortable with their approach?
Well, I think they were comfortable with their approach, but I think most would always be looking or realistic about if things stop working to change. And there are some people who are pretty exceptional at going from one strategy to the other. Ed Thorpe is a great example, who started out by actually. His background is he had a PhD. We didn't get the PhD in physics because he never finished his thesis, but the reason he didn't finish because he decided he didn't know enough math and then ended up with a PhD in math and then never wrote his thesis in physics. So he was a real quant guy, but he got involved eventually in markets. He's famous. His fame in the world, by the way, is not markets. His famous to the world because he wrote this book, Beat the Dealer. He figured out mathematically how you could win a blackjack, and he wrote this book that sold millions of copies. And and actually is the person who's responsible for casinos changing the way they handle blackjack, multiple decks, reshuffling all of that, due to his book. But that's sort of a tangent. To go back to the markets, he decided the real place to make money was the markets. And he was the first one to figure out the mathematical equivalent of the Black-Scholes model, which he did quite a few years before the Black and Scholes published their famous paper. So for a number of years, he was trading options very successfully, probably the only person in the world who knew how to price them. So he was making massive amount of money with very, almost no drawdowns. Then he went on, but as the efficiency went out of that, he became involved in statistical arbitrage. He developed that. He developed convertible arbitrage. He developed various strategies going from one to the other as each strategy started to lose its edge as more people became familiar with the approach. So he's a perfect example of somebody who starts out with one strategy and goes through completely different strategies by adapting to the changing market conditions. Even within a single strategy, like statistical arbitrage, I'm not going to go into the details because it's too specific for this type of broadcast, but even within that strategy, he changed the way that strategy worked through several iterations as the markets were changing, each time making the strategy again have an edge. And that's in the interview. I think it's too detailed to go into in this podcast how he did that.
Yeah, and I mean that kind of raises a point which I've heard you talk about numerous times, and that is that most traders tend to come unstuck due to a lack of flexibility. Is that what you're getting at here?
Yeah, I mean that's a trait that probably the majority of traders don't have, and it is a trait that is essential for great traders, and that is the ability to be flexible in every way. And one example would be to be able to say, hey, this has been a great method, but it's just stopping working, and I've got to figure out what does work and why this is not working and change if it's not working. So that's a way of being flexible. Another way of being flexible is like one of the stories I have in Hedge Fund Market Wizards, a fellow by the name of Jamie May, who goes into a trade, he goes into one trade idea, and this is a guy who does very, very deep fundamental research and can spend months researching an idea and making sure he's got it all right. But he had this idea, say, a few years ago where China was going from being a net exporter of coal to a net importer after years, a whole history of being just a net exporter. And he saw this growth in China and could see that there was going to be a tremendous amount of shipping increases going on because of China's demand. And so he had this bright idea of getting long shipping stocks. But when he did the research, he discovered that that shipping had actually gone through a boom a couple of years earlier because of a commodity price boom. And there was a whole slew of ships that were coming on stream, tremendous bulge in supply that was coming on stream. So once he became a bit aware of that, he realized that the trade was not buying shipping companies, but being short. He doesn't actually go short because he's always trying to have asymmetric return risk. So he did that by buying long-term puts on shipping companies. And ironically, this big idea that he had, which he put on in exactly the reverse fashion, ended up being his best trade for the year. Again, flexibility. And of course, maybe the most important way of being flexible is when you're in a position and you decide that you're wrong. It's the ability to get out. And if you're really convinced you're wrong, great traders will not only get out, but will have no problem flipping their position completely around.
Yeah, okay. And I think this is probably a good segue into my next question, which is, are there any traders you've interviewed and that stand out who pretty much just broke all the rules and just did the complete opposite of what you're quote unquote supposed to do when it comes to trading?
One. You can take all the traders I ever viewed into my life, successful traders I interviewed in my life, in any of the books, and including ones I interviewed that didn't go into the books, but only one stands completely alone, completely removed from the whole crowd of other traders. And if there is to use a cliche, the exception that proves the rule, I don't know. But the fellow is a prop trader, stock trader by the name of Jimmy Baladimas. He is the last chapter of hedge fund market wizards. Now, I should explain how I found, well, let me tell you what Baldemus does. You remember like a couple of years ago where we had certain commodities going sort of vertical, like silver, which had been going straight up, and then they got to 30 and 40s, and even I think the low 50s. But if you remember what that move was when it was almost like going straight up vertically in those higher price levels, well, who is selling silver in that type of a market? Jimmy Baldemus. Or cotton, which had gone multiples of its prior record highs, with the last days of the rally being these straight up, like a cliff type of huge price moves. Who's selling that market, in that vertical ascent? That's Jimmy Baldemus. So he's taking trades where the markets are going berserk the other way, and he's stepping in and going short. That's the type of trading he does. Now, I kind of say my first line of that chapter was Jimmy Baldemus breaks all the rules. And one of my first lines in the concluding summary of that chapter is some variation of "Don't try this at home." I mean, my point, I really don't want people to read that chapter and try to trade like Baldemus. And I do draw some aspects of his trading that do have applicability, but it's actually one particular aspect. But I want to make clear that I really don't want people to, by any stretch of imagination, think that this is something they should try. Because 999 out of 1,000 people will go broke doing this. By the way, if I was listening to this myself, and I heard somebody saying what I'm saying, said, "No, that can't be right. This guy couldn't be successful doing that. He's, these numbers can't be right, and he's going to blow up." Well, I don't know. I guess he theoretically could blow up, but as far as not being right, he's been sort of one of the best traders in his firm now for many, 15 years plus. And the way I know, and he makes millions every year, or I guess maybe in a bad year he comes closer to breaking even, but he's made a large amount of money trading this way. And for those who are skeptical, wonder how can I believe this is true, particularly for a prop trader. And people who are familiar with prop firms know you can't get track records from a prop firm. There's just no way of doing it because they just won't give out their numbers. So how do I know that this is for real and he wasn't like pulling a fast one on me? My son got a job as his trading assistant. And one day speaking to him, he said, "Dad, you wouldn't believe this guy I'm working for." And of course, being in the company, knowing of his reputation, he knew, and he entered all his trades and he knew his numbers. And so he knew he was for real. And that's the only reason I was able to put that chapter in the book, because otherwise I would have said, "No, this can't be right. This guy this can't be true." I would not have believed it myself. But if I didn't have my own son for verification, I wouldn't have believed it either. So, but for those who are wondering how that could possibly be true, that's the answer.
Yeah, and I guess that kind of, even though you said don't try this at home, obviously for good reasons, I guess it kind of highlights a point I've heard you make in sort of given talks and other interviews about how it's so important to find your own trading method and not necessarily try and mimic exactly what someone else is doing.
Absolutely. Yeah, and that's actually, when I give talks myself, if there's any point I emphasize probably more than anything else, is what you just said, that don't look for the trading secret. There is no trading secret. Look for the trading method that's right for you, and it's not going to be the same for everybody. So that's absolutely true. And then Baldemus's approach would be wrong for almost everybody. It's right for him because his nature is he just is not happy unless he's going against the crowd. He just always wants to be against the crowd. And if he tried trading another way, he probably wouldn't succeed because it's so against his nature. It's not a good way. He actually could. And in the interview, if people read that particular interview, they'll see I'm trying to say, hey, by the way, the reason he makes money trading against the markets that way is not because he necessarily is great at picking tops and bottoms. It's because he's constantly trading against his position. So he's going short, the market comes back a little bit, he's buying it back. when he's buying, he would do like 3, 4, 500 trades a day, and he could be short like 500 stocks. But if some of them, whenever they did, he's short, if they dip a bit, he'll take partial or total profits and then put them back on. So he's constantly taking profits out of the market that way. So that's what's really making his money. And he succeeds even though he's against going to major trends. It seemed clear to me that if he did the exact same thing, just trading against the positions, but went with the trend instead of against the trend, he would be a lot better off. And I explicitly mentioned he never really argued it or could give any reason why that wouldn't be true, but it was just against his nature. He just had to be opposite the wave in the market. If there was a mania of any sort, he had to be against it.
Okay, sure. So, I mean, while we're on the topic of trading methods, I mean, you often hear people say, keep it simple, don't overcomplicate things, simple works best. So my question is, did you notice amongst any of the traders you've spoken with and who were doing extremely well in the scheme of things, that for the most part, they do have a very simple approach, or is there an aspect of complexity to their success?
I've seen both. That's a type of trade or factor that doesn't really, there is no proper one for this. Is a successful traders use simpler approaches, successful traders use complicated, but I've seen both. Again, going to something like Thorpe, his approaches were highly quantitative, highly complex, and it was their complexity, I believe, that not just the complexity for the sake of complexity, but complexity that was necessary. Well, so let me say that again: complexity that was necessary to tease out the edge that he found. Or people like D. Shaw, again, extremely complex approach. I mean, you're talking about trading virtually every market in the world, all sorts of derivatives, outright markets, all sorts of options, thousands and thousands of instruments, trading them all against each other with scores of models, with teams of hundreds of PhDs. Yeah, I mean, you really can't get much more complicated. And it's the complexity. He's teasing out small. He's not actually actively participating anymore. He went off to pursue other endeavors, particularly computational biochemistry. But he designed this whole process, and he was basically finding a lot of very, very small edges, or that's what the approach does. And it would not succeed without complexity. So you have that as clear. You have those examples for clear situations where you couldn't really be successful without that necessary complexity. On the other hand, you have other traders who are not doing anything much more complicated than reading charts, but are particularly good at it, and use risk management and basically combine chart pattern recognition with risk management. Doesn't require a PhD. It does require a skill to be able to tell which patterns are more likely to result in a move one way or the other, and it does require the skill to use the appropriate risk management. But having those two properties, it can then be executed without really any great complexity. So I think it ranges across the board.
Yeah, and I mean, I guess that just sort of comes back again and highlights your point about finding a trading method that that meshes with your personality. Now, something that is forever embedded into my memory after reading, especially the New Market Wizards, was the necessity of having an edge. So I'm interested to get your take on this. What exactly is an edge? Like, how do you define it, and how do you know if you have one?
So first of all, there are people who misleadingly think that an edge is not absolutely necessary if you have good enough money management. There's in fact, there's a famous Wall Street saying that goes something like, even a poor system could make money with good money management. Now, that's absolutely one of the most ridiculous things that has ever been said. Besides not being true, it's just absolutely stupid. And the reasons it's stupid is for the same reason it would be stupid to think that you could go to Las Vegas and play roulette with a money management scheme and come out ahead. No, you can't come out ahead. because the house has the edge, you have a negative edge. All you're going to do if you try to apply money management is to guarantee that you lose. In fact, actually, money management in a situation like that would be bet all your money one time, because that's your highest probability of winning. So the best money management scheme is real betting it all at once, which is really the opposite of money management. So you can't be salvaged by money management. Now, the money management is absolutely essential, maybe more important than methodology, but it's not enough. You need to have an edge. So this gets down to, okay, so how do you know if you have an edge? Well, it's not one of those things you can look up or find a rule or prove absolutely. I guess you could see it in your equity if you show some consistency of making money without unduly large drawdowns. Then over time you can begin to conclude that you have an edge. If you are good at the markets, people who are good at the markets, another trait that does typify really good traders is they have a high level of confidence, and that high level of confidence is impossible to have unless you're delusional, unless you do have an edge. So it's a type of thing you have to sort of feel and believe on your own. It's not something that's definitively provable or anything like that. It's just that if you're in that groove and if you're kind of making money with some consistencies and have control of your losses, you get to the point where you feel that you have an edge, and your equity confirms that. I mean, you could feel that you have an edge and you're losing money, then you're delusional, So, but if your equity curve is reinforcing your what you're feeling and seeing and executing your approach, then you can jump to the conclusion that you do have an edge. But you need to have an edge, and an edge does not exist without a methodology. I've never met anybody who has an edge that doesn't have a very specific methodology.
Yeah, that's really well said, Jack. And just while we're on the subject, talk to us about one of your pet peeves, which you've labelled the well-chosen example. I really liked what you sort of said about this in one of your books. So would you mind explaining what is the well-chosen example and why should traders be aware of this?
Yeah, okay, that goes back to the very first time I wrote about that was back in Complete Guide to the Futures Markets, which was done in '84. And basically what I was seeing in the industry when I got into it was, you'd have all these ads for trading systems, right? And they would show you this trading system. They have a chart, and they would. There was like a perfect example would be like you would have a chart, and there was maybe a euro-dollar market or something like that, and the market would be you'd show all these sells and buys, and the sells would be all near the highs, and the buys would be all near the lows, and it looks like, oh wow, what an incredible system. And it could actually be an actual system that gave you those results. But in that particular case, it would be a counter trend system that you kind of, there was a market that kept on having false breakouts on both sides. And basically, if you use a system that sort of sold the breakouts instead of bought them, you did extremely well during that particular period of time. So you have a system that looks like it's really performing very well. But with that particular example, you use the same approach in a trending market, and you'd completely wipe out your account. And actually, the way, as I recall now that you mention it, I remember the thing that really drove this home. It was one day, we had been working on trading systems, and I had a partner that I was working with. And we developed these systems and spent some time on it or whatever. And I wouldn't say they were complicated, they weren't complex, but they were not super simple systems and had some sophistication to it. And then I read this article, and it showed an example of, I think it was a Swiss franc it was, and it showed it over a year or two time, and it made like $37,000 at very small drawdowns, and the signals were just great. And then I ran our system, and we did nowhere near as well. Yeah, our system made money during that period, but nowhere near as well. And I was kind of discouraged. And the system that was described, by the way, this was for a magazine article, right? It was a very simple system. It combined two moving averages. It sort of took something like a 20-day moving average and a 6-day moving average. And when they were both long, you were long, and when they were both short, you were short, and if they disagreed, you were neutral. And I kind of, knew that, well, we had tested, so, one of the early things we had did was test moving averages over, different time periods and just as a basic, very simple approach. And I knew that, 20-day moving average alone, 6-day moving averages did not work well. So how could the two of them work together where each one didn't work on its own? I knew that. So we ran the analysis, the exact same system on a portfolio of maybe 30 markets. And here's what we found. No surprise, the one market it worked best on was the Swiss franc. And no surprise, the single year it worked best on was the year in the example. So the author had kind of found the one market for the 1 year where this particular approach worked best. Now, if you did the approach on a diversified portfolio, if I recall correctly, I think it lost money. But the one example looked phenomenal, and this happens all the time. People write books. They'll write books on charts and technical analysis and all this stuff, and they'll show you examples of how it worked. When I did the complete guide and when I did the follow-up years later, the Schwager on Future series, I went out of my way to choose examples where things didn't work. In fact, I had a big section of the book where I took trades I was recommending as a director of futures research, and I took a whole segment of trades that I'd recommended as they were, and some were winners and some were losers. And basically I didn't cherry pick. I just took them, and I didn't try to make the winners more or losers. I was just kind of demonstrating what were the right choices, what were the wrong choices. And I went out of my way to show things that didn't work. I went out of my way to actually point out when I did classical chart analysis that these patterns, well, it's good to know them, and it's good to know how they work more often than not, or how people expect them to work, or how you could theoretically use them. But also be clear that there's lots of times that they don't work out well. And in fact, what I call the most important rule in technical analysis is actually a failure rule. It's basically that when a chart pattern fails, that is a signal in itself, and it's a more important signal than when you get a chart pattern that seems to be confirmed. So I always spent a lot of time trying to make sure that people understood that don't just take anything because this example works. Don't jump to any conclusions. You always have to test everything on a broad portfolio over a broad number of years, but almost all books, almost all articles don't do that. They just take things that work, and they allow the reader to jump to the conclusion that this thing is really the best thing invented, and when it's really not.
Yeah, I'm really glad you sort of went into that in so much detail, Jack. I think that's a really important point. But let's move this along a little bit. So I'm keen to hear a bit more about what you're working on these days. I know you're keeping busy with FundSeeder, as well as been working on some indicators with TradeShark. But let's start with FundSeeder. So give us an overview of what this is all about and how this platform is helping traders to improve.
Okay, so FundSeeder, first of all, to give credit where credit is due, I'd like to say it was my idea. It wasn't my idea. It was an idea of a colleague, Manuel Bellari, who I work with on a different project. At the time he was with ADM Investor Services, and I was actually our relationship started when I was still with Fortune Asset Management, which was a hedge fund advisory firm that got acquired. But we continued to work together, and in terms of constructing portfolios, and I was an advisor for that project. And these are portfolios of hedge funds. In any case, one day Emmanuel said to me, we were at a conference, and he said, I've had this idea, tell me what you think of it. And he was the FundSeeder concept. So his concept was, and what the FundSeeder concept is to create a website, a web meeting place that would be the intermediary between undiscovered traders, primarily undiscovered, it doesn't have to be undiscovered trader, but traders, particularly undiscovered traders, and investors looking for trading talent. And they could meet at the website, you could also think of fundseeder.com as a search engine for trading talent. So that's the basic idea, and very critically part of that idea is that you just don't try to get traders to register with your site and put them on and get their numbers and post them. A very, very essential part of this concept is that you don't get the numbers from the traders, you get the numbers directly from the broker. So traders would register on the website and link their accounts to the website. So therefore, the numbers that would be collected on the website would be numbers coming directly from the brokers. So it gives it much greater validity and sort of implicit verification in that process, vis-a-vis most sites which will just take numbers that are provided. So that was also an essential element. And to get traders to the website, the key is that you're going to provide this verified track record, and that will make it easier, much easier for traders who would have not a prayer in the world of attracting money, let alone institutional money, of being able to do so if they are trading talent. We in fact have, unbelievably, with the site still pretty early on, we're still in the early stages, but even at this point, we have literally traders registered from over 100 countries. I mean, I found that astounding. I think it's astounding enough there's traders in 100 countries, but the fact that we've already have that many different countries represented, and this is still very, very early on. We've only just recently expanded the site to go beyond the initial couple of brokers we were able to directly link with a few brokers, and now we can link with virtually all major brokers. But that just happened. So this was even before that point. So you take traders in some developing countries, let's say, or some Eastern European countries, take a trader, I don't know, anywhere, it could be in the Ukraine or whatever, who has a math degree and develops a trading system that's really good. Is he going to have any chance of raising any money, institutional money? Not a chance in the world. But if he can get a small stake together and trade it and get a track record that's coming from the broker, he can build up a track record that can then be used to attract attention. So that's the basic concept. Now, so far, we've only done the trader side of it. We had originally planned to have a trader and investor side together as one website. And for regulatory reasons, we decided to keep those separate. That we would right now, we're just in the process of building the trader side and getting attracting as many hopefully talented traders as we can worldwide to the site and building the track records and ultimately hoping to be the site people go to or that can be used to find trading talent. And at this point, there is no investor side because that's where our focus is. We will later this year construct the investor side of that as a separate site, which we will then populate with. We will use traders from the trader side as a source for the investor side. And the investor side will be through a registered company and which will have all the appropriate regulatory compliance met and so forth. So we're just taking care to do it that way. But as far as traders are concerned, while this site is not directly accessible by investors, there will be a one company that holds both sites, and if there's trading talent that shows up on the fundseeder.com, we're going to be using that site to find trading talent and hopefully in the future lead some of that trading talent or connect some of that trading talent with investors, primarily, basically, or maybe only institutional type investors looking to allocate money to undiscovered traders. Oh, and I should add one thing. The site right now, there's a current platform that allows traders to do stuff that they really can't do on most normal platforms, like get an equity curve and do analysis on an equity curve. We are, however, that was basically the first platform we're using. We currently have under development we have a technology team doing a whole completely new platform that will have literally 20 different trading tools, including all sorts of graphics and analytics that one can perform on one's trading record, both the equity and trades themselves. And will allow stuff like besides just equity charts or even underwater charts or other, will allow charts, say rolling charts of let's say rolling return charts or rolling Sharpe ratio chart, or any metric you want to choose. We'll have tools that allow traders to create use technical tools, let's say like a crossover moving average, to apply to their equity curve, so they can signal when their equity curve is starting to trend down. So they could use that as a cautionary signal to maybe take a second look at their trading, or maybe cut back trading or stop trading or whatever. So we'll have Monte Carlo simulations, on and on and on. Now that new, much more comprehensive and much better graphics website will come on stream probably sometime in the fall. If people go to fundseeder.com and register, then anytime we do anything new, like we just did when we expanded the accessibility through almost all major brokers, which was a new thing. We did that just days ago. We put out a newsletter. So if you're registered and we have the new platform, you'll be notified of that. And traders now, as I say, almost no matter who their brokers are, can probably link to the site.
Okay, excellent. I mean, that sounds like a really good platform. Definitely can see how it's going to help a lot of traders out. One thing I've got to ask is, have you been surprised and maybe pleasantly shocked with some of the results and talent that have been produced by users of the site?
Well, it's too new to answer that question because, unfortunately, track records materialize in real time, and we're tracking from when. Now, in some cases, it depends. With some brokers, like Interactive Brokers, I think when they sign up from there, the backtracker gets imported, and we do have some good traders that are evident through that. But it depends on the broker. And for a lot of brokers, there's no past record that's imported, so it just gets built in real time from the point of the registration or the account linking. In some cases, a small amount of data, but for the most part, for most traders, we really have to wait for the track records to develop. Now, I wouldn't be surprised. One of the things I do anticipate is we will find some really exceptional traders that are unknown to the world through this process by linking out on a global fashion. Like I say, once you go out, you're literally getting people from 100 plus countries. You're going to be looking at people that no one else has looked at before. And that combined with the idea that you only need a tiny, tiny fraction of all traders to be really good to have a substantial number of excellent traders. So I don't know how many traders there are. There's certainly many millions, maybe tens of millions across the world. Who knows? But you only need a tiny fraction of those, a fraction of 1% to be good, to really have a large number of good traders. So it doesn't have to be a large percentage. So I fully expect that we will have some really good traders come out of this process. And in fact, one of the things people will see if you go on the website is this thing called Market Wizard Search. What the Market Wizard Search is there's going to be some future book called Undiscovered Market Wizards, and that those undiscovered market wizards will come from traders we discover through this website. And a book ain't going to happen this year or next year. It's going to take a few years of kind of having this thing run, and but at some future point, when we feel we have, or I feel I have enough traders identified through the site who seem to have been able to perform for enough time with enough consistency, then there'll be this book called Undiscovered Market Wizards. So I'm expecting that to happen, and I would be surprised if we don't find enough traders to fill a book.
Very cool. I mean, that's definitely something to look forward to. So all the traders in that book you plan on sort of sourcing from Fundseeder?
That's the plan. That's the plan. I guess I shouldn't chime in. If I find some unknown trader in a different way, I guess I wouldn't rule out that they would go. But my primary source for this book is going to be indeed the website. That's the plan. And, if I'm wrong, there wouldn't be a book, but I really have trouble believing that I won't find at least a volume of. I'm sure I'll find more than that. I think we will have more than enough people to be able to choose, a book's worth of what I call undiscovered market wizards.
Yeah, no doubt. I'm sure you will. I'm sure you'll definitely find some. So, let's just change topics and speak a little bit about on the Trade Shark front. I'm keen to hear about the indicators you've been working on there. So, tell us a little bit about maybe what Trade Shark is and the indicators you've been working on.
So Trade Shark is a chart software company, and not just because I did a project with them, but their chart software is really very good. You can tailor your charts very precisely the way you want them. Easy, it's intuitive. It's a very, very nice chart package and lots of indicators, and including quite a number of proprietary indicators. But that's a matter of people find what works for them and so forth. So I never endorse other indicators or anything else, because even my own I wouldn't say any I don't make any guarantees about it. I can tell you what they are and all that. But so they had asked me to do this project. They wanted me to create some indicators, and they had two other people that had created, Larry Williams and I think Ralph Vince had created some proprietary indicators for them. And they asked me if I would be willing to do that. And I said, I'll tell you the truth, I'm just not an indicator person. I actually don't use indicators myself, have not used them. And while I've worked on systems, trading systems, I've done a fair amount of work on trading systems, I've really never done indicators. But I said, let me think about it. And I thought about it. What I actually ended up doing was I realized that the system work that I had done could actually be transformed into indicators. And so there was a project I had done way back, I guess it was at least over 25 years ago. And I had done it with my partner at the time, Louis Lukac, who was a real computer whiz, and he's always programmed everything I've done actually since the time we met. He's always been the fellow who's done all the footwork, all the programming, and all the hard work, And so anyway, we had developed when I was at Prudential, I had developed this in-house trading system, and we had come up with certain systems that we were putting out signals on and all of that. So the idea was to use those systems with different parameters, and those systems included both trend and some counter trend approaches. And the idea was to create indicators that were composites of those, using different inputs, combining different systems, so to speak, into a single indicator. So there's one indicator that's called the trend weight. Well, the trend weight's really a composite of different systems, and there's also an overbought, oversold indicator, which is a composite of different counter trend systems. And there's one that's directional weight, which basically adds the two together. So if the market's trending, and the trend's sort of reaches a maximum reading and stays there for a while, or is very high readings, eventually the counter trend starts to build up, and at some point if the directional weight which combines the two could come back to zero, or even reverse direction, while the trend is still looks like it's running. So that's a third tool, and then there's something called a dual trend, which basically takes a trend weight and combines it with one of Trade Shark's own indicators, which is a much shorter term indicator. So my stuff tends to be more. The indicators are really, and I did a set of videos. The videos are available for free at tradeshark.com. You could find them. You could find the indicators. There's not the indicators, the videos. So the videos are for free, and you can look at them. So this is all explained. So there's one on each approach. And there's one called the dual trend, where the dual trend takes the trend weight, which is intended to capture long-term trends in the market. That's what it does really well. It's good at staying with trends and all that. It has defects of any trend approach, which if you get a very choppy market, it is going to lose money. But on balance, over the years, the reason I took something for 25 years old, so we could test it for the past 25 years. I wanted to make sure that in the interim, it was something that had a significant edge in working versus, so that I could make at least confidently say that based upon 25 years plus empirical evidence, there's a much better chance going with it than against it. So it was important to be able to test something like that blind. That's why I wanted to use something that was developed a long time ago. In any case, that is combined with trade charts, another trade charting indicator, which is much shorter term, and that's called the dual trend. And I kind of like that because they're so different, and that the dual trend will change much more quickly. But it also won't be anywhere near as good in riding trends. And combining the two has nice properties. So that's a fourth approach. So there are these approaches. They're explained by the videos. They're more inclined towards a systematic approach to markets. And I also arranged them. One of the key things I did was to have them each have inputs that needed to be defined. So there's not just one fixed way to use it. You have to define a threshold conditions for each of these indicators. And there's also, you can choose something like an early exit, an early reversal, which are explained. And by doing that, you can turn these indicators into your own sort of approach, which is very important because I don't want to go counter to my own advice. I always tell people, don't just get a trading system and follow it. Don't buy somebody else's trading system and follow it, because the odds are you're not going to last, because as soon as it has a bad period, and every system has a bad period, you're going to abandon it because it's not yours. So I made these so that they can be combined, they can be used together, they can be used, you can vary each one. And so two different users can develop completely different signals off of the same indicators. And that was critical because one of the essential points is that users need to make these, to choose the parameters that go with these approaches so that they fit the way they are comfortable trading the markets. And when you do anything, one thing that's good about TradeShark is that you could actually see, like you could do stuff, which I do in the videos, is like anytime there's a buy signal, it's shaded green. Anytime there's a sell signal, it's shaded red. And it's neutral, it's, let's say, yellow as an example. Well, you can superimpose that on the price chart as a lightly shaded backgrounds, and you can pull in the data, let's say, the last 10 years, and then you can walk through 10 years of data using this particular approach and see exactly how the market did. It's not fitting it to what it did. You could see, had you done this 10 years ago, and theoretically you could have done this 10 years ago, again, because it's based upon stuff that was developed 25 years ago, how it would have performed in a real sense. And so users can get a real sense of what one particular adaptation of these indicators would actually work, and can experiment and see very visually where the buys and sells are coming in.
Yeah, yeah, good one. Well, I'll put a link to those videos in the show notes for this interview. And if you want to access the show notes, just go to chatwithtraders.com/27, and the links will be underneath the interview. But I mean, Jack, we should probably start to wrap things up because we've been going on for a little while now. But before we do this, one last question, and I'm sure you have a ton of great quotes and one-liners which you've picked up over the years, and it wouldn't be right to ask you what's your favorite, but is there just one or two quotes that you would like to leave us with before we wrap things up?
Okay, that's an interesting question. Okay, I'll give you two quotes. I'll give you one quote from one of the people I interviewed, and I'll give you one quote that's my own. Interview from the people I interviewed, and this is the quote. This is what I tell people. If someone said to me, Jack, we want you to give your best trading advice. We only got there's one kind of condition or constraint here. You can only use 10 words. So if I can only give advice in 10 words, right? And this is the quote I would use. And it's a quote from Bruce Kovner. And the quote is, know where you're getting out before you get in. The quote that I would use, and I guess I should just explain why that's so important. Well, for one thing, it sort of guarantees risk management. And for the other thing is, it's much more subtle. And that subtlety is you're making a decision of where to get out of a trade before you get in, means that you can make that decision with the benefit of complete objectivity. Anybody who's been a trader will know that once you're in a position, you lose objectivity. So most people, almost everyone, will get into a position and worry about getting out at some later point. But once they're in a position, your thinking gets clouded. If you can decide that ahead of time, as Bruce Kovner suggests, then you're thinking from a much more objective and, I believe, a potentially successful frame of reference. As far as my quoting myself, there's a line I have, I'm sort of paraphrasing it, and it goes to this idea of finding your own approach to market. And the line is, there's a million ways to make money in the markets. Unfortunately, they're all very difficult to find, but there are a million ways. And the point is, don't worry about finding the one way. There are lots of different ways, but they're hard to find, but there are lots of ways. And only a very, very small number of types of ways are going to be right for you.
Yeah, both extremely great quotes, Jack. Thanks so much for sharing those, and thank you so much for coming on the show.
I appreciate that. You really did your homework on those questions, and you did a really extremely. I've done quite a number of interviews over the years, and you did a really good job on touching on a lot of different subjects, and clearly doing your homework. I appreciate that from your side, and I think the one drawback is that I think this podcast could end up so long that maybe you have to break it into two parts. I don't know, but whatever.
Yeah, no, that's great. But before and thank you very much for that. I appreciate your feedback there. Before you go, do you want to share with listeners where they can go to find out more about you and stay in touch with what you're up to?
Right. Okay. So, again, the main site that the company that I'm involved in is fundseeder.com. I also have Jack Schwager, my name.com, which I no longer update, but there's stuff up there. There's stuff up there, interviews and articles and links to books and stuff like that. But the other site is fundseeder.com. So those are the two sites I would direct people to.
Okay, good one. Well, I'll put links to everything we've mentioned during the interview, so your books. You're also on Twitter, aren't you? So we'll put your Twitter handle in the show notes. Yep, cool. And links to Fundseeder, TradeShark, and everything that's been mentioned. Just go to chatwithtraders.com/27 and you'll find everything there in the show notes. Again, Jack, thanks a lot for doing this. Take care and let's talk soon.
Oh, it was fun doing. Okay. Have a good one, Aaron.
Thanks, Jack.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up everybody? Welcome back to a brand new episode of the Chat with Traders podcast. This is episode number 28. And before we go any further, let me just say a huge thank you to everybody who listened, tweeted, shared last week's interview with Jack Schwager. I was thrilled to have him on the show, and it sounds like you guys all really enjoyed it. So thanks so much for listening. Now, let me tell you a little bit about this week's guest. And he originally was attracted by the fact that traders can make money in both rising and falling markets. So this week's guest, Andrew Foldy, left a career in commercial real estate when the GFC hit in 2008 to focus his attention on becoming a trader. A few years on, Andrew has carved a profitable niche for himself, trading options and designing systems, both topics which are covered in depth during this interview. But some of the highlights from this discussion would have to be the way in which Andrew avoids trying to predict the market and instead thinks of trades as a series of if-then scenarios. Also, the purpose of why the options market even exists is really interesting, as well as the important factors one should consider when designing a system. I also like how Andrew applies a blend of systematic and discretionary aspects to his own trading, which we go into during this interview also. And if you have any questions, so if there's something you're challenged with or something you want to know more about, then take this opportunity to ask Andrew a question. Whether it's in regards to trading options, designing systems, or just trading in general, Andrew's your man. So leave a question for him in the comments at chatwithtraders.com/28. Just scroll to the bottom of the page and leave a comment and Andrew will get back to you. All right, guys, I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Andrew Foldy. Andrew, welcome to the podcast, man. How's it going?
Doing great. Thanks for having me on.
No, thanks a lot for coming on the show. I mean, I really appreciate it. And there's a few things I'd like to cover with you today. So, of course, we'll begin with how you got into the world of trading and what your early experiences were like. But from there, we'll get into some discussion about options and sort of systematic trading. And seeing as you're very clued up on options, where as I'm almost a complete novice in this area when it comes to options, but I mean, listeners will probably recall me saying that from previous episodes, but feel free to add to your answers with anything that may be valuable, even if I don't necessarily prompt you with my questions. So,
okay, sure.
Yeah,
I can do
like
that.
a plan?
Yeah, sounds great.
All right, cool. So let's start from the start. And if you don't mind, share with us, what were you doing before you got into trading? And then what actually sparked your interest in the markets?
Well, before I became a trader, I was a full-time commercial real estate broker in Florida. And when I was kind of developing my career there and I was working on teams, and through unfortunate timing, my career was just starting to grow when the Great Recession hit. And Florida specifically was kind of the epicenter for the real estate crisis, where a lot of the United States real estate values dropped 10, 15, 20%. And in the area where I live, things dropped by closer to 50 and 60%. And so our local market went to more of a depression, whereas the rest of the country went into a recession. And at that time, it was challenging, and it looked like it was going to be very difficult for several years. And one of my mentors that I've known ever since I was a teenager, he also had a lot of commercial real estate holdings, and we were involved in the business together, and we were discussing it, and he had some investments with a hedge fund that was trading options, and they were doing very well. And so we said, well, this is great. The market's going down, and they're profitable. It just was totally counterintuitive. We did not understand how that was working. How are these guys trading options, which is part of the stock market? They're trading S&P 500 options, and the market's crashing, and everything's bad, and the economy's going in the toilet, and these guys are making money, and they were making a lot of money. And we're like, we have to figure out what's going on. We have to know what's happening. And so we both kind of parallel went into this education process of kind of self-teaching and exploring what was going on. And so that was back in 2007, 2008. And we're going through that process and a lot of studying. And one thing led to another that I just decided that I didn't want to tie myself to a local economy. I didn't want to tie myself to one industry and one sector, and that by trading the markets, I was going to have the ability to be in any market that I wanted to be in and anywhere in the world, and I could do it from anywhere in the world, and that I could actually profit like these guys, whether the market went up or down. And I said, that's the path I need. I need to be on that path. I need to have that opportunity where I'm not dependent on a strong economy. I'm not dependent on economic growth for how I'm going to do each year. So that's kind of what spurred everything and how I became attracted to the trading world. And then one thing led to another, and just through my natural instinct to network and work with traders and work with business contacts and really just get out there and not just live in a bubble. I got to know a lot of great people and got connected with SMB Capital in New York, and really was able to expand and get my trading up and running and go full time. That's kind of the background.
Right. Yeah, that's a really good answer. So let's get into that sort of education process, which you briefly touched on there. What was that like? Like, what was the process you went through, and what was that education that you were sort of absorbing right at the very beginning there?
Right. Everybody starts probably in a similar place where they're gonna absorb all the free information that's available. So there was lots of hours on YouTube and lots of time on blogs and social media and trying to find videos, and then you go buy the stack of books from Amazon and you get them and you start reading all of them, and that kind of orients you to what's going on in the lingo. But it really the unfortunate part of that is it can lead you down a challenging path, because you may start to learn the language of trading. You understand the concepts of what the different tools are and what the different instruments are, and maybe they talk about strategy, but they don't tell you what to do. They don't guide you, either from liability, or they just don't know what they're doing and they just know how to explain the market. They might just be a financial publisher and not really a trader. And so you don't really get the tool. You understand about it, but you don't understand what to do or how to do it. So it was kind of like a struggle. There's a lot of excitement about the possibilities, and but really just not having any guidance made it kind of challenging. And then little by little, I realized, and then the other traders I work with realized this even quicker than me, is you have to, if you really want the best information, best education, and you want to accelerate your knowledge, accelerate the growth of understanding and your personal growth, you got to hire people. You have to hire the experts to teach you. And so we went down that path, and many tens of thousands of dollars later of educating ourselves, that's really what it took. It really took that for us and it's, some people say, and I've heard this by educators that I've worked with and respect very much because I know they're excellent traders and they also teach, is when they tell somebody about trading and they give them a strategy and they tell them what not to do and give them guidance on what they should be focusing on. If they give that away for free, the person never follows through. And they could charge $1,000 for the same conversation, and the person that pays $1,000 is going to pay attention, they're going to take notes, and they're going to hold themselves accountable for a period of time because they put money on the line that they're going to take that knowledge and apply it. So that's what happened for us. We spent lots of money, different service providers, and the best education I've ever received was through SMB training, and that's why I stuck with them and really started to develop a relationship there so that I could take that information and kind of help share it with other people and help other people learn the way I did. Hopefully the right way, not spending too much time, trying to consume free information and think that's going to help them grow their trading business.
Yeah, sure. I mean, I have actually heard that in the past, that when you do pay for something, you do tend to, in most cases, pay more attention to it and actually benefit from it more so. I mean, that's probably like a, marketer's favorite phrase as well, but it does actually, it genuinely holds weight in most cases. So that's a good point that you brought up. And you also spoke about, in your answer there, about he spent tens of thousands of dollars on education. I mean, surely no one actually wants to pay that much. In hindsight, how could you have maybe not spent so much on education? Like, how could you have...
I'd say, I could probably go through and pick out 20,000 of that we could have skipped, in hindsight. But you don't know which thousands of dollars and which courses and what instructors and what online programs. In hindsight, we know that some of those, it probably gave us more of the tools and taught us about the market in a way. And by having the cost involved, we really had to absorb it. And that helped us probably at some level. But the parts that mattered, it's probably $3,000 or $4,000 worth of education after knowing the basics that really gave the tools that hard and fast, here's your training wheels. Just follow these guidelines, do exactly these steps from day to day. And, most people's personality, most traders' personalities aren't going to be able to live, following a very specific set of rules from day to day, but by starting that way, by doing it that way and letting a system work, you can realize that it's not about your intuition in the market. It really is about strategy. It's really about using things, doing things that make sense, doing things that work. And it's not about your ability to predict. Once you get past that and you stop thinking that the only way you're going to deserve a profit is by predicting, then that kind of frees you of that responsibility, and you know that you can just apply things that work in the right circumstances. So that's probably, tens of thousands is not I'm not going to say that's what it takes. That's not true at all. But I think it does take a few $1,000s of education to at least accelerate your process. Take somebody else's 10 years of experience and pain of developing how it works and let them teach you in a few hours. Let them show you or let them mentor you over a couple of months and just shortcut all of the trial and error and get to what works. Generate profits from it and then go from there and start developing your own ideas. But just trial and error alone that's how it becomes, you're going to be going against the odds for your success. Because most people aren't willing to pay for somebody to help them. Most people think you have to predict what the market's going to do to have a profit, and that's just simply not the case.
Sure. Okay, so even for you in the sort of the first few years of your journey, if you had to put it down to maybe one or two things, what would you say were the biggest challenges that you had to push through when you were coming up? So challenges that essentially impacted your P&L in a negative way.
Right. So thinking I have to predict is where it stems from. And then the second part of that is when you're wrong, then you have no plan. Because you say, well, I made the prediction. And I really feel in looking back at the early struggles, I really feel like I thought that if I didn't predict it right, I didn't deserve to change my mind and then, stop losing money. Like I had to take that pain from being wrong, and I had to wait until the market agreed with me to get out of the position. And that was probably the worst and most stressful times where I went through a few different mouses where they'd get smashed and I have to go get another one and all that stuff. But now knowing that it has nothing to do with predicting, and I don't have to feel like I earned a profit by guessing what was going to happen correctly, that now it's more about adapting to what's going on and knowing the two different probabilities in every market, which is the trend and the range. If the trend is identified, then you can expect continuation in that trend. However, you have to respect the range as well. So if you're a little bit overbought in a bullish trend, you can't just say I have to be bullish because it's bullish. You can either be flat or a little bit less long or maybe even a tiny bit short if you want. But really getting past thinking, well, we're overbought, the market has to go down, and that's the only way I'm going to make a profit this week. That there's a lot more ways to do that. So I want to make sure I answer the question fully. Early struggles, is that kind of what we're getting at?
Absolutely, yeah.
Challenges. So thinking I had to predict, not being willing to admit when I was wrong and get in the right direction again. Poor strategies, the wrong strategies on the wrong instruments. That's a big one. So frequently managed income trading styles on low-priced ETFs, that's just a recipe for disaster. So, if you have an iron condor or butterfly management strategy and you trade that on an ETF and you hear people talk about fixing and adjusting and managing their profiles, you say, okay, I get it. I'm going to use ETFs and I'm going to use an income strategy. I'm going to manage it frequently to make sure I keep it under control and wait till I trap the market. Well, you got two things right and one thing wrong. And the one thing wrong is you're using it on the wrong instrument, which means your commissions are going to be 1,000% more, give or take, whatever the exact number is. But you're spending 10 times as much on commissions for frequent management, which means you're running uphill with the wind in your face because you have to overcome very expensive commissions on that strategy. Whereas the same strategy on an index option has a better chance because your commissions are less. Or contrarian trading without risk management. That's, it's a, public, your show's heard by a lot of people, so I won't mention any names, but receiving guidance from people that were really more in the entertainment business than the trading business, that just expressing their opinions all the time and saying, I have the experience, I've done this for so long, and the market has to go down. And so it's just be short. That's it. That's the whole strategy. Is just be short because the market has to go down. And when it doesn't go down, they're silent. They have nothing, no more guidance for you. And you're left to say, well, what am I supposed to do? And if you don't have the right strategy and you don't have somebody that is showing you whether or not they were even in that position, then you're left on your own. Now you're out there with, frustrated and you're waiting until you're right. So, being in the right strategies, having people that are actually showing you that they're doing what they're saying they think is going to happen, and giving you guidance as far as day to day, how to get out of it and what to do if things don't go the way they think. The best traders I know, they aren't. I'm not saying they're the best traders in the world, but the best traders that I know at SMB, none of them think that they are going to be right. That's just it. That's all there is to it. They have an idea and they have a belief that they are skilled and have a good knowledge of the markets and that they're going to be right more than half the time. And really, it's going to be a number quite bigger than half of the time. But it's still, when they're wrong, they know I'm wrong. I'm done. I'm out of that one. And it doesn't mean I'm flipping my position. It means I'm wrong and I'm done. I'm out of that one. And you keep the loss small and you move on to the next one where when you're right, you can have the big win. So it's just some of those kind of psychological things and strategic things where there's so many ways to approach the market that if you just have the wrong combination, you're going to be struggling. So just having the right combination of strategies and psychology to make sure that you have the ability to control your losses when you're wrong and have the good sized wins when you're right.
Sure. Okay. No, that's a really great answer, Andrew. And something I'd like to go into a little bit deeper on what you mentioned there And it comes up now and then as why you shouldn't predict, you shouldn't try and predict the market. But I mean, no one knows what the next one or X number of bars on the right-hand side of their chart are going to be. So what do you mean by you shouldn't try to predict? Because obviously when you execute an order, you're either anticipating that it's going to go up or it's going to go down, and hopefully in your favor, either direction. Could you just expand on that, the reasoning on and the mindset of predicting?
Sure. If it feel, and this is going to get into just semantics, but hopefully that by going through that, maybe the psychology will come through. If you feel like you are constantly predicting, or if it sounds like predicting, like the market's currently wrong and it has to do this, or this announcement's going to come out and this is what's going to happen, and you basically position yourself with one scenario. If I'm right, I'll be profitable. If I'm wrong, I will lose. If that's the case, then you're going to, especially, and some people don't even go as far to say if I'm wrong, because they just don't think it's possible. They say there's just no logical way that I'm wrong about this, and this is what has to happen, and I have to be in that direction because it's the only thing that makes sense, and they go for it. And if it doesn't work out, it's like their world falls apart, and they don't they freeze. It doesn't make any sense why it didn't happen the way they thought. Then they have no plan of what to do after that. Now we'll go into the part where you're saying you do have to have some kind of bias. You do have to make some kind of assumption about what's going to happen. Well, in options trading, you don't have to make that distinction. You literally can have no directional opinion in options trading and go from that point. Your only opinion may be whether or not volatility will expand or contract in the short term. But even that is not going to be, that's only going to impact in the short term, but not the trade itself. So that's one way that you can remove predictions. And I found that options traders that find good guidance and have discipline have a higher probability of success than directional traders. And that's just from my own personal experience. I don't have some kind of deep, 1,000 person survey to prove that or anything. But my observation and working with a lot of traders and seeing the success rate with the types of traders and seeing traders that failed at directional trading and then learned about non-directional options trading, that they have number one, they have a great chance that they will stop losing money if they have good guidance on the types of strategies and instruments to trade. And then secondly, they have an increased chance of generating some type of positive results by using a systematic non-directional options trade and with the right management strategies. And that's not saying that they're going to make money every month, but if they stick with it for 6 months, in most market conditions, they're going to come out ahead by following those strategies. And they're not going to be home runs, and you're not going to, triple your account this year, but you can make decent income on a decent sized account. So now I'm going to finish the thought process by saying, now when you do a directional trader, where does that leave them? They are a directional trader, and I said that they can't predict, but they have to have an assumption. The psychology that I would encourage, rather than feeling like a prediction, I would rather have a series of if-then scenarios and several of them. So I would say, if we trade back to this level, then I would consider that a great long opportunity because it would be a dip in the direction of the trend. Just very simple if-then scenario. If we were to have a dip in the direction of the trend to this level, I think the risk reward would be favorable for a directional trade back to the top of the range or to a new breakout, and then I would close it when everybody else is buying the breakout. So that's my if-then scenario. Say, well, I don't have to that's not the only way I could make profits on that instrument. I could have a second if-then scenario. If we don't pull back and we break out and we hold, then I can buy a held bid above that level, or if we consolidate above that level for 5 or 6 bars and the bars are getting smaller, then I would also consider that a long opportunity. I don't need the market to come down to my level. I can take advantage of it another way. And I've eliminated predicting what is going to happen. I've given myself 2 ways to profit. I can say if that first one happens and I buy it and then it breaks the level that I thought was going to hold, now I can have a whole nother series of if-then scenarios. If it holds below that and consolidates, now it's a short opportunity. If it trades back above and consolidates, it's a long opportunity. If it trades back above and takes off, I'm going to skip it. It's not trading in a way that I want to trade, and I'm just going to go on to something else. Those are a number of scenarios where you say, in this scenario, I'm going to have a small loss. In this scenario, I might change my mind and go the other direction. In this scenario, I have a lower probability trade, but I might be able to hold it longer. And you give yourself a number of ways to be in that without needing to say, get in some chat room or get on Twitter and say, XYZ is going to drop 50 cents and I'm going to buy it and it's going to make a new high. And now, because you've made some public proclamation, you feel like that has to happen for you to have any dignity in the world. Rather than that, just say, here's some if-then scenarios. If it gets here, I would try this. And it's a more humble attitude. It's a more adaptive attitude. And you don't feel like you have your pride tied up in what happens next in that stock or ETF or index or anything else.
Yeah, that's really good. I like the idea of the if-then scenario. That's definitely a way to overcome that predicting kind of mindset for sure. And just before we get into a few more of the specifics about how you trade these days, I'd just like to ask you, from the point you started to the point where you reached some sort of level of consistent profitability, what sort of time frame was that period?
There was probably a year and a half that was heavy bleeding and painful and stressful. And then probably a 6-month period of kind of turning away from that. And then, what year is it now? 7 years. So, and then after that, just kind of slowly, and it's been a progressively steeper incline from that. So call it a year and a half of kind of poor results and non-results. And then until I was moving into something that was more sustainable. And then now at this point where, achieving levels as an active trader that you don't hear about in the news and from hedge funds and things like that, just because it's more active and for smaller accounts than these big institutions.
Sure. Okay. No, that's really good. And during that time, the first 18 months, how active were you trading and how intensively were you studying?
My study was off the charts. Every waking moment that I had, I was reading and studying and back testing and creating charts and creating studies, just going through and watching webinars and reading books and reading information. It really was, 6 a.m. to midnight every day. It was like, that's all I lived and breathed was the markets. And that's just what I felt like I had to do. And I learned a lot in that process, but I was also not consuming the correct information. So I had information overload from bad sources. So from all of that free information that was out there from entertainers rather than, traders that were actually trading professionally and getting real results and sharing their results that they were getting. I don't think that's the process everybody should go through. I think I worked too hard and looked in all the wrong places, and was looking for people that were going to show me how to predict the market or depending on them to predict it and feeling like I could follow blindly along with them. That just, none of that worked out very well. The study was very intensive and the activity was pretty active, probably 5 to 15 trades a day, sometimes more than that, which would have been a bad thing because I would not have been trading strategically. So moderate amount of trading. I wasn't trying to scalp or day trade or find the hot stock of the day or anything like that. I was just probably over managing options trades in the wrong instruments. The commissions were through the roof, really eating into any chance I would have had of making profit, even if I knew what I was doing. All those mistakes, that's kind of what it looked like. So while I was working hard and feeling like the harder I worked, the worse it got. And so at some point I kind of backed off and said, I'm looking around, and as I was getting into the SMB world, and I started seeing these traders that had full-time careers and were basically bought 3 courses and learned for a few months, that they got to the point of profitability. I said, well, what's going on here? These guys, they trade like 3 times a week, and they're doing well. I don't understand this. So that's when I kind of adapted that mentality and got into a little bit calmer state and learning how to trade that way, and it was doing well.
Okay, sure. And just real quick before we move on, while you're studying from like, say, 6 a.m. till midnight most days, you obviously didn't have a job during that period. So what were you doing for an income?
So that was with the group. I was doing some other consulting, and because my background is marketing, so I would do marketing consulting. I did some real estate consulting, and I had some real estate deals that were left over from the brokerage company, that because commercial real estate deals specifically, a lot of them take 6 months, 18 months to happen. So I had a lot of deals that were kind of pending that I still had a commission coming on. So those checks were coming on occasion. So it was enough. It was pretty thin, though. There wasn't really a lot of income, and there was more nights where I was buying ramen noodles and keeping things nice and easy. But thankfully, those days are behind, at least for now. I'm thankful for it, but it's not like that anymore. But I think more importantly, I'm grateful for. I don't even care about what a little extra money coming in does. Mike Bellafiore says he talks to young traders and developing traders and says, what do you think the greatest part of trading is? Why do you think we do this? And they say, the money. And they try to come up with like a deeper answer because they know that's what he's getting at. So like financial freedom and taking care of your family and things like that. He's like, yes, all of that's good. All of that's great. But you could do that anything. You could go out and get a master's degree and be an engineer and do something else. You could get all of that in some other job and industry. So why is it trading though? Why is it trading? And like, it's freedom and you can make more money and this and that. And Mike, he lets them go on and give all their answers, and he's very consistent in his responses. This is something where it's very challenging and most people don't make it. So when you can achieve and you can get to that point where you say, I went through the rigors and I went through that process and the learning process, and now I can actually do it. And there's that achievement level. It's more of an analogy for a professional athlete that has to work hard to get to a certain level. And, some people call it, you can almost call it like the gamification or the sport of it. That's the part that I'm really enjoying right now, is that confidence. That's something I used to look at and have no clue and used to kind of pound back on me and was challenging. Now I can navigate it from day to day and actually feel like I'm on the right side of things. And it took a long time to get there, but I really enjoy that.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, Andrew, so let's move along a little bit and shift into some discussion about more about the way in which you trade nowadays. So how would you define your trading method?
The core positions that I'm in are income oriented, and income some kind of has a connotation that it's lower returns, and it can be. You're definitely not going to hit big home runs, but it's definitely better than typical investment returns. But income oriented, market neutral trading of options on the indexes. So that is the core position. Probably, just going to think about the numbers and try to do quick math in my head. Probably 80% of the portfolio is in that style of trading, and then the rest is semi-directional. Still has an income approach. Often, probably 90 to 95% of my trades are options, a combination of buying and selling, net short, net long, mostly short options, and then a little bit of futures trading for hedging and for opportunistic swing trades, and a little bit of just more recently in the last few months actually been diving deeper into the SMB equities programs. They have a program now called Trader 90 that's where they have all their tools combined, multiple meetings throughout the day talking about equity directional setups. So I've been getting into more of that since the income trading is going well and want to diversify further. But with the income trading, that's oriented to selling market premium in the options market. You have the edge of time decay, which is the one component to options trading that kind of allows you to trade with the wind at your back. If you believe in trend following, you can believe in the trend following of premium decay, which is that it's a constant in the market, and then you just have to mitigate the other risks in that trading. And that's where I orient a lot of my trading to, and that is a probably a steeper learning curve to understand initially, but ultimately when you get through that, a little bit longer learning curve of how those different aspects work together. Options trading is very much 3 and 4 dimensional rather than directional trading, which is 2 dimensional. You can always call it 3 dimensional. You have up, down, and then over time. With options trading, you have volatility and implied volatility considerations and different Greek measurements and things like that. But once you get through that learning curve, then options allows you to have a higher probability of success as you trade from day to day and month to month. So that is basically the style I'm in. I do sell a lot of weekly premium. That took a long time to master because it is a very volatile market. So I do not recommend you hop 2 feet first into the weekly options market without a lot of experience in trading, probably starting with monthlies. Prefer liquid instruments that I can manage actively, but making sure I get enough premium. So there's a lot of criteria involved in making sure you find the right opportunities in the weekly selling market. With individual stocks, I buy options because they are a little bit more erratic and can move faster and further than an index. So I like to buy weeklies on individual stocks based on the defined trend, pullbacks in the trend, consolidations within a trend, things like that. So that's kind of the mix that I have going on right now, but mostly that monthly contracts, index, options trading right now.
Okay, sure. So, if you could, for those who might have no idea about the income aspect of options trading, how would you sort of just describe that and just explain that to someone?
It's good timing you asked me that, because just earlier today I was talking to Seth and then a gentleman, Mike Eisner at SMB. We had a conference call and we were discussing that exact topic, because we want to bring some of our newer options programs that are really based on I'm going to call them simple strategies, and it's not because they have a lower probability of success or any other factor that makes them less attractive. They're just simple to understand. And we were just discussing on how do you describe this to somebody that doesn't know the options market. And the idea is there's the options market is an insurance market. If you look at the fundamentals of it, and I'll just describe it also by paralleling the futures market. The futures market is originally designed, and the purpose of it is for hedging. So if you own a bunch of stocks and you want to short-term lock in the price of those stocks, but you don't want to, say you have a basket of 100 stocks, and they're all different places, and let's say this is back in the old days when they were actually stock certificates, and it was a big to-do to go figure out how to sell all your stock because you thought the market was due for a correction, it was crashing, maybe it was up a lot, so you want to hedge. Whatever that circumstance is, the process of selling was so cumbersome that it was easier to go to the futures market and sell a few futures contracts and have a synthetic hedge. You synthetically reduce your exposure to directional conditions in the market. The options market comes a step further and uses a variety of contracts, calls and puts, that you can buy or sell, and then combinations of those. And it basically creates that same hedging opportunity. You can sell calls, which would limit your upside, but it says if the stock or index rises above this price at or before expiration, then I would have the obligation to dispose of this asset at that price to the person that bought the call from me. And then if you buy the put, or if you sell a put, if the market drops below the put contract at or before expiration, then you could be under the obligation to buy the stock or asset at that price from the person that bought the put from you. So, and then you can be on the other end, you can buy. So you'd have the right to execute that contract, but you wouldn't be obligated to do that. So once you get past, that's where the learning curve is. You have to get all of these contracts and long and short puts and calls, premium, buying premium versus selling premium. Once you get through all that, the simpler analogy is it's just like an insurance company. There's the insurer and then there's the insured. The insurance company is selling insurance premium. They are the ones taking on an outsized risk for something that is not necessarily likely to happen. And they do it in the right amount of size, and they do it in a diversified way that they have an edge and they have a good business model. And in fact, as the insurance buyer, you hope they do. You hope they have the capability to fulfill their obligations because you need to be protected in your specific circumstance. So maybe a trader, maybe a highly leveraged investor can own a lot of shares of certain companies that they feel strongly about fundamentally on the long side. However, earnings announcements are coming up, or there's just maybe they have a nice profits kind of run away from the mean in their favor, and they want to defend the position, but fundamentally they have no reason to sell it. So they can go to the options market and buy puts. And they can put a floor on how much risk they have. And that floor is not a stop loss. The stop loss, if it touches that price, you're out. It's done. Your stock is taken away from you. The position is closed, and if it immediately spikes back up in your direction, you're out of the position. You've lost it. So your way of defining risk is a limited opportunity, because if it touches that point any time while the trade is open, you're out of the stock. But if you buy a put, you can own the right to sell it at that price, but you don't have to sell it at that price until expiration. And at expiration, you can either exercise your right, or you can roll the contract, meaning you close that month because it's expiring and you go buy and put in a different month. and that's a way to defend your position without using a stop loss. And it's very common to do that because it adds a little more flexibility. Now, all the benefits of that, the other side of the coin is that happens at a premium. You have to pay a premium value. When you study it, it's called extrinsic value. It's called options premium. In that, it's just like insurance premium. You have to pay for the right to be covered. And so you pay that extra value. So if you don't use it, that premium goes away. It goes to zero at expiration. So if you buy a 1 month put, it expires a month from now, and you pay $1 per share for that put for a $150 stock, you're going to lose 0.75% on that stock value to defend that position. But if it drops 20% overnight, you're going to lock in, you're going to minimize, and you're going to reduce your exposure. Say the put you bought was 5% below the stock price, and it opens up down 20%. You are capped. You do not lose more than 5% plus the cost of the put. So you would lose 5.75% instead of 20%. And that's the purpose of the options market. Now, if you go in and you are an options seller and you know how to combine various options positions and hedge those, you can actually bet in both directions of the market at the same time, and you have the middle of that position, which is premium decay in both directions, where you either own puts and sell more premium below it, or you can sell calls and sell puts. That increases your odds because usually an options buyer is going to buy in one direction or the other. But if you bought in both directions, you'd be over-insuring, statistically speaking. So you'd have too much premium paid. Well, if you go as a seller, you want to sell too much. You want to sell more than is probably going to be needed to insure those positions. And then you use other management techniques, management from day to day. You can look at your risk and make adjustments when things are changing, or if volatility gets to a certain level, you reduce your exposure. There's a lot of management techniques beyond that. And you can see that from there, it's entirely different. It's a completely different market than stock trading, where you just have a variety of setups that have a probability of either going up or going down. And then that's your directional exposure. It's a very 50-50. When you look over 1,000 trades and 1,000 traders, it's a 50-50 game. Whereas a trader with excellent experience and guidance and using a good system or good strategy is going to be better than 50%. An options trader can pretty much day one with a good system can become 60 or 70% profitable. And they can use management techniques that keep their risk reward very favorable as well. But you have to get through that learning curve of how the options market works. And without the proper learning curve, you have a lot going against you, because there is an outsized risk involved in the options market that the brokers, the market allows you to take amounts of risk that they would not allow you to take on a pure stock trade. So that's a risk that has to be understood and has to be studied very well, or else you could be walking into a lot of pain in the options market.
Okay, that's excellent, Andrew. Thanks for really expanding on that. That's excellent. So while options are, of course, your weapon of choice, the way in which you trade options, I believe, is fairly systematic. So if you could describe to us, what extent is your approach systematic, and are there still any discretionary aspects to this?
I worked for a very long time to develop systems through a combination of underlying market statistics and signals for both the trend as well as mean reversion. And then I also did a lot of systematic study of option strategies, so different management techniques, selling different strikes with different times expiration, different frequency of management, different ways of looking at directional risk and hedging that from day to day. And my first experience with SMB was as a student And I was actually taking a course. I'm going to call it a course, but at the time I took it was not a course. It was actually, I asked them, I called up and I talked to Steve Spencer, co-founder, and I said, is anybody there? Could they train me on developing trading algorithms? And he said, let me get back with you. So, and then he got back with me and said, we have an algorithm trader here. He develops systems, and he is developing systems and signals and indicators for the firm, and he would be willing to do a training. So I actually went up to SMB, and this is part of where my, that adding up to my, a little bit more expensive learning experience than most traders go through. But I think it was 10 days I actually spent there the first time on the desk working with Rick Martin, their algorithm and systems trader and trading developer. And that's where I started to learn a lot about the systematic approaches, very rule-based, combining a lot of the tools that you see. So if you see an indicator and you see a system, you can actually just take all of that information and combine it into one set of rules and automate a backtest, automate a report that would tell you how well that would do and what the statistics behind it were. And there are some very excellent algorithms and systems out there. To me, there's a lot of systems that you can develop a backtest that has extremely great results, high probabilities of the historic trades working out, excellent equity curves, low drawdowns, big run-ups, doing very well. But when you dig down and you either randomize the information or you move it into the forward market, a lot of those systems break down and don't work. So as far as high probability trading, to be able to develop a fully automated directional system, to me it's just not my psychology. I spent a lot of time working on that, and I got a lot of benefits from it that I'll talk about in a second. But just as far as the study of it and applying it, to answer your question, do I use discretion? Discretion is a huge part of my execution trading and my trading decisions. I use systems to guide what I look at. I get signals and alerts on things that are worth trading for a variety of reasons, either pullbacks in the direction of the trend, liquidity, relative implied volatility, things like that, relative strength to the market, a lot of those things, general trendiness signals, consolidation signals on all instruments that I really like that work well and continue from back testing statistics all the way into taking those signals as a discretionary trade, seeing that the wind is really at my back. The trades get easier, the profits are more easy. I don't have to wonder about what's going to happen in the trade. I just know I have a good probability. I put the trade on. I have a reason to exit. I have a reason to take profit, and that's it. So on systems, I believe that studying systematic trading is very valuable. It's actually very valuable for an investor, somebody that's looking for much longer term holds using a systematic approach. Maybe it could even be a fundamental way of looking at the market and picking a portfolio. There's still a systematic way that Rick taught me, and then together, actually, a couple years later, we then developed a course together to kind of formalize that experience that I went through, which was kind of off the cuff, scheduled. He designed it. We got together and we had a 10-day one-on-one experience to study and learn all of this. And I got to absorb his decades of experience on Wall Street and in Chicago and absorb all that information, process it, stay in communication, develop a lot of systems, did a lot of correspondence and work together, phone calls, went back and visited. And then ultimately it came down to saying, let's formalize this, make it a more of a video series that's a little easier to intake, more affordable because it's recorded. So we put that together. And in that, we actually, in that course, we had a couple-minute period that we talked about what we call the 7 steps to system success, which is whether it's a discretionary, really you can use it to analyze your own discretionary trading is one thing you can do with it. So you're basically analyzing yourself as the system, or you can analyze an indicator. You can analyze a management technique, a filtering system. Say if a filter generates that this is a stock we're trading for the day, and you can just see what the ending result for that day would be on each of those. But whatever it came out to be, these 7 steps are very useful for kind of measuring any type of trading, any style of trading.
Yeah, okay. So those 7 steps which you just mentioned there, I've actually seen that video series and it was really well done. So would it be possible to ask you to briefly run through those 7 steps, just mentioning what each one is, along with just 1 or 2 real quick points?
Yes, got it. The first, there's those 7 steps, and we have them in a specific order. And one of the first things I like to mention is when looking at this, and you can do this for any type of education, when somebody's giving you a list or a bullet point or a summary, you can say, why isn't something in this? And in this circumstance, I always like to point out the fact that the one that we have listed last is last for a reason. And it's without fail. Any system I talk about, one of the most common questions at the very beginning is accuracy. It actually, just today, we have the Options Tribe premium chat room. And the question came up today. We're talking about ratio straddles, where I sell premium at a ratio. So I have a directional opinion, but I also have a market neutral opinion, premium decay, stop losses, automated management, things like that. And saying the first question, we're kind of bringing up that conversation again. And one of the first questions that got popped in was, and I'll kind of leave some suspense. I won't even tell you, but it was this last point. It's the without fail. It's so common to see the first question be asked is what we feel is one of the least important things to be concerned with in trading. So there's your suspense. So I'll save it for the end. The first one is risk. That is absolutely the first and most important thing. The first is the one at the end, but one of the top ones that's often discussed is what's the return? How much did it make? How much did it make last year? What's the average annual return? How much did it make per week? That's often the first question, is how much did it make? But we like to look at what is the risk? And there's multiple forms of risk. And the series is free. If you go to SMB training, or actually I think you can just Google it. If you just type in 7 steps to system success, it probably, or you can, you're going to link to it probably.
I'll put a link to it in the show notes.
There you go.
So if anyone wants a link, it'll just be at chatwithtraders.com/28. And the link will be just below the interview. So
that'll be good. Yeah. You can go through that and see. But risk, we talk about total capital required to make the trade, average drawdown, average loss, cumulative drawdown, so that's a peak to trough measurement, looking at standard deviation of a loss. A lot of those types of measures, that's most important, because if you have 2 systems that both make 60% a year on average, and one has 5% drawdowns and the other one has 15% drawdowns. And I have actually a couple more examples where it even goes to the point of showing a system that made less but had a better ratio of drawdowns. When you apply leverage to that, or you randomize that information and you take the same statistics and you repeat it randomly through a program, it actually shows you that it's unreliable or it's less reliable. And when that happens, it means that's something you can't scale up. Nobody's trading because they want to make another $1,000 a month. Everybody that's ever gotten into trading, no matter how small they start, it's without fail. If you know how to do it, you're going to open up an Excel sheet and you're going to do some kind of compounding interest calculation to figure out how quickly you're going to be able to trade bigger so you can make more. And if you don't fully know and understand risk as a mathematical figure in your trading, all of those dreams of compound interest are going to turn into nightmares because you don't understand the big drawdown that's coming. And you have a couple of good weeks or a couple of good months, so then you ramp up your size, and you don't know when that risk that you could have defined by your strategy, that it was going to hit you down too far. So you shouldn't have ramped up so quickly. Should have ramped up a little slower, considering the risk that was probably coming. They do this at SMB on the options desk. They're doing very well. The market's been excellent for market neutral options trading. But the reality is, their flash crash is coming. A 2008 is coming. In August 2011 is coming, and which are the harder times. And there's going to be a drawdown month. So they're always taking that into consideration on their trade size, not just ramping up the next month because last month was good. They know the pending risk. They know what's going to happen. And so that's how you pick your trade size and how big you're going to trade and what your expectation is. The second one is reward. You do have to have a positive belief and a positive mathematical and statistical outlook that you're going to have trading profits. So, and they need to be proven by looking back in time at what you've been doing, and they need to be proven in a simulated environment, and they need to be proven forward in the real world. And if you're not getting a reward, if there's not profits, you need to really, don't let psychology say, well, eventually it's going to start working, or I'm going to start tweaking things that I've never considered before and think that's going to make the difference. You have to have a positive expectation of profits. The third one is actually the term expectancy. So I kind of said expectation, but expectancy is an actual math formula that's used for your average win, your average loss times the number of each of those. And that comes down to an expectancy number. It's a very simple calculation that we could almost put this as, I can almost move this up to number one because it's such a valuable number, and there's so many other figures that systematic traders use as far as cumulative average returns, Sharpe ratio, standard deviation of returns, etc. Cumulative or expectancy is a simpler and very straightforward figure that also has the benefit where when you have a single trade on, while that trade is on, it's very, very difficult to think about the fact that this is 1 out of 1,000 trades. There's going to be 1,000 entries and exits that you're going to experience on a system or through some approach to the market. And when you look at each trade as if whether or not this one works out, or whether if 60% of the next 10 trades or 80% of the next 10 trades work, that has some kind of weight on the system. When the reality is it's over 1,000, you need to know that every time you pull the trigger, that you're not going to achieve a specific return that is your expectancy number, but you need to psychologically say, as long as I do this right, as long as I follow my rules, as long as I do what I'm supposed to do with this trade, I need to just know that I'm racking up my expectancy number. That every time I do it right, I just say, I earned $23 on this trade because that's my expectancy in this system. Whether or not you lost 10 or you made 60, it doesn't matter. You say my expectancy is $23 per trade, and that's the psychology you have behind using expectancy rather than how often you're right. The fourth one is volatility, which is not necessarily the volatility of the instrument you trade, but it's actually the volatility of returns. So it's basically it's not simple math, but it is simply proven with math that if you have less volatility of returns, so fewer of your trades are outliers. Most of your profits aren't generated from one or two big wins, and you don't have these sudden larger losses than usual. When you can eliminate those, you have less outliers, you have a better probability of that system working for years and years to come. So looking at different ways of volatility of returns is something that we do. Which one am I on? 5. 5 is frequency. So that is partially psychology, also has to do with transaction costs, that a higher frequency system, especially as a retail trader, instantly has lower probabilities of success because your ratio of cost to expectancy goes up. So that is one of the things behind frequency. Also, your ability to execute, if you're taking the trades manually, goes down because on paper it looks wonderful. In the real world, you realize that sometimes you're sick, sometimes you go to the bathroom, sometimes the power goes out, and there's a lot of things where you can't mess with your statistics because of the fact that you aren't a machine. The sixth one is duration. So that's a kind of a psychology one that lets you know that some systems, trend-oriented systems specifically, are going to have a lot of losses put together. So they're going to have a lot of small losses with very short duration. So you're going to feel like you take a loss, you take a loss, you take a loss, you take a loss. And then you have a trade that starts to go in your favor. Psychologically, you say, I don't want this one to turn into a loss too, so I'm going to take it off. And that becomes the one that makes 10 times more than any of the losses had. Knowing that there are systems like that. I've seen systems with 30% accuracy or less that were fantastic systems because they had tiny little losses when they're wrong. So they just accumulated a few little losses, but they were great setups. They were the times when they could take that small amount of risk and they get wiggled out. They take the setup occurs again. They take a little risk. They get wiggled out. And then the setup occurs. They load up on the position and it goes in their favor. And it goes big and it goes for a long time. So your losses may have been 2-3 hours and your wins can last 2 weeks and be enormous. So knowing that behind your system lets you know to allow those losses to just happen. Let them accumulate. Let them happen over a short period of time. If the entire market is very stagnant, you may have a lot of stocks, a lot of positions, all experience the same thing at the same time. And right around the time you want to quit and pull the plug, 5 or 6 of those can run in your favor big on that system. So you just have to know what the duration expectancy is. And then the last one, which often is brought up as the most important thing, is the first question I often receive about a system or a strategy that is, I feel, could almost be removed from the list. But there is a purpose for it on the list, so that's why it's still there. And that one is accuracy. Asking how often or how many trades out of 10 or how many trades out of 100 are profitable is probably the most common first question, but it is the least important aspect of trading to know if something is going to be reliable and profitable in the future. The psychology of having to be right is what often brings that up. The psychology of wanting to win often is brought up. The training that we have in school that says if you get less than 70% of the answers right, you are a failure. You have failed at this. And bringing that into the trading world is what keeps a lot of people from becoming profitable and having fun in this market. You have to be willing and understand that you may actually be wrong half the time, and that could lead to excellent results. You could have a 50% success rate and have outstanding results. Because if you're 50% accurate in a trend-following approach to the market, so half of your trends run in your favor and half of them have small exits, you're going to be fantastically successful at trading. The reality is trend following is often 35 to 40% accurate. And that's why most people fall in love with the concept of trend following. But then when they try to execute it, they often get shaken out and move on to something else pretty quickly because they get that negative feedback from the market and see that they're accumulating losses. And instinct comes in and says, well, if I'm not getting the results I expected, it's probably wrong and I need to quit. But the reality is you just didn't have the right expectation of how that was going to work out. You probably were misled into being only shown great examples of when something worked, or being shown 2 things that didn't work and 5 things that did. And that sets you up for that expectation that if you do this, you're going to win more often than when you're wrong. And the reality is it's probably not that way. It's probably 7 losses and 3 wins, or 6 losses and 4 wins. That's probably how it is. And you may actually enter where you have 10 losses in a row, or 1 out of 10 works. And that's not enough data to consider something invalid. You have to look at more information than that. So those are the 7 steps in a very abbreviated way. The entire video series that you can opt in and get for free explores that over I think it's either 7 business days or 7 calendar days that you get those. There's a video and kind of an article that goes with each one of those. So you go through that entire process, and even that is just a very brief snapshot of what Rick and I went into in the Systems Foundation course at SMB, where we really dive deep into all these metrics and ways of looking at different techniques and strategies and how you can measure them and know if they're going to work.
All right, awesome. No, that was really good, Andrew. Thanks for going into so much detail on that. And I'll put the link to that in the show notes at chatwithtraders.com/28. So if anyone's interested in learning more about systematic trading, then definitely check that out. I did, and I got a lot of value from it. So anyway, we should probably start to wind things down, but let me ask you just one more question.
Sure.
And I love to ask this question to a majority of the guests, and that is, what's the number one reason why the majority of traders lose money and never reach a high level of success, in your opinion?
Well, I'll have to just give an answer, because I could probably think about this for days and come up with it, but or I might give a mixed answer. One is there's traders enter the market with a lot of confidence because they're either smart, so they may be more intelligent than a lot of their peers, family, or friends, and so they look at the trading market and say, okay, most people fail at this. However, I'm generally smarter. I am good head on my shoulders. When I try to understand something, I do well with it, and I'm also passionate about it. So they say, well, I have what it takes, because most of my friends, they're just not even interested. So if they try, they'd probably fail. So I'm probably well suited for success because I have other success in my life. Or I've seen very successful businessmen and investors that in the markets that come to trading, and they get a negative feedback from the market, meaning they lose money, and they approach it the same way they would approach anything else in their life. If it's sports and you're losing, you just practice harder and you try harder and you learn more, and through sheer effort, you're going to be able to improve yourself and get better results. In business, you can work longer hours and you can cut your prices, and you can make decisions that you control how you're going to fix it. And you get positive results from that in other areas of your life because you overcome what's going on and you make it work. And traders, those that are attracted to trading, often have that mentality and characteristic. Then you come to the market, and you have to learn very, very quickly that your willpower has no place in the markets. Your willpower to say, I am going to hang on to this trade until I'm right. I'm going to will this system to work. I'm going to will this trade to work. And you just say, I know I'm going to be right. And you take that approach to the market. The worst thing that can happen is that you get rewarded for that a few times. So you call the top in something that's high flying or up big for the day. You call the top and it drops right away. You say, oh, that's great. I should have taken a bigger size. Then it happens again, and you do it again, a little bigger size. And, oh, that was great. And you don't even realize the whole market was consolidating, so every pop was faded. And then all of a sudden, the December rally comes, and the market breaks out. You say, well, I've been conditioned. I know it works. I'm going to short this thing. And then it takes off. The whole market goes up 6%. Your stocks go up 11%. And the whole time you're just trying to will it. You're trying to study. You're trying to figure out why it should go down, why it's got to work out, why you're right. And through some willpower effort, it's going to work out for you. Where the mentality that works is to know when you're wrong and have a understanding that certain there's nobody that's going to be right 100% of the time. And as soon as you are wrong, as soon as you get to a point that has exceeded your expectation of what should happen, that you need to do something about it. And one reason I love options trading is I don't always have to close the position. In my psychology, that works great because I still get to kind of hang on to my idea. But in options trading, I can take other approaches for just kind of defending myself and bringing in a different trade to kind of enhance the position and not really close the original one. It's just kind of a psychological game I get to play that helps me, and it really works out better. But I think that's kind of it, is that they bring in success in other areas of their life. They try to apply it to the market, and the market doesn't play by the same rules. So I think I'm just going to pick that one. I think that's kind of one may not be a common one that's brought up.
Yeah, that's actually a really unique answer. I don't think anyone's given anything quite from that angle before, so I really like that answer. That's a good one. Now, Andrew, thanks so much for coming on. Now, I know there's quite a few listeners who I've spoken with who are keen to get into options or who might have already started on options. So would you be open to answering any questions that listeners might have in the comments about trading and more specifically around options?
Yeah, that'd be great. You can just let me know or figure out some way that I can be notified when they get posted, and I'd be happy to answer any questions.
For sure, yeah. So if anyone has any if anyone has any questions for Andrew, just go to chatwithtraders.com/28, scroll to the bottom of the page and just leave a comment there, and I'll let you know, Andrew, whenever there's any new questions there, and you can jump onto those.
Great.
Okay, and where can listeners go to find out more about you?
You can go a lot of places to find out about me, but most of my work right now is through SMB Capital and SMB Training, also known as SMBU. So the fastest way to type that in is probably smbu.com. You can also get me on Twitter. So I have a pretty unique first and last name combination. So if you were to Google Twitter, Andrew Faldy, or just Andrew Faldy in general, you'll probably find me in a few different places. And I don't have any other distant relatives or anything with the same name at this point. So I'm pretty easy to find that way as well. So Twitter, Andrew Faldy, or I think it's Andrew F_SMB, but it's pretty hard to miss. But what's any other way? Andrew at andrewfaldy.com is email address. You can send that as well, so it'll come right to me. And then I can add you to my Google Plus, and you can get updates that way as well.
Okay, good one. Well, I'll make sure to put links to everything you just mentioned there in the show notes, including your Twitter handles. So, anyone who wants to find out more about you can just jump onto any of those links. And like I mentioned, I'll also put a link to the video series that you created about system trading. All right, Andrew. Well, thanks so much for coming on the show today and sharing plenty of valuable pointers with everyone listening. Have an awesome week, and let's stay in touch.
All right. You're welcome. Thanks a lot for having me.
Thanks, Andrew.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up guys? Welcome back to another episode of the Chat with Traders podcast. I'm your host, Aaron Fifield. This week's guest is Brian Shannon, who first and foremost is a professional trader whose involvement with the market dates back well over 20 years. He's also the author of the highly regarded book, Technical Analysis Using Multiple Timeframes. And thirdly, Brian is the founder of Alpha Trends, an educational company focused on teaching traders how to navigate the market successfully. For the most part, Brian is a swing trader with the occasional day trade in the mix. During the interview, Brian discusses both of these approaches and gives a few pointers that may even help you to discover the right time frame for your own trading. We also talk about understanding the psychology of market participants within well-known patterns, the 2 indicators that Brian uses most often, and one of them being VWAP, which is volume weighted average price. And Brian also walks us through the 4 stages of a market cycle: accumulation, markup, distribution, and the decline. So all in all, Brian hit on plenty of great topics, and I feel like you're really going to enjoy the insight he shares with us. So I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Brian Shannon. Hey Brian, welcome to the podcast. How's it going?
Going well, Aaron. Thanks for having me on here today.
No trouble whatsoever. Thanks so much for coming on. I've really been looking forward to this, and there's plenty I'm keen to discuss with you. And I mean, I really should just say, I've got a ton of notes here, so let's just get right into it. Now, you've been involved with the markets for more than 20 years as a pro. But your first experience with trading dates back much further. Would you like to share with us the story about your first interaction with the markets? And then we'll go deeper from there.
Yeah, my first equities trade was a company called LoJack, and LoJack was I think they're still around, but they track stolen vehicles basically. And this was 25 years ago. I used to sit around and watch Wall Street Week with my dad on Friday nights, and I saw this news broadcast about this technology for stolen vehicles. And I remember, telling my dad, hey, I thought that was a pretty cool idea. And he said, well, let's buy some of this stock. I think it was $4 a share. And I had maybe $500 saved up from various odd jobs, caddying and that sort of newspaper routes, that sort of thing. And he said, well, buy 1,000 shares. You put up your $500. If you lose, you lose the $500, but you make money. So I didn't realize at the time, but he was essentially giving me 8-to-1 leverage on this trade. Fortunately, it worked out, and it went to $10 a share about 6 months later. And, for no other reason than, hey, it's $10 a share, I said, let's sell this. And so I made a profit of $6,000. And from there, I was pretty much instantly hooked and thought, this is great. Why would anyone ever have to work for a living when you can just do the, trade like this? And obviously, it's not that simple. I had some very good beginner luck, and it worked well, though. But that's what really piqued my curiosity.
Yeah, that definitely is some very nice beginner's luck right there. So, what was your sort of motivation to buy that? Like, where did the idea come from to actually put your money into that company when you could have invested in, any company that's listed on the market?
Yeah, I had seen on television a local news broadcast saying how that this technology was reluctant to be brought on at first because the state police in Massachusetts didn't want to pay for the transponders to track the stolen vehicles down. So the company said, we're going to donate them to the state police department. And the state police were real excited about it. And I remember hearing one of the cops on television say, hey, I think this is great. I even bought stock in it. Found out later that the trooper, basically had inside information when he bought it and had to give his profits back on that. But it didn't prevent me from, coming up with the idea. And I was, probably just a young, impressionable kid who wanted to bond with his dad and thought that this was a great idea and knew that, he was in the market, and we'd been watching Wall Street Week, like I said, and I figured, hey, let's put some of this to work. What do you think, Dad? And he took the initiative to say, okay, let's do it.
Okay, excellent. And just quickly, how active was your dad in the markets? Was he an active trader?
No, my dad, he's retired now, but he's a physician, and he would, he was pretty active, but not by any measure compared to, like what I do today or where my trading has evolved to. He's been more of a buy and hold for, 6 to 12 month type of investments.
Okay, sure. Cool. All right. Well, so from college, moving forward a couple years, you landed a job as a stockbroker. How did that come about, and what sort of tasks were you doing in your role as a stockbroker on sort of a day-to-day basis?
Well, the interesting thing was that I really didn't know what a stockbroker did. And maybe that's naive, but I think it's good too, because I probably wouldn't have gotten into it if I realized what a broker's job was. So, after college, I didn't really know exactly what I wanted to do. I knew I liked the market, and I happened to find a brokerage firm that was willing to sponsor me for the Series 7 license. Once that occurred, I went in to the office, and they basically gave us a script and said, start calling off these lists, find phone books, alumni directories, and that sort of thing. And it was after I passed my Series 7 license and was making the calls for a while, I realized that the business was really a glorified telemarketing position, not the trading that I was interested in. So again, probably a little bit naive, but it's it got me in the door. I went to a more established firm, which was Lehman Brothers, and really learned how to sell there more than anything, which was great training. And then just kind of transitioned to trading from there after moving to a couple different brokerage firms.
Okay, so you were mostly on the phones there, trying to convince people to buy stock. Is that correct?
Yeah, and it's I like to kid around about it and say that it was a great experience because I got to practice with other people's money, and I wasn't cavalier with anyone's money that they entrusted me to. But I did learn a lot of good lessons by not having my money in the market and learning how the market worked a little bit. So I was instantly attracted to technical analysis. It made a lot of sense to me. One of the early influences there, I guess, was there was a newsletter called the Cabot Market Letter, and they had written about, they were interested in buying this stock if it got above a certain level. And I thought, well, isn't that strange? Why would somebody want to buy it at a higher price? That seems kind of counterintuitive. So I looked into it, and I saw the chart, and it instantly made sense that if it got above that level of resistance, I didn't even know that's what it was called at the time, but if it got above there, that it looked like it was clear sailing from there. So I ended up getting involved in that stock, made money, and just started to devour everything I could find about technical analysis.
Okay, sure. So you went to the stockbroking firm, and then you went to Lehman Brothers. From there, I believe you ended up trading with a prop firm. What was your experience like trading with a firm, and what was the attraction to actually get into a firm instead of trading your own money just as a retail guy?
Yeah, I think I was 22 or 23 years old when I did that, and it was basically I had saved up some money in the market, and I had seen in the back of Investors Business Daily there was every single week a advertisement for trade with our capital, or earn 20 to 1 leverage is what it was. So I was intrigued with that because I figured that I didn't have enough money to really get involved in the market with the amount of capital that I had. So I was still a broker. I answered this ad, went to New York, and met with these guys. And I signed up as a remote trader, and this was 24K modem. And I remember being all excited with a 48K modem, sitting there in my basement trading. And they didn't give a lot of training. That was the thing that they basically said, okay, we'll give you a shot. You get to keep X percentage of your profits. And I had, I basically borrowed some money to put down for that initial $25,000 deposit. And so therefore I was extremely risk averse. And that really helped me. I mean, they say don't trade with scared money. And I don't think it was necessarily scared money, but I was being smart and really people say they don't like to lose, and I say in the market you have to hate to lose. You really have to. When you start feeling something moving against you and you get uncomfortable, you just have to get the heck out of it. So I was fortunate in a way that I wasn't scared money, that I had the opportunity to see how stocks traded, technically through my experiences as a retail broker. So that was great experience for me. And from there, then I helped them, that is the New York firm that I was with, I helped them open an office in Denver and started branching out that way a little bit.
Okay, sure. And did you mention in there that you were working, or you were trading, remotely from the firm? Yes, it was, so they were out of New York and they didn't have any local offices. So they were sponsoring people to, trade with their leverage basically. And, they got a piece of the commission and they marked up the commissions a little bit, so that plus the additional profit that they made, that it was a good business model for them, and it was a great opportunity for myself. Okay, sure. And are there many prop firms that still kind of operate that way today? Yeah, there are. Yeah, there's still. I mean, if you dig around, you can find them, and they are. A lot of times people are attracted to them. I can't criticize the firms or the people who are attracted to them, because what they typically attract are people with less capital and maybe not a whole lot of education either, but they're willing to give them a shot basically in the market. And I would say that, knowing what I know about the markets today, that I took a huge risk that I would not recommend anyone else do when I did do that account with the prop firm, but it worked for me. So I think that everyone, has the right to make that decision for themselves. Yeah, absolutely. So you mentioned right there that you took on a huge amount of risk to do this. Did you ever have a backup plan in case this trading thing never took off for you?
Um, Great question. And I can't really say that I had a defined backup plan. It was more, I'm going to make this work one way or another. And I suppose that if it didn't work out, I would have returned to the brokerage business and started, building a book of business that way again.
Okay, sure. So during this time, up until sort of where we are right now in your journey, what would you say was the biggest challenge, within these sort of first 5 years, the biggest challenge or some of the hurdles that you had to overcome that were essentially affecting your P&L in a negative way?
Well, I think it's true for almost anyone that we are our own worst enemies. And, I'm not sure if that's the answer you're looking for, if you're thinking, maybe some external factor. But realistically, I think that we are all our own worst enemy in the market. That even today, I'm still astounded some days about some of the decisions I make during the day, and think, well, I knew better than that. What was I thinking? And to control our impulses and to be more disciplined, to cut losers quickly and to hold winners, real basic stuff. Those are the things that trip pretty much everyone up and continue to plague anyone involved in the market who's honest. We are human. We do get emotionally involved, even though we try not to. And the thing that I've gotten a lot better at is recognizing those times when I'm making poor decisions and saying, enough, just stop, liquidate the position. This is not smart. So it's a matter of probably trading more specifically, maybe I started trading too big and too concentrated in certain positions. But at the same time, right before I learned a great lesson right before I started with that prop firm, because I was trading a company called Chantel Pharmaceuticals, and they weren't a pharmaceutical, they were a complete fraud. Actually, they had a miracle skin cream that eliminated wrinkles, and this stock was going, it started out at maybe $6 a share, and I was on it because it had big volume. It was breaking out, and I was trading it up to about 23, 24. I held some over the weekend, one weekend, maybe 1,000 shares at $21 a share. And I remember that Monday morning seeing that the stock was halted, and it was, Barron's did a hit piece on it, and the stock it was basically cut in half, and I lost maybe $8,000 to $12,000. I don't remember the numbers overnight. Right before I was just getting my money together to go trade. So the lesson there was not to have such concentrated positions, especially in little story stocks. And there's so many lessons you learn along the way. But that was one that really stood out for me, that almost eliminated me from ever getting involved with that prop firm.
Okay, sure. So I really like that answer, and that's an excellent example too. While that was probably quite a painful point in your sort of development stage, were there any points where you felt like maybe you weren't just cut out to be a trader and you actually came close to giving up?
Yeah, actually, it was probably I'm just going to say, it was maybe 2000, 2001. At that point, the market was getting crushed, and I had not learned at that point yet that, you can't just keep buying stuff that goes down. And I was actually had a prop trading firm I can't really call it a prop trading firm, more of a people would come in and trade with their own money, and we would help them with getting extra capital. But the market was getting crushed, and I was losing money pretty consistently at that time, just buying stuff in downtrends and expecting that they would bounce, and they weren't bouncing. And I did. I nearly dissolved the account. I was super close. I took a couple weeks and did some reflecting. Came back and talked to the partner that I had at that time and said, "Listen, here's what I need to do." Fortunately, we had a business, and the business was profitable, so I just slowed things way down, and started trading. Maybe I don't even remember, but half of or a third of my normal size, and just started grinding it back and getting back into it in a more disciplined way and reevaluating and learning. So I was real close, though, to throwing it away. And if I did not have a backup plan, backup business where I was able to pay bills, then there's no doubt in my mind that I would have been out of the business and no idea what I would be doing today. I was very fortunate, I think.
Okay, right. Yeah, that's really interesting. So let me ask, from when you left the stockbroking firm job to at what point, how long did it take you until you reached a level of consistent profitability? Like, when did things really start to click for you?
Well, I remember my first 6 or 7 months, I was profitable every month, and I was being super disciplined and cutting losses. Then I started to get a little bit of that ego involved, where I thought I knew everything, and then I started to go through a down stage. Fortunately, I kept it limited, and it was really just in evolution, really. The whole thing, obviously, trading in general is an evolution, and you come back to the basic principles. So I kind of got lost on that question there for a moment, but the thing that I would say is that my lessons learned are that the basic things that I still preach to this day: only price pays, follow the trend. I repeat those things a lot of times to remind myself, because that's really the principles of how you make good money in the market. And I believe you get exactly what you deserve in the market, that you can't make excuses that if I lose, it's because I did something stupid, and I hold myself accountable. I can't complain about Greece or China or whatever the news of the day is. I have to recognize the environment we're in and adapt to it, or stand on the sidelines and wait till things make sense.
Yeah, totally. So let's get into that a little bit deeper. So describe to us, if you could, your actual trading style and your methodology for how you approach the markets these days.
Well, my main approach, sometimes I will do counter trend trades on an intraday basis, but the main approach is that I'm a trend trader, and I'm looking for stocks, for instance, in an uptrend, and using multiple time frames. So as I describe it, it's not really quite this simple, but identify a stock on a longer term time frame. So when I'm looking at a swing trade setup, and that's my preferred time frame, is that I want to look for stocks that will last a few days in terms of the trend, if the market warrants it. And obviously there's certain conditions where we've got a choppy market and it's just not feasible. But I'll look for the bigger trend on a daily time frame, and a real very, very simple thing that I look at is what's the direction of the 50-day moving average. Now that will just tell me, okay, if it's rising, well then we're in an uptrend, and I look at that stock and say, okay, that's not a stock I want to short. If the stock has a declining 50-day moving average, I say that's not a stock I want to buy, because it's in a downtrend. So I'll look at it and see, has it had a period of volatility contraction, and that is, has it pulled back, and so the uptrending stock, if it's pulled back to a prior level of resistance that looks like it might be support or a key moving average or a retracement level or just something significant technically, then I will say, okay, now on that daily chart, I've identified a possible trade candidate. Then I will go down to a 30-minute chart. So each candle representing 30 minutes for the last 20 to 40 days, whatever I need to kind of see what's relevant, basically. So on that 30-minute time frame, and it's not just a 30-minute time frame, you have to be aware of all the time frames, really, but this is, again, simplifying it. Then I'll look at it and say, okay, on this 30-minute time frame, where has the stock come from? So if it's run 10% in the last 3 days, it tells me the risk reward isn't good there. But if instead we've got a stock in a strong uptrend that's pulled back on diminished volume and it's starting to undergo a little bit of accumulation on that 30-minute time frame, then I'll start to look a little bit more carefully. And one of the guidelines I use on an intraday intermediate term time frame, such as a 30-minute chart that goes back 20 to 40 days, is a 5-day moving average. And I generally want to buy the stock when it makes a higher high above a flat to rising 5-day moving average. And that tells me the intermediate term trend is now turning back up, and I have a logical place to set my stop, which would be, as I like to say, underneath the most recent and relevant higher low. So that if I see that the entry relative to the initial protective stop is small enough to justify a position, and that the trend on the longer term time frame looks like it should be able to continue in the direction, in this case in an uptrend, then I'll look to say, where's the potential for resistance, or where would it likely slow down? And based on that perceived amount of potential reward, then I come up with a risk reward and say, okay, this is a stock that makes sense. So I use that 30-minute time frame to come up with a risk reward and to plan the trade. And then I'll go down to like a 10-minute chart, each candle representing 10 minutes over the last 10 days or so. And I'll start to anticipate the trade now more. I'll start to stalk it, set alerts. If I think it's going to break out beyond 25.50, I'll set an alert, let's say at $25.40. And then when that alert triggers, I'll start to look at the stock a little bit more carefully. I'll see, what's the overall market doing? Is there, if the market's down and the advanced decline line is let's say 2-to-1 negative, I might, I'd say, well, I still want to look at this stock, but maybe I'll trade smaller share size. And so I start stalking it. I'll reset my alert to 25.45 or 25.48, or I'll start to watch it on a shorter term time frame. And then I want to make my decision based on price only. I don't want to look at it and say, well, the volume's not there yet, because a lot of times people will wait for volume, but the volume will come a day and a half later when the stock has already moved 5 or 6%. So to trust price action, going back to your question of, what lessons have I learned? I think that trusting price action, if you have a good plan and you have a backup plan for it, that really is you're going to get into a lot more trades and not talk yourself out of them because the volume's not there yet, or there was a divergence with the MACD, or, well, I don't like what the NASDAQ is doing, or something like that. So to take each trade based on the merits of that trade individually, and if there are macro concerns about the market or some kind of event coming, to use that for the money management aspect and to reduce my position size to compensate for that higher volatility or perception that we might not be able to follow through as strong as if the entire market was in a better trending condition. So it's a long-winded answer, sorry.
No, that's excellent. That's really good. So,
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So, just so we're clear, like you spoke there a lot about price action and focusing on the price itself. How do you treat fundamentals and news? I think you might have briefly touched on that there, but just so we're clear, do the fundamentals and news have any impact on your decisions to get into a trade?
I try to not let them. I am generally aware, so I want to know what are the potential catalysts for a stock. So if for instance, I'm looking at this stock and I think it's a buy, but then I see they're due to report earnings after the close, then I'm not going to trade the stock because I don't want to gamble on earnings. That's a lesson I've learned in the past as well. Gambling on earnings, it's gambling. There's no edge there. So I will be aware of what the catalysts are potentially. I'll be aware of the news headlines at least to try to determine what are the catalysts, what's shaping the psychology in the market today. But I try not to read into it too much and have an opinion of the news itself, because the news is often, I don't want to say made up, but coincident to the price action. Not leading, or it's, we can't always trust accountants. We can't trust CEOs that the news is actually what's happening. And that's why I adamantly say over and over again, only price pays, that you can be aware of the headlines and that sort of thing. But market doesn't care what I think about a stock, about what its value is or what it should do based on an earnings report or something. The only thing that's going to pay or hurt is price action. So I would rather lose my opinion than lose my money and move to the sidelines quickly, because you can always reassess the trade and determine to get back in. But there's a tendency to that when we look at the news, we get our egos and our opinions, and we think the need to be right becomes stronger and really, clouds our judgment.
Yeah, okay. No, that's excellent to hear about. Now, this is something you often talk about, and that is focusing on the psychology of patterns and less about the actual pattern itself, like whether it's a cup and handle or a double bottom or whatever it might be. So could you explain perhaps your reasoning for looking at patterns from this angle?
Well, there's nothing wrong with recognizing a pattern, and I often talk about candles, for instance, as well. Some people will be looking at a candle and they'll say, "Hey, that's a doji," and it on the daily time frame. And I'm more interested in what happened underneath the surface. How did that doji come about that it sold off strong in the morning and might have chopped sideways for a little bit, but then the buyers regain control, and I can see it much better on a shorter term time frame. That is, I can understand the psychology of what's shaping it. And back to the cup and handle, nothing wrong with recognizing these classic technical patterns. And I started like that as well, looking at recognizing technical patterns, but I saw a lot of them fail. And what is it behind there that makes the sense? So a cup and handle, you could train a monkey to recognize cups and handles. You can program a computer to do it. But there's the art of the science rather of technical analysis versus the art of trading and understanding, hey, things can and often do go wrong. That is, they don't work out as anticipated the way a technical analysis book will tell you it should. So I want to see that, so a cup and handle, a stock comes up to a certain level of at $80 a share. It runs up to that. It pulls back down to 70 and it runs up to 80 again, but there's still supply there that's unable to be taken out at that point. So the stock backs off again, but instead of backing off down to $70 a share, it finds buyers at $76 a share. It finds support and starts rallying up towards that $80 level again. And then it might even dip down to 78 and then hit the 80 and then break out. So the point is, though, that these higher lows that are being established tell me that the buyers are gaining control price-wise. They're not waiting for the pullback to 70. Instead, they take control at 75. Then they take control at 78. So they're getting more aggressive price-wise. And the time distance between those tests of resistance might be, from the first test of 80, it might have been, to the second test, it might have been a month and a half. And then 4 weeks later, we test that 80 level again, and it pulls back to 78. Then 2 weeks later, it comes back up again. So they're getting more aggressive, not only price-wise with the higher bids where they're taking control, but time-wise that they're coming back more often to test and work through that supply being offered at the $80 level. So so you can understand what's happening rather than just saying, hey, that's a cup and handle. I read about those. Those are bullish. I'm going to buy it. It just gives you that better understanding of what the forces are underneath the market. So you want to look at the market and say you're going to have one of three positions. You could be long, you could be short, or you could be in cash. How do the longs feel? How would you feel if you were long? And where would you be getting more aggressive? How would you feel if you're the seller at that $80 level and your supply gets worked through? Or if you're a short seller and you're trying to hold it back at that $80 level? And if you have the ability to be objective and on the sidelines in cash, where do you get involved at the best risk reward standpoint? So it's not really super complicated to try to put yourself, how would I feel if I was long there, if I was short on that stock, or if I'm in cash, should I just ignore this stock, or is there the potential for opportunity in it?
Yeah, you mentioned a lot of great points in that answer, so thanks a lot for sharing that, Brian.
Sure.
Now, I've noticed in your analysis of reading charts that you pay close attention to two indicators. There might be others, but I noticed that you pay extra close attention to these two. So the first would be moving averages, and the other would be VWAP, volume weighted average price. So I'd like to ask about both of these. Well, you sort of already covered the moving averages a little bit earlier. But just on moving averages, they seem to get a bit of a bad rap. A lot of people kind of regard them as maybe a tool for amateurs or maybe they're just using them incorrectly, or I'm not sure what it is. But have you noticed this, and why do you think this sort of there's, I don't know if a stereotype's the right word, but there's kind of like a stereotype around moving averages as though they're ineffective?
Yeah, I think that a lot of people do misunderstand and misuse moving averages. I look at them as a mathematical trend line, a constant to compare price to over a certain period of time, whether it be 20 days or 50 days or 200. The time is the constant, in other words, in a moving average. And just like we were talking about the psychology of a pattern, I think it's even more important to realize with a moving average, we're all taught that a 50-day moving average is support. I say it tends to act as support. So a stock in a strong uptrend pulls back to a 50-day moving average. People will say that's a buy signal. And to me, it's not a buy signal, but it's a reason to look more carefully at the stock on a shorter term time frame, to look under the surface and see what's actually happening there. Because I can show you thousands of examples where a stock pulls back to the 50-day moving average and just keeps going. That is, it just keeps dropping. So it's the psychology behind that 50-day moving average. If you're a long holder and you bought the stock, let's think of a mutual fund or someone, and they've got millions of shares of this stock, and they bought it at 20, and it runs to 28. And it's 4 points above its 50-day moving average. They might say, hey, it's getting a little extended. Let's start paring our position back. Let's sell some while we can. So they sell a couple 100,000 shares. It pulls back down to the 50-day moving average, and they say, all right, let's not sell anymore because the 50-day moving average often acts as support. So what they're doing is they're removing supply from the market at that area only because they've observed, they've learned that the 50-day moving average often acts as support. Let's think about a short seller in the same situation who thought, hey, this stock has gotten overheated. Let's sell short some stock. We'll cover it down near the 50-day moving average. So they put the supply on the stock to bring it down to the 50-day moving average. They start to stick in their bids for the stock, and they not only remove one of the sources of supply that helped get it to that 50-day moving average, but then they're also starting to add some demand in there by putting in bids. So the bids are starting to show up, and the stock is losing supply, and we're starting to see that gradual shift. So I want to look underneath the surface and say, is there actual evidence? Let's go back to that 30-minute time frame. Is there actual evidence on the 30-minute time frame that the stock is starting to at least turn sideways, that the pattern we've seen over the last 2 weeks during this pullback of lower highs and lower lows is starting to show more neutral market? So we see less supply. We're starting to see a little bit of demand. And then think about the people, the big mutual fund might say, okay, we sold 200,000 shares between 25 and 28. Here it's at the 50-day moving average. Let's bid for another 100,000 shares. We'll replace part of our position in there and provide support for the stock as well. So they're putting in bids. That's the source of demand. And then you've got your all of the people who look at moving averages and say, hey, the 50-day moving average usually acts as support, so I'm going to stick in a bid there. I want to get involved in this hot stock because it's pulled back to the 50-day moving average. So we start to see that it becomes a self-fulfilling prophecy, this 50-day moving average or a 10-day moving average or whatever the dominant moving average is for that stock on whatever time frame it is, a 200-day moving average, let's say. So there's the psychology behind why do people look at that level. Now let's take it one step further and say, since that stock rallied from 20 to 28 and it's pulling back to 24, we might have another group of people who trade based on Fibonacci. And they're saying, well, it's pulled back to a 50% retracement. 50% has been a good level to buy this stock. So they kind of go through the same process of let's put in our bids here, let's remove supply. And then let's say there's another factor such as the volume-weighted moving average price since that event is in that area. So there's the psychology behind all of these oscillators and indicators that are much more important than just looking at little squiggly lines and saying, okay, that's a buy signal, okay, that's a sell signal.
Okay, excellent. So let's talk about the VWAP. I mean, what is it you like about this indicator, and what separates VWAP from other indicators?
The volume weighted average price, what it does is it takes, so whereas a regular, simple price-based moving average is based on of the average price for whatever period of time you're looking at, it doesn't consider the volume that traded there. So if we have a stock that traded, let's just say, keep it real simple, if you had a stock that traded 100 shares at $20 a share and 10,000 shares at $19 a share, you can't really assign the same value on a moving average to say the average is 19 and a half. The average is really closer to 1901. Based on volume. So we're looking at it from the supply and demand in terms of the actual dollar amount assigned to a certain price level. And what I like to look at is, for instance, the volume weighted average price since an event. One thing that's been really helpful is, since when a stock breaks out from 20 to 28 and then it begins to pull back, oftentimes you will see that buyers congregate or support is found near the volume weighted average price since that breakout event. Or more recently, I've been tweeting about, for instance, in Alibaba and in GoPro, the volume weighted average price levels since these companies actually became public, and they've both, within the last couple months, shown that, the stocks had some nice bounces and they rallied almost precisely to the level, the volume weighted average price since the stock came public. So there's a lot of psychology assigned to that level. It's the average price. It says above this level, the average participant is making money. Below it, the average participant is losing money, and we can start to, delve into the psychology of the buyers and sellers and see how much they have at stake at certain, they tend to be inflection points. So at those levels, how much do they have at stake, and who's, gaining or losing control there?
All right, cool. So still on the subject of VWAP, do you find that it's more popular within the professional space? And if you do, why do you think that VWAP is maybe underutilized by retail traders?
Well, one of the original uses of the volume weighted average price is for, let's say you work at Fidelity and you want to buy 2 million shares of Alibaba. So you tell your broker, hey, I want to buy 2 million shares over the next 2 weeks, and what I want you to do is to do a good job for me. The way I'm going to measure that is over the next 2 weeks, we're going to see what the volume weighted average price was during that time. If you do better than the volume weighted average price during that time, I'll give you more business. If you do worse than that, I'm going to go to a different brokerage firm and have their traders execute the trade for me. So it's a value comparison for a lot of institutions in that regard. I think, though, that over the last I've been looking at the VWAP for about 12, 13 years, and I actually stumbled upon it. I think that everyone looks at every oscillator and indicator when they first start out looking for that holy grail. And the VWAP it just kind of spoke to me that it acted as support and resistance. So it is becoming more widely used by retail. Fortunately, not overused. That it's still effective for looking at even intraday in the markets. I'll look at it often on a 1 minute chart and look for who's in control. And if it's got a declining volume weighted average price, generally I don't want to buy it. If it's got an advancing volume weighted average price, that is, the average price has been increasing throughout the day, the transaction level has been increasing throughout the day, then I generally don't want to short that stock. So it's becoming more widely utilized. I like to think I have something to do with that. I've been tweeting about the VWAP and wrote about it in my book in 2008. So I've been tweeting about it and talking about it and writing about it since then. And it is becoming a lot more prevalent with more retail type people.
Okay, sure. No, that's really well said. Now, you spoke a little bit earlier about your time frame analysis, and I've just got a few more questions around that. But before we get into it, I think it would be beneficial if you could maybe run us through the 4 phases of market cycles as you see them. I believe you cover this in your book, but if you could just give us sort of a brief overview of the 4 different phases of a market cycle.
Sure. Actually, you know what I would like to do, Aaron, is to send you a copy of the infographic I had made up for that, because it really explains it a lot more in detail, what I'm going to be able to say, and perhaps you can put a link up to it with this podcast. But essentially, it's as I mentioned, when I first started trading, I wanted to I got my hands on as much technical analysis information as I could. And what's always been attractive to me is the simpler analysis. And Stan Weinstein's book from 1986, I believe, or something like that, Secrets for Profiting in Bull and Bear Markets. If any of your readers or listeners have read that, they'll see it's been a huge influence on my career. I in fact sent a copy of my book to Stan Weinstein, and he praised me for it, and saw that I said, "Hey Stan, this is I've been hugely influenced by your work. I learned this from you, and I want to give you credit." And anyways, the 4 stages, it's goes back to the business cycle. The business cycle being, we have periods of expansion, then we have a peak, then we have a decline and a trough. So we have these 4 stages. And in the market, it's been described as stage 1 is accumulation. Accumulation occurs after a decline. So after a long decline, it doesn't even have to be a long decline. Let's say we're talking about a daily chart, and the stock has experienced a significant pullback. As I like to say, if they don't scare you out, they'll wear you out. So during the stage 4 decline that precedes stage 1 accumulation, what you see is that you've got stubborn holders who hold the stock on the way down. They're not being disciplined. They're not cutting losses. They're still believing the press and the hype around a stock. But in that stage 1 accumulation, what's happening is the stock starts to become indecisive as the supply and demand starts to reach a little bit more of an equilibrium, that you don't see there are these fearful sellers anymore. It starts to turn a little bit more neutral. So that accumulation phase, what we see in there is that it can last a long time, and one of the hallmarks of a accumulation is that we see moving averages crossing back and forth above and below each other. So moving average crossovers represent indecision. A lot of people use them as a timing tool, and I think that's incorrect, because moving average crossovers mean there's a conflict in terms of trend So a 20-day moving average crossing up and down, up through and then down below a 50-day moving average says, the intermediate and longer term trends are in conflict here. There's no real trend revealing itself. So it's a good avoid. So during that stage one accumulation, it's a good stock to avoid. As those longer term moving averages flatten out and begin to, start to turn higher, then you see that the buyers are slowly gaining control. And in that late stage one accumulation, that's where you anticipate the breakouts. So as the stock makes a higher high above the flat to advancing longer term moving averages, that's when you want to participate in the stock. So you anticipate in stage one, you participate in stage two, and as it makes the higher highs and higher lows, you manage risk and hold on as long as the stock tells you to, based on whatever time frame you're engaged on. So in other words, as long as it makes higher highs and higher lows, you stick with it. And then as it undergoes distribution, we see the opposite of now we see that the stock is not going higher anymore. It's being met with more supply. The moving averages cross back and forth, representing indecision, and it's either digesting those gains through time before a breakout, or if it breaks down, then we look at it and say, okay, now the moving averages are heading lower. This is a stage 4 decline. That stock is an avoid if you're just a long trader, or it's a short sale candidate. So those 4 stages allow you to just kind of very simply look at the market or an individual stock and say who's in control, buyers or sellers, or is it unclear? And if it's unclear, the beauty of that is that's just an avoid. There's no reason to go near that stock and give it some time, keep it on your watch list, come back to it, but there's no reason to be involved in a stock that's just going sideways.
Yeah, well, I mean, there's always plenty of others to choose from, isn't there?
Exactly.
I mean, if you can send through that infographic, I'll post it with the show notes underneath this episode.
Yeah, of course.
At Chat with Traders on the site. So I have a question in regards to the time frames, and how did you discover the time frame which was the best fit for your personality to trade? Like past guests on the show have mentioned quite a few times that many traders often spend a long time working with a time frame that isn't necessarily the best fit for them. So how did you discover a time frame that worked well for you?
Well, and that's a great point. And going back to your, what lessons have been important, understanding your time frame is hugely important. And, if you have the patience of someone like Warren Buffett, then you've got no business looking at an intraday, chart for what happened for one day. But if you're maybe a little bit more, I think a lot of traders tend to be a little bit ADD and hop around a little bit from stock to stock looking for the action, then you shouldn't be looking at what pays the best dividend. So it comes with, like a lot of success in the market, with understanding yourself personally and what works best for you. How much time do you have to commit to the market? Can you sit down in front of the market each day and be on task and pay attention to the micro movements and be patient enough to not just get emotionally involved because you're bored and I'm a trader, so I should be trading type mentality. So how much time do you have? How much capital do you have? How much experience do you have? No one should start out with day trading. Day trading is something you evolve, or some people might say devolve to. But because there's, the more often that you're confronted with having to make a decision in the market, the more often it is, the more likely it is that your emotions are going to creep into the decision-making process, and you're not going to be able to control yourself as well. So you start out, everyone should start out with a longer-term horizon, whether it's a couple months, or swing trading is really an ideal type of time frame because it gives you the opportunity to get feedback on your trades within a couple weeks, generally, and you can learn and hone in on things a little bit better. You don't have to be watching tick by tick. But if you are the type of person who, can sit in front of the machine and pay attention, control your impulses, and you've been successful on the couple month horizon, then down to a successful swing trader, if you can do that successfully, then you start to experiment with day trading. It's a great skill to have. It's not appropriate all the times. When you've got a choppy market environment, it's a great skill to have because it allows you to put some money in your account without exposing yourself to overnight risk where we might have a market that's gapping on a frequent basis. So it's a great tool. It's a skill. It's certainly not appropriate for everyone. And to start out just trying to day trade is something I would tell anyone that you're a fool if you try to just start by day trading.
Yeah, okay. So I think a lot of people who are probably quite new to trading are often attracted to the idea of day trading with the mindset that you're taking more trades, you can make more money than whether if you're swing trading, you might only take a few trades a week. Do you believe that you can make just as much money as a swing trader as someone who's a day trader? Like, is there any time frame that makes more money?
I think swing traders make more money than strictly day trades. All of the trades that I look for, I'm looking for a swing trade opportunity. I would ideally like to hold all of my stocks on for a few days to weeks. However, the market gives me new information throughout the day, and I have an opportunity to maybe lock in some profits or avoid a loss. So I will, the market will tell me basically it's not appropriate for me to hold. So I will day trade it instead. And I will say that I also tend to have a personality that lends myself to probably a little bit more day trading than I should be doing. But it's also kind of kept me in the business at the same time that I'm not willing to sit with a loser long enough to cause damage or to hit a stop that's 5% away when I can cut my loss at 1% because I see the handwriting on the wall. And that's just something that comes with experience.
Okay, no, that's a great answer. So, all right, Brian, well, this has been really, really good, but we should probably start to wrap things up. So let me just ask you one last question. And in your opinion, what is the reason for why the majority of traders lose money and never reach a high level of success? Why is there such a high turnover in this business?
Well, it's an extremely difficult business. Anyone that tells you that it's easy is lying, being misleading. It's a difficult business. You have to have capital to start, but there's no barrier to getting involved, let's say, as a day trader when from day one when you shouldn't. I think that people get impatient with the market. They don't find out who they are and what their personality and their appropriate time frame is in the market until after they've made too many big mistakes, so that they want to get involved in the market and they see it as the opportunity for a way to make easy money, when in fact it's extremely difficult. And it comes first with mastering yourself, or no one masters their self, but having a much better understanding of yourself. So I think it's impatience and then ego that when they get into a trade, and they see that it starts going against them. They start pulling up news. They start looking for other opinions. Their ego doesn't allow them to take that quick loser when they meant to, when they went in with a plan and said, I'm going to cut my loss here, but then their ego gets in the way and says, no, just buy a little bit more. It's definitely going to bounce, and they compound their problems. So not understanding their time frame and being impatient and not learning the mechanics of how the market actually trades, and understanding the psychology of the flows of money without before they start sizing up their positions and getting involved with too big a share size, or just saying, hey, I like Apple, so I'm going to buy Apple. Well, Apple's not always a buy. All stocks go through that cyclical phase where they go through a stage 4 decline.
Yeah, what a great answer. Okay, Brian, well, we've hit on a ton of great points during this interview. And again, thanks so much for coming on and sharing a whole lot of knowledge with us. This has been really good. Before you go, can you share with listeners where they can go to find out more about you?
Yeah, alphatrends.net, and StockTwits, it's at AlphaTrends. So you can find my book also on Amazon or technicalanalysisbook.com. And I'm pretty easy to find on the web.
Okay, great. And your book title is Technical Analysis Using Multiple Time Frames. So we'll put a link to that in the show notes at chatwithtraders.com/29. This will be episode 29. And you're also
congrats on that too.
Thank you.
On 29 episodes, yeah. Nicely done.
Yeah, one a week. We're not slowing down. So you're also on Twitter as well, aren't you?
Yes, at AlphaTrends.
Okay.
ALPHATRENDS.
Great. All right, well, all those links, of course, will be in the show notes at chatwithtraders.com/29. So you can go there to, get a recap on this episode and all the links mentioned to find out more about Brian. All right, Brian, well, again, thanks so much for doing this, man. Take care, and let's talk soon.
Excellent. Thanks again, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey guys, what's up? Welcome back to another episode of the Chat with Traders podcast. This is episode number 30, and thank you so much for taking the time to tune into another episode of the podcast. It's awesome to have you listening. Now, this week, we're taking things up a level. I had the honor of interviewing the legendary market wizard Tom Baso, president of former money management firm Trendstat. Tom started his working life as a chemical engineer, often discussing stocks and investing with colleagues. As he started to experiment with trading from a $2,000 account, there was no beginner's luck in sight. Tom consecutively lost money for the first few years before things started to turn around. With a series of events that followed, Tom went from trading his own money to forming Trendstat and managing other people's money. At the peak of his career, Trendstat managed $600 million of capital. And while Tom's now retired, he still actively studies and continues to trade. This week's interview covers many topics that range from trend following and systematic trading to psychology and why you must never forget to enjoy the ride, which is most important of all. Just before we roll into it, I'd like to highlight there were a number of challenges recording this interview. Firstly, this was recorded a few weeks ago when I was fighting through a cold, and we had some challenges with the audio equipment. And we also had to record this interview in two parts. Then just to top it off, there was a thunderstorm that rolled through midway. But I'm hoping you can look past this because the knowledge and experiences that Tom shares over the next hour or so is invaluable. All right, guys, I'm your host, Aaron Fifield. This is Chat with Traders, and here is this week's guest, Tom Baso. Hey, Tom, how are you?
I'm doing fine, Aaron.
Excellent. Great to hear. I mean, it's awesome to be speaking with you, and I must say before I go any further, thanks so much for being open to an interview and making the time to come on. It's really a true honor to be speaking with you.
It's totally my pleasure.
Yeah, so I mean, like, earlier this week I was going through, I reread your Market Wizards interview and I listened to a bunch of your interviews on Michael Coville's podcast, and they were all really insightful, and so I'm excited to hear what you're about to share with us today. And I mean, there's no doubt that listeners are going to take away a lot of valuable wisdom from this discussion. So just before we get into it too much further, for those who may not already be familiar with you, they might just be getting into trading or just starting to get into the world of finance, would you like to give us just a quick 30-second snapshot of who you are and kind of what you're most well known for? And then I've got a bunch of questions about where it all began for you.
Sure. I'm, of course, the former creator and president of Trendstat Capital Management. We had about a 28-year run or so. I started out as a chemical engineer and got into trading, and one thing led to another. First, I was trading stocks, and I got into bonds a little bit and traded a few options, and got into futures trading, expanded that to about 80 different markets in futures, and eventually got into currency trading, which is the bulk of our money at the end. But we still traded mutual funds and futures, and at our peak, we handled about $600 million of other people's monies. We are registered commodity trading advisors in the U.S. and registered investment advisors as well in the U.S. Shut that down in 2003 and enjoying retirement the last 12 years or so.
Okay, that's excellent. I mean, that's a really impressive way to kick this off. So I'm keen to hear how you very first got into trading and what was it that initially attracted you to the financial markets?
Well, what happened is, as a chemical engineer, I realized that there was sort of boom and bust in the United States in the economy. And every time there was a boom, they'd hire engineers, and every time there was a bust, they'd lay them off. And not wanting to get laid off and at least wanting to have a backup plan, I decided I'd better save some money as I was earning it. And as that got to be a little bit of a larger quantity of money, I decided I should do something with it rather than sticking it in the bank. And some friends of mine that were also chemical engineers at lunch would talk about the stock market, so that intrigued me, and we started a stock portfolio, and so I could participate in the conversations as well, and that led to an investment club where we ended up eventually running the club, and that ended up into a small investment advisory business, and teamed up with another couple fellas and got that going. That grew into a substantial size, and I eventually sold my share of that company and formed TrendStat. And TrendStat then was my way of trying to not only manage my own money, but manage my client monies as well. And we just kept growing that over time and evolving in complexity, number of markets, and so on until we became the success that we became.
Okay, excellent. So let me just take it back to when you mentioned there that you sort of started out as a chemical engineer. Were there any skill sets that you learned as an engineer which you applied to trading or had some sort of relevance when you sort of brought it over to the markets?
Yeah, the most obvious one that I have noticed over the years, and it certainly applied throughout my TrendStat years in the company, was something called process engineering. And what I refer to that as is one of the first lessons you learn as a chemical engineer is the old pipeline comes into a tank, the tank is full of water, and there's a pipeline going out of the tank. And you learn how different flows coming into the tank will fill the tank over certain amounts of time. And you'll learn that flows going out take water out over time. And when you have them coming in and going out at different rates, then you need to be able to calculate how much water is going to go up or down in the tank. And so process engineering in my mind always becomes stuff coming in, stuff being processed, and stuff shipping out. And TrendStat Capital Management was a perfect example of that. We had all sorts of downlinks and internet connections and everything bringing in data continuously, in some cases tick by tick. Then we were an operation that did nothing but process that information. So we had 40 computers and 10 people at our max that were just doing nothing but crunching a lot of data. And then there's the flow out, the orders, the communiques, the updates to websites, and all that. So to me, that was just process engineering. Bring in the information, process the information, ship information out. And the faster and better and more efficient you can do that, the better off you're going to be.
Yeah, okay, that's really interesting. So just still sort of sticking with that journey as you were starting out, if we were to zoom in on your first few years, what do you recall your experience being like?
Well, the first thing that comes to mind brings a smile, because the first few years, I would say, were pretty much losses and me making mistakes and just sort of wandering and trying to find my way. I looked at things like fundamentals, and I took several newsletters, and I read opinion after opinion to the point where I was totally confused. And I realized that sooner or later, a trader has to take individual responsibility for what he or she is going to do. And the only way you're going to do that is to simplify everything down so that you can say, this is how I'm going to trade. I'm going to take this data, I'm going to examine it or process it, and there's going to be a flow of orders that goes away from me. And when I do that efficiently and religiously and in terms of disciplined, that's where I'm going to be able to analyze whether that approach is working or not working, modify it if it's not working, improve it, and keep getting better and better as a trader. And so the first couple of years were actually losing years, and it required a tremendous amount of foresight, strategic knowledge, and patience on my part to just keep doing it, because it's kind of like, how many times do you want to beat your head against the wall before you stop? And there was certainly plenty of that in the first few years.
Okay, that's great, Tom. So I think it's fair to say most of us will probably never forget our very first trade. So tell us, do you remember your first trade, and how did that turn out for you?
I don't remember the specific trade, but I would remember that it was a stock that I bought, And I think I bought it based on somebody having a hot tip. I want to say it was Alcan aluminum, somehow way back when. And I realized well into the trade that I had no idea how this particular tip that I was given had anything to do with the financial well-being of Alcan aluminum, and that I had no idea how to get out of the thing once I got into it. I didn't even have the ability to chart it or do anything. So I just really felt like completely a fish out of water. I had no idea what I was doing. I realized it fairly quickly, and thankfully did not lose too much money on that one. I did lose, I believe, but I thought it was an interesting educational experience.
Okay, sure. And I mean, you touched on this sort of a little bit earlier, and I think I read this in your Market Wizards interview, but is it true that when you very first started, you actually lost money for 5 years consecutively, sort of one after another?
That would be referring, Aaron, to my commodities trading. I took about, I think it was the fourth year, perhaps, where I at least broke even. So I traded for, first year lost money, next year lost less money, next year lost less money, finally broke even, and it probably took me to about 4 or 5 years roughly to where I was actually producing a reasonable profit.
Okay, so I think there's a couple really valuable sort of notes we can touch on there. The first one would be, how were you able to lose money for 4 or 5 years, yet continue trading? And secondly, what was it that motivated you to keep pushing on and not to give up?
Okay, the first question is, in terms of how was I able to keep doing it, is I was a chemical engineer. I was actually at a day job. I was making good money. We were in great demand back in the oil embargo days in the 70s and 80s. And I ended up with a nice job, lots of promotions. I was highly ranked in my daytime job. I always got the best raise, the best promotion, and eventually had moved over into the business side of the chemical industry, and was still trying to advance down that road while I was trying to become a better trader at the same time. And because of that, I had cash flow, and because I always kept my trading very small, and as I was trading and losing small amounts of money, I was easily able to not only replace the losses, but to increase the size of my account, to improve diversification, to improve the numbers of volatility and risk controls and things that I was learning how to do at the early stages. Some of that just requires more capital, and I just worked real hard and tried to save as much as I could and keep adding to the account. And why I was able to keep going was that I saw that every year, when I looked back at the year and tried to decide what was going to, which direction am I taking in the future for the coming year, I could always see that I had made progress, that I had made less mistakes, that I lost less money, that I had captured more of the types of moves that I was trying to capture. And it kept me thinking that I'm on the right path, and I just need to keep refining it and getting better and getting more diversified and keep my costs down. And little by little, I finally got there. It took a long time.
Okay, good one. And just looking back on that time, of course, with the power of hindsight, is there any way that you feel as though you could have potentially shortened that learning curve from the point of first starting out to where you've reached a level of profitability?
Well, yeah, in today's world, I probably could a little bit, in that there's all sorts of, some of the brokers will give you free practice trading types of softwares and on the websites and things that would allow you to run tests that for very little or no money as an inducement to get you to trade your account through them. Interactive Brokers comes to mind, interactivebrokers.com, and but there's others too. And there's lots of software that you can either buy or use in various levels of sophistication that would allow you to test certain ideas out and cover a variety of data. In my days, I literally had Wall Street journals. I saved everyone religiously. When I did a study, it would be pulling out the Wall Street Journal day after day after day after day and sticking it on a piece of paper, because mini computers or microcomputers hadn't even been invented yet. So I'm doing this all by hand. I'm using chart paper to chart the things, and I'm running a study over a course of a couple years of data. It would take me an entire weekend to just try to run some idea on one particular market for maybe a few years of data by the time I was all done. And it just cumbersome and tediously boring and tediously slow to get it done. But I knew that once I had certain things done, that I could use that and understand what I was going to get on the good side and what I was going to get on the bad side. It also forced me as a trader to live in the moment of those trades day by day, in the data, in the historical data. So many times I think today traders have such fancy, sophisticated software that you can run 20 years of data against 60 different markets and you get some number at the end that says you made 12%. And there's no understanding of how that 12% was made in the detail. It's just the final page of the study that comes out and it gives you all these fancy statistics. You say, oh, I like that, I'll do that. But you don't live with the trades day by day and realize the types of things that could have happened intra-trade that you have to be able to psychologically live with. Well, because I was doing everything by hand, I guess good or bad, it was good that I ended up being able to really understand how a trade evolved day by day, because I was doing it all by hand. There wasn't any computer program back in those days.
Sure, that's really interesting. And like you mentioned, the Wall Street Journal there, was there anything else you were doing to sort of educate yourself on the subject of trading?
Read a lot of books, and we had our lunchtime crowd that would exchange ideas. Those were the two ways I kept expanding my brains.
And during this period up to your first maybe 10 years in the markets, were there any points that forever changed the way you approached trading, like any aha moments, realizations, or sort of hard lessons that will forever stick with you?
There was one that I talked to Jack Schwager about in New Market Wizards that is etched on my memory, and it involved the Hunt corner on silver way back when. I can't even remember the year anymore. I'm going to say it was in the 80s. And I was long silver, as I was supposed to be. And I had about, I think at that time my futures account might have been, I'm guessing between 70 to 100,000, right in there. It gotten to be a decent size account now, but it was relatively small. And all of a sudden, silver starts screaming upward, and I've got, I forget how many, like 4 or 5 contracts of this stuff. And I'm looking at my equity in my account, and today it's 125,000. The next one it's 150,000. It's 175,000. It's 200,000. It got all the way up to 500,000 on this one trade. And my account was going up and down 25 to 50,000 a day. As they got near the top, it got very frothy. And darn it, I'm a good trend follower at that point. I'm going to stay with this trade and let the trade run, let the winner run, cut the losses short. That's the rules. You got to do it. And I was just so disciplined about it. And by the time it got back to my stop loss point, which I had moved up and followed the trend, I ended up netting out about a $250,000 account out of it, and which on the surface of everything would seem to be, what's wrong with that, right? I mean, we started with 50 or 75 and we ended up with 250. That's a good trade. And it certainly was very profitable. But when I sat back at the end of it and I thought of the nerves that I had to put up with to live through that trade, I thought, wait a second. should I have really had 5 contracts or whatever it was throughout this entire trade, or would it have made more sense to have a proper exposure and to stay with the trade during the entire trade all the way to the end, but when the markets got insane, to hold less of that position so that as a portfolio, all of my instruments in the portfolio would have a somewhat equivalent ability to produce profit or to create loss, and they would be able to diversify each other a little bit. In this one case, the silver so dominated my portfolio that I might as well not even been trading anything else. And I thought that didn't seem right to me, so I started doing a lot of research on volatility as a percent of equity in my portfolio, and started from that point on creating the early stages of what Trendstat eventually very successfully used over the years, which was our volatility controls. And along with that, the risk controls evolved, and we used those at Trendstat as well, which was limiting the risk of the particular market to my portfolio and limiting the volatility that it contributes to the portfolio, both as a percent of equity. And I think once I had those two things in place, performance got a little more predictable, got a little bit more consistent. Profitability got, I think, strangely a little better. I guess it allowed me to put the proper number of contracts on so that one market didn't dominate the losses too much. But that led to, I ended up ultimately, even with margin as a percent of equity controls in a couple of instances in Trendstat, and we had the ability then to put together real portfolios that had real diversification, that had real abilities to have all the markets help contribute to the profits or losses. And that was a real aha moment to me because living through that silver trade, wow, there pretty much is a way to keep yourself up at night.
Something I just want to touch on that you mentioned there, and that was about volatility control as a percentage of equity. Can you just elaborate on sort of what you really mean by that, and maybe how this is something that other traders could adapt to better sort of manage their capital?
Sure, it's easy to do, and I'll give you the exact formula. It's take a market and figure out for one contract of a futures market, figure out how much the highest high of the day and the lowest low of the day is worth, is a range in dollars or whatever currency you're living with, in our case, US dollars. And you'll come up with that number, and that's its volatility of one contract for that market for that day. I would average, I use an exponential average, but you can use whatever you want. It all works similarly. I'd use a 20-day average of that daily volatility. So that gives me sort of the last 20 days of how much is this thing moving up and down. Is it moving up and down per contract $1,000? Is it moving up and down $200? Is it moving up $500? Whatever it is, it's just telling you that this is how much this thing has speed to it. It is going to dominate, it's going to contribute when it's going your direction that much per day, and it's going to potentially hurt you that much a day if you're in the wrong way. Once you have that number, then I just divided it by the dollars of equity in my account. So let's say you're trading $100,000 and that particular market was moving highest high to lowest low, it would be maybe $1,000 in any one day. Well, that one contract would then have a 1% volatility to equity. 1,000 divided by 100,000. Now, what I used to do, and I can't even remember the numbers now, it's been so long, but we used to set at Trendstat for some 80 different markets we ultimately traded. Each market would have a very specific, by how we were trading it, level of volatility that it would be capped at, and we would never let it get above that. So every day, the computers would take in the data, recrunch the 20-day moving average of the volatility, recrunch the equity that we now have because we either made money or lost money today, so the equity's changed, come up with a new percent equity for percent volatility to equity of every single of the 80 markets. It would compare them to the allowed limit of each of those markets, and it would give us a set of orders to peel off markets if we ever had any that got over the volatility level. And we would just sell them off at market the next day.
Okay, excellent. Thanks for sharing that with us, Tom. That's really good.
Mm-hmm.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Something I'm keen to ask you about, and that's kind of your mindset and where you were at sort of in your head during your sort of 20s when you were getting into trading there during those early years. Did you always envision yourself as reaching the high levels of success that you were able to achieve? I'm always interested to know if you like had that long-term vision and a long-term goal that you were sort of working towards. You knew where you wanted to get it. You knew where you wanted to get. It was just a matter of how you were going to get there. Like, did you always picture you would reach the massive success that you reached later in life?
I didn't even picture that I would be a professional money manager when I started out. I was a chemical engineer. I was simply looking for a way of trying to manage some money on the side, and I assumed that if I was successful at running my own portfolio, I perhaps could retire a few years early from being a chemical engineer. But I was happy at the early stages being a chemical engineer. I was paid very well for it. Chemical engineers, when they came out my year in '74, were one of the highest paid engineering disciplines because of the oil embargoes and everything. So life was pretty good for a young single 20-something that's making more money than he's spending, and it's piling up in his account, and he is learning how to trade, and I just assumed it would be a side portfolio and that I would somehow be able to increase my net worth, and I'd have the backup in case I was ever laid off, and life was good. Little by little, what happened was, as people found out I was having some success with my own portfolio, the investment club evolved into sort of, hey, why don't you do what you're doing for yourself with some of our money? That led to a certain limit on the number of people I could do that for before all of a sudden now you've got it registered as an investment advisor, and then running into two other friends that ended up getting into the investment advisory business with me, and little by little things I still figured we'd just do this on the side and do it part-time at night or on weekends, and it'd be a second source of potential income. But it was still just a way to manage the money and defray the expenses of taking all these services, and the cost of registration in the U.S. is, there's some money involved in that. And what ended up happening, much to my amazement, is on a part-time basis, we ended up making enough money off of our business to where we could pay one salary full-time. So I said to my two partners, I said, you guys have kids and all that, and you can't really travel. You're tied down a bit more. I'm still, I don't have any children. I got a lot of flexibility. How about if the company pays me my salary that I'm making now at the chemical company, and allow me to leave and open up the offices, and let's take this serious and make it a full-time, successful business. They agreed. I left, started everything, started traveling and meeting clients and putting business on the books and creating computer systems and hiring secretaries and signing office leases and doing all the things that you have to do. And one thing led to another, and pretty soon I got the second partner out, and before long the third partner joins us. We add more staff. The whole thing becomes a wild success.
That's excellent. So let's get into that a little bit deeper about once TrendStat was formed, and talk to us about how you were trading at TrendStat. I believe that it was a totally systematic sort of operation. So can you just sort of shed some light on that topic?
Yeah, TrendStat really, the name of the company was coined by myself, and it's just the trend following statistics. Abbreviated to TrendStat. STAT is statistics, and trend is the trend following or trend of the markets. And I felt like if you could just take and collect lots of data on lots of different markets, determine the trend, and then always position the portfolios in line with whatever that trend was, that over time there were going to be large movements, large trends that ended up paying your way for the most part. A good statistic that I would cite was in the first year at TrendStat, I did an analysis of where we made money and where we lost money, and I actually ranked the trades from the most profitable trade during the year to all the way down to the largest loser of the year. And we were running about 30-something% reliable in terms of our trading. That is to say, 30% of our trades would be profitable and 70% of them would be losers. But it turns out that one year, 2 trades that were so largely profitable that if you had not gotten those 2 trades in your portfolio, you would have broken even for the year. That's how lopsided it was to the 2 trades that ended up being so blockbuster and so unbelievable that you had to have them in your portfolio. If you didn't, you were just going to break even that year. That got me thinking, I've got to make sure, with no excuses, that I always get every one of those 2 or 3 large trades every year that are going to be there for the most part over time, and those are going to be what's going to pay the way. And the rest of it is a whole bunch of hard work to get nowhere. And that was really what led me to the kind of just expanding the number of markets that I traded, because it put bets, if you will, in more markets, giving you that many more opportunities to catch that 1 or 2 in those particular markets. And I never knew which market ahead of time or which trade I was making was going to be that big winner, but I wanted to make sure that I had as many chances of catching them as possible. And so I just kept buying more and more computers, and we had at the peak, including myself as an engineer, we had 3 full-time computer experts that were doing everything from programming to hardware to keeping the networks running to backing things up to backup facilities off-site, all sorts of things. And it just became a data processing facility, really. A lot of people used to think of me, and still do, as a trader, and yet a lot of times when I was in the middle of Trendstat, I was thinking myself as the president of this data processing company more than I was a trader. I realized, looking back at it, I definitely was a trader. I had to create all these programs. I had to tell my programming people what I was trying to go for, and that was being a trader. But if you woke up and followed me around all day, you'd kind of be wondering how would anybody think that I was a trader?
Yeah, I think that's really interesting, actually, how you sort of mentioned that, and you sort of almost called yourself or the company just the data processing hub, pretty much, instead of a sort of what you typically think of when you think of a trader. I think that's quite funny. So generally speaking, was there any human interaction with the trading systems during a typical trading day at Trendstat there?
No, there was zero. What we did was we built lots and lots of computer programs that we would take data in. We would run the programs once a day against that data, and then decisions would be made by the algorithms that we had built into the computers, and prints would come off, and the human beings would just scan it to look for any kind of computer malfunctions or data malfunctions or anything that looked strange to anybody. Because that would be the last chance we would have to catch an error that maybe of our computers through our poor programming perhaps might have created. But once we knew that everything looked normal, the data looked normal, the data passed all the data checks that we did, the orders were created, hit the button, and out they go. And all of that was automated. The only thing the human beings would have to do is start the process to run the orders, visually scan them to see if anything looks strange, and hit a button to transmit them all. That was the only thing the humans did.
Okay, sure. So Trendstat was sort of in full effect during, I think it was sort of the 90s. Is that correct?
Yes, in various stages.
Okay, so during that time period, was this approach common amongst money management firms, or was this quite sort of new to the space of money management, this sort of systematic and automated approach? Was the technology that you were using reasonably cutting edge for the time?
I would put it this way. I would say that cutting edge would mean very different things to different people, I think. If it was at all cutting edge, it would be sort of us trying to take a longer-term trading strategy across a lot of markets and automate that process. I do believe that during the 90s there were automated traders out there, but they were probably doing more intraday trading and what would you call straddle trading, pairs trading, those types of things. It seemed like a lot of the automation was concentrating more on the very short term, and we were just the opposite, concentrating on fairly long term, but doing it in a systematic way. So we were probably unusual in that regard.
Okay, sure. And I mean, I probably should have asked this a little bit earlier, but what was the initial appeal that attracted you to a systematic approach?
That's a good question. I would call it laziness, human being laziness. When I was doing my initial work and I had to have my chart paper out and burn my eyes up every night trying to go through all what the markets did and put in my new data and figure out where my orders were and then create some kind of a fax and then ship that to the trading desk and have them put my orders in for the next day. It was a lot of work. And I realized when personal computers came out, and I was an engineer by background and I knew how to program, I thought, well, why don't I get me one of these things? And I'm just going to program the ability to put the data in and pull it down from someplace and program the computer to do what I do every day. And then it'll generate a set of orders, and then maybe I could print them out and put them in the fax machine. And later on figured out that there's these things called fax cards that I can, take the print and take it right to the fax machine and out to the order desk. And little by little, I kept eliminating my jobs. And I developed this philosophy of a human being can do something every day. There's two forms of human endeavor, so to speak. There's the artistic, creative side, which I think everybody loves to do, the artsy side, the inventive side. And then there's a lot of things we do as human beings that are just stuff that a machine could do. And it's just very repetitive and doesn't require any unbelievable brain behind it, in that if you can put down in a rule-based way exactly how you're doing what you're doing, then you can have a machine do the same rules. You just have to program it into the machine. And so what I try to do at Trendstat is keep everybody as much as possible working on the creative and inventing side of things, and let our computers free us of the drudgery of every day. That was the philosophy.
Okay, sure. No, that's excellent. So, I mean, kind of, you've talked about your systematic approach, but your actual trading method was, from what I believe, was very much based on a trend following kind of strategy.
Yes.
So, I mean, what was it about the trend following approach that you adapted that just meshed with your personality so well? Like, what are some of the key benefits to this approach that you saw?
Well, one of them was that a lot of the major mutual funds and brokerage firms constantly kept saying it can't possibly work. And yet I'd seen people of notoriety that had successfully traded along those lines. In addition, it was mathematical. In addition to that, it fit me because it was more long-term in nature, as opposed to trying to worry about what happened the last hour in the market. And I was a busy guy. I didn't have the time to mess with what happened in the last hour. I was, in the early stages, I was still working as an engineer, trying to do stuff on a part-time basis, trying to get an MBA, trying to build a house out in the woods that I custom designed myself. And there was a lot on my plate in my 20s and 30s. And I just really felt like I had to try to be very efficient about that. And trend following was a way of making sure that I always captured every major trend. And as I told you before, previously, in some years, as little as 2 or 3 trades would be the difference at Trendstat between making money that year and breaking even. So you had to capture every one of those big ones, and trend following would always mathematically capture a very large move. It couldn't fail to do that. And that gave me that reassurance that that's what I was going for. All this other stuff that you do every day, little losses, the 2/3 of the time that you lose money, that's all a lot of work to get you nowhere.
Yeah, and I mean, while we're on the topic of trends, do you find that the structure of trends has changed from, say, I don't know, 10, 20 years ago to how they are now? Like, is it fair to say that trends might have been much cleaner cut back then, and in today's market, the trends tend to jump around a lot more?
It could be. I frankly haven't taken the time to try to do that kind of analysis in the recent years, and I have been retired 12 years, so I would say that, yeah, there's some choppiness out there, and a lot of it could be driven by shorter-term computer action. But the way I like to think of the trading world that I have sort of observed over the last 3 decades, probably, almost 4 decades now, I guess, I think that the use of computers has sped up everything. So in the days when, that's lightning and thunder out our window here, in case you hear it in the background.
All right, yeah.
A little monsoon action in Arizona today.
All right.
I think the whole world in trading can now move, say, a few billion shares, where they used to back when I came out of college in '74. A really good day at the end of the 73-74 bear market, which lasted 2 years, was 10 million shares on the New York Stock Exchange. To put that in perspective, SPYs trade hundreds of millions of shares all by itself. One instrument trades literally 20, 30, 40 times the amount that the entire New York Stock Exchange traded in '74, because they were doing it all by hand. There was tickets, there was telephone calls, there was a lot of running around and very inefficient approaches to doing everything. So now you can do all that a lot faster, and you can even tell your computer to make the decision faster, to transmit it faster. Everything's sped up. So the way I like to look at it is, I don't know that the trends have changed all that much, but they probably happen a lot faster. So to me, what constitutes a full trend? It's kind of like a large cycle of human psychology when it comes to investing. There's the I don't want to ever get into the stock market again stage. Then there's the stage where stocks start going up, but I don't trust it. And then they go up a little further, and I don't know, maybe I should get into this. And then you start hearing about it at cocktail parties, and you almost have to buy it at that point. And by the time you get around to doing it, it's actually at the high and about ready to reverse that psychology and go the other way. Well, now a lot of that psychological shift from depression to euphoria seems to happen a lot quicker. We have telecommunications, we have, blogs and all sorts of news coming to our phones. So we know what's the latest on the Greek crisis and what is the prime minister going to say. And there's 25 people analyzing what he's going to say or what he's not going to say. And it's compressing. In the old days, you had to wait till the Wall Street Journal showed up to get some of this stuff. Nowadays, everything's electronic. Everything can react quickly. So I don't know that trends aren't there as much as the speed of those trends and the psychological changes that go through the market happen a lot faster, I think, than they used to in the old days.
Okay, sure. That's really well said, Tom. When we were initially speaking by email, you'd observed that there is an obsession, or seems to be an obsession, with predicting rather than being in the now amongst many traders today. Would you like to expand on this? I mean, I feel like you've got some interesting insights to share on this topic.
Well, yeah. To me, I get asked a lot, even at friends, parties, whatever, that people find out I used to be a trader. And we start talking about investing. It's something that affects almost everybody. And you'll get on conversations about, well, what do you think is going to happen to the dollar? What do you think is going to happen here? What do you think the government is going to do here? And I can carry on an intelligent conversation on economics. I used to have to pretty much know what countries were doing with their currencies, and I'd be fairly well read on that, if for no other reason than during a client interview where some major bank is trying to hire me to manage their currencies, that I can speak intelligently about various economies and at least appear, even though it has nothing to do whatsoever with my trading, to be intelligent and knowledgeable about various economic things that are going around the world. And I've continued to do that. I've followed this whole Euro thing and the Greece thing with fascination, because in 1997, when people were interviewing me, I absolutely 100%, with no punches pulled at all, said that the euro is a dumb idea and it will never last long term. It cannot. You can't base all sorts of different political systems into a single currency that's based on a whole bunch of different balance sheets. It won't happen. Somebody's going to cheat. Somebody's not going to pull their weight. Other people are going to be getting the shaft on it and having to pay for the people who aren't doing it right. And that's what you're seeing now. Germany, some of the German people got to be getting fed up with the attitude of places like Greece and Italy and Portugal, Spain, and other places that seem to be, socialist and debt-ridden and don't seem to be able to get their act together at all, financially speaking. And how long are you going to run that until you just say, I've had enough? And then you break it apart again. So I've always thought it was a dumb idea. Well, the prediction of that is all good and fine, but in reality, to trade, all I care about in trading is what should my portfolio be positioned this moment right now, period. Nothing more than that. You don't know what tomorrow's going to bring. You don't care a whole lot about what yesterday brought, because that's already gone and never coming back. You really need to concentrate on looking at your portfolio And I've heard Paul Tudor Jones say this on occasion, where he likes to start each day assuming that all his positions are wrong. Like he's starting all over again, and he's reanalyzing where does he want to be right now. And if he assumes that everything's wrong, he's critical then about every position. He tries to decide, no, I do like that position. I want to hold it on again for another day. I think that's trying to force himself to be in the now, and that's a good thing. It's the only thing you have the control as a trader of doing is buying or selling right now. You can't buy it 3 weeks from now. That's not going to, there's no point to that.
Yeah, that's a really good point. I'm glad you brought that up, Tom. That's excellent. So something else I've heard you talking about in sort of past interviews, maybe this was on Michael Coville's podcast, but you were talking about a coin flip concept. And what you were referring to was sort of how entries are less important than sort of money management and good risk management and exits.
Yeah, I did the random study. I just took the computers and I had them create a random number generator. And at the end of every day, if I didn't have a position in any one of, like, I forget how many markets, I think I did 8 markets. Somebody else in Austria replicated it with 20 markets. It came out the same. In fact, they might have even made more money than I did. But we were all slightly positive, not robustly positive, just slightly. But what it came down to is the same concept I mentioned already. If you trade all year long, and 2 or 3 trades are the difference between making a very nice profit versus breaking even, then you must be in on those trades someplace. And then once you get in on those trades, you need to let them run and mature and bring you those very large profits that you seek. A random number generator that just simply says, okay, I don't care which way I go. Markets could go down a lot, they could go up a lot. I'm just going to flip a coin. Whatever it says, the next morning I'm going to buy the open or sell the open, as the case may be. But once I get that new position, I have to try to assume it's the next really, really big winner that I've got. So I need to trail my stops at a logical level, give it enough room to move, to be safely restricting the risk, but at the same time giving it room for normal movement. So things like average true range, things like breakouts on charts, all of those types of things, depending on how sophisticated you want to be about it, could come into play to give the market normal movement, but to allow that profit to keep building and building and building over the long run for that one trade. As soon as it hits that stop, that tells you, well, that trend was not the one you were looking for that major, that major trade that would pay its way, pay the way for the portfolio to be successful for you. So what you'd end up with is you'd be out of the market and flip it again. Well, random number is going to give you 50% of them are going to be buys and 50% are going to be sells. It isn't going to be long until you're going to match up with that trend. When you are on that big trend, that's going to make all the money for you. And that's how you're going to make the slight amounts of profit for the year. You're going to have lots of losers, you're going to have some gainers, and you're going to have 1 or 2 or 3 very, very large gainers. And those are the ones you have to be in on, and a random number generator will give you those.
Okay, sure. So I'd like to move it along a little bit now and sort of touch on the subject of psychology. And I think I could almost quote you saying from other interviews that psychology is probably the most important aspect of profitable trading. So why do you believe this to be the most important aspect?
All right, well, I would say good trading falls into 3 different things that have to happen. The first one, which everybody spends all their time on, is the buy-sell decision. You have to have a way to say, this is how I would buy or sell a market, a stock, or whatever it is that you're trading. Secondly, you'll have to answer the question of how much should I buy and what types of instruments should I buy. I call that whole area the sort of portfolio management, risk management, volatility management area. And you have to be successful at that too. The third area, and the most important one in my opinion, and the one that a lot of people spend the least amount of time thinking about, is your own psychology. Because you as the human being who ultimately, even in the case of fully automated Trendstat back in the day, I had the power as the owner of Trendstat to go in and pull the plug on the computer or override it or do whatever, because I owned the company 100%. So if my psychology wasn't in good shape and my knowledge of what we were doing comfortable with what we had created, then the first time I go through a drawdown, I'm going to start second guessing myself and all those computers, and I'm going to start telling my computer staff, oh, we need a whole new way of doing things, and let's go research this latest hot strategy that seems to have made 50% last year. And I could go buy black boxes or build black boxes, what's the difference? And keep switching and trading and fail time after time after time because my psychology wasn't right. So even though I was automated, you still have to have a good, balanced mind about what you're doing. Trading, like for instance, a good example that I've heard Dr. Van Tharp talk about, good trading is following your strategy that day. It is not whether you made money or lost money that day. It's simply following your strategy. And that's a very profound thing. Hit me a long, long time ago when I heard him say that. I thought, yeah, that's perfect. That's exactly what I do every day. And that's why he and I worked together a few years at least. I helped him out with some seminars he was doing, and I found it fascinating to meet a lot of people around the world, and we had a good time doing them until my schedule got so busy it got unreasonable to do them anymore. But that was a very succinct and smart way of putting it. Good trading is following your strategy. It's not, good trading isn't making money and bad trading losing money. Good strategy development is what you need to do. Once you have that strategy, you need to follow it and to actually execute it. And the time to change your strategy isn't at the heat of the moment, halfway through the trading session when your particular position is going against you by 3% and you aren't sure whether you should pull the plug on it or not. You should have already figured that out, and it should be just blindly done. And when you're out of the position and the markets are closed, if you want to sit back and think about what just went on and try to come up with a better way, all good and fine. I'm not saying anybody shouldn't be constantly striving. I was sitting here, one of the reasons I called you a little bit late today was I got completely mesmerized by some stock research that I was doing. So I still am doing it here at 62 years old, retired. And I think you have to keep working and getting better, but you have to stick to whatever it is that you're coming up with unless you can figure out a better way. And I think a lot of people don't do that. I think they pull the plug on it or they buy the black box and 6 months later they throw it out and they change everything they're doing, and they're adding so many layers of filters. I've had people at Facebook give me a message and ask me questions, and I'll say, well, tell me what you're doing and I'll see if I can react to it, and I'll go into this involved explanation of all the different filtering this, and they only do it if the ADX is that, and on and on and on and on. I'm wondering how they ever get a trade to happen. They get so many filters in the thing. They're trying to achieve perfection. And it's so complicated, it's probably not workable, and they're likely to miss those 2 or 3 very large trades that are going to pay the way. And because they filtered those trades out somehow. So I encourage people to really understand their own mind. I think some people are a little more cut out for trading than others. I think that sometimes extremely cerebral, highly intellectual, they view themselves as smarter than everybody else. They're brilliant. They sometimes have a hard time with trading because they just know too much. And some of the best traders, if you look at some of the floor traders, the people that have come off the streets that really didn't know a whole lot about investing at all, certainly don't have the MBA or anything, but they're successful traders because they find something that works and they stick to it, and they don't let the markets beat them up, because they don't really have that mental side of them that wants to analyze and theoretically understand everything out there. They just want to make some money and go home, and so that's what they do. And so it's something to think about. Everybody needs to study their own psychology and try to ask themselves, what could they be doing to balance themselves out more, so that when they're doing actual trading functions, that they can stay in the now, they can analyze where they want to be fairly unemotional about it, and react quickly. That's really what good trading is. And that's psychology. And the first two, you can do all the work you want, but if you don't have the psychology, you'll never execute those first two.
Yeah, that's an excellent answer, Tom. Very, very well said. And when Jack Schwager interviewed you for the Newmarket Wizards, he actually dubbed you as Mr. Serenity because of your cool, calm, and collected style of trading. So, I mean, how were you able to actually achieve this and maintain this evenly keeled mindset, even through times of drawdown?
I've asked myself that question a number of times, and the only thing I can think of that seems to play in my mind about history and, my life looking back is that I was so darn busy doing so many things that didn't involve sitting by a phone or in front of a quote machine. And I had so many varied interests that were outside the markets. I've run into people that in the middle of the night wake up and they want to see a quote machine down by their bed and to know what the euro's doing tonight, or weird. That's obsessive to me. I like golf. I'm going to cook dinner tonight. I like helping other traders. I yesterday was pruning my front yard. I love to do sort of an Italian landscape scheme with everything's flowering. I hand prune all my bushes and trees and do it myself. And there's so many things for me to fill up my day that trading just becomes sort of one of the many, many things. And by doing that, it sort of removes the attention to my conscious brain of all the different pre-crisis is doing this, and oh my God, gold's up $10, and all these different things that go on that could capture your mind and all of a sudden pull you down some kind of a psychological hole. Because I was so busy, because I allowed the computers to do their things, because I spent time programming those computers to do what I wanted them to do, and I knew they were doing that, it sort of gave me that peace of mind to, wonder what I was going to cook for dinner that night, or something else, or concentrate on my golf game, or have fun vacationing someplace. I didn't have to be obsessed with every day, read the paper, read the quote machines, look at the charts, agonize over everything. That's where I think a lot of traders, including Jack, I believe, back in the day when he interviewed me, he was very caffeinated. He New York, fast, go-go personality, constantly, driving, and a lot of the market wizards that he interviewed, some of which aren't around anymore, were pretty fast, high-risk guys in the end, and some of them blew up and didn't make it over the long run. By comparison, I was pretty boring, but where I was unusual was the kind of the systematic, keep it simple, don't get stressed out over it. I think that appealed to Jack in a way because he sort of wanted to adapt some of that for himself. He was just the opposite, and I think that he found it appealing in a way. And that's probably how that chapter got written somehow. But it was a fun process. I enjoyed Jack. He was a great guy.
Yeah, and just to elaborate on that, also during the interview with Jack, you spoke about viewing your life like a movie. So what did you mean by this, and how does this have a positive impact on your life, and probably more specifically, a positive impact on your trading?
If you watch a movie, you think about a movie that you've recently gone to see, the scene that is up on the screen right that moment is always going to be the now. So you are allowed to, guess where the plot's going, You might guess right, you might guess wrong. It's kind of like the markets. You might think it's going to go up more, but it might not. But you know what you're looking at right there, because it's on the screen right now. If you pay attention to right now, then you can enjoy and allow a horror flick to horrify you, or an emotional film to make you cry, or a comedy to make you laugh at that moment, because you paid attention and there was a joke there and you said, that's funny. Okay, so your emotions can go all over the place, but you aren't attaching yourself. You know it's a film. It's there for entertainment. You still have your own life, your own beliefs, your own everything inside you. So I like to think of the markets and life as sort of a movie. And you kind of know which way the movie's headed, sort of, but life throws you a lot of unexpected turns, so do the markets. And I think you just have to, kind of look at it and say, okay, that was interesting. Now, what are we going to do now? And how do you react to it? And what was your strategy supposed to do during that new information or new change in the conditions? And I think it keeps you a little bit separated emotionally from the actual trade, to look at it as a movie, than to feel like trading is your life and you're surrounded by it in every way you turn and look. The market, you wake up and you go to the market and you're checking the market before you go to sleep, and you got your phone in front of you all day long during lunch. You're not carrying on conversations with people because you're worried about what's happening with the euro. And that to me is not watching a movie. That would be kind of losing yourself in the middle of the movie.
Yeah, I like that concept. I found that part of the interview really interesting. So, I'm glad I sort of brought that up and got you to share that with the listeners. I think that's really interesting. So it seems like you've made a conscious effort throughout your years as a money manager, and even still to this day, during retirement, that your way of trading was designed to fit the lifestyle that you wanted to live, and not the other way around.
Yeah, I think a lot of people, again, Facebook and Twitter and all that, I must have like 1,000 something people that follow my Twitter stuff that I put out every now and again. It really started out as me trying to help out my stepson and my brother-in-law know which way I was putting my hedges on and taking them off, and it grew from there to all sorts of people signing up like it was a free service on which direction the market's taking lately or something. So, but I get a lot of calls and messages from people about how they view how do I trade? How does Tom Basso in his retirement trade? And I hate to be rude, but I feel like saying to him, why do you care? You should be designing what you do for you. Why would you want to do, I have a different net worth, I have a different expertise level, I have different computer equipment than you do. I may have different legal restrictions in terms of the markets I can trade. Some people live in India and they're asking me questions. I have no idea what the Indian stock market looks like, or what the regulations are, or what the brokerage conditions there are. Never ever traded an Indian stock, don't plan to lately, unless something changes. I just don't know anything about it. So why are you trying to apply what I'm doing to your life? It'd be better for you to be developing what it is that you want to do on your own. And that's exactly what I've done. I'm in retirement. I do spend a little time trading every day. Some days like today, as I just mentioned a while back, I got immersed in a little bit of stock research because I had some ideas I wanted to explore and think about. I didn't come to any profound conclusions, sadly, but it did certainly burn up a couple hours of my day. And nothing's changed. Tomorrow I'll do the same thing I did today in terms of trading, but it gives me some pause to think about it and all that. But I'm designing something that I can manage myself, that I can go on vacation and take my PC along and maybe spend 20 minutes to a half an hour a day. That's the most on a vacation I'm willing to part from the vacation. If I can get it all done in a short amount of time, they have an internet connection on a cruise ship, let's say, or wherever, I can get my job done every day, continue to trade my strategy, and it's designed around having me be able to do that. And I find so many people looking at systems and strategies that, man, they have full-time jobs, and I'm thinking, how are you going to do that with a full-time job? You're supposed to be out there talking to customers or building widgets, and how are you going to be able to focus and pull it off? You're going to miss trades. You don't have enough capital to diversify it. There's lots and lots of problems you see right out of the gate. The biggest thing I find with a lot of people is capital. They want to start from nothing, and they'll tell me they've got $2,000, and how do I start trading futures contracts? And I kind of scratch my head on that one, because I have to admit, I started with about a $2,000 or $3,000 account, had no clue what I was doing, and I'm sure glad that I figured it out, because I ended up losing money for 4 years, and it took a long while to get to where break-even occurred. But as I got larger in size, more diversified, and got better risk control, volatility control, it all came together. I think trying to do all that with $2,000 is just mathematically impossible. So people are undercapitalized, they don't have a knowledge of what they're facing, and I think it's sad that they aren't thinking through what should they be doing to design something for them. If everybody listens to this broadcast and could just sit back and say, how could I make my own trading strategy my own? Make it exclusively mine, make it fit my lifestyle, my capital, my resources, my expertise levels. They're going to be so much more capable of hitting that psychological sweet spot of being able to stay in the now and do what they need to do because it's theirs. They don't have to worry about what Tom's doing with his stuff, or what Michael Covell's doing with his stuff, or Jack Schwager with his stuff. It doesn't make any difference. It's only important what I should be doing with my stuff. And I think that's what, if everybody could get that one thing out of this interview, I will have done great service to mankind.
Yeah, absolutely. No, 100% agree with that. And from listening to you in various other interviews, it's clear that you're a big believer in taking full responsibility for all aspects of your life. So I'd love to hear your thoughts on why you feel so strongly about this.
It's empowering, basically. Once I figured out that if I, through trading, was responsible for everything, including, I believe I told you earlier about the tip that I started my stock trading on, and it ended up being a lousy tip, and I had no idea what I was doing, and I blamed the guy that gave me the tip and blamed the company for not doing what it should be doing and everything else. But that's not empowering at all. You have to say to yourself, no, wait a second. I'm the one that called up, put the 100 shares on. I'm the one that's responsible. I'm responsible for figuring out what went wrong there and what would I do to make it better next time, and developing trading strategies. It's all on me. Nobody else is going to do it. Nobody else is responsible. The market is going to go through large ups, abrupt downs. It's going to have a lot of noise at times. It's going to be dull and boring at other times. That's what markets do. You can't blame the market for your problems. You got to take it on yourself and say, what can I do to deal with all of what mankind's going to throw at me over my lifetime? And when you answer that question, you'll be developing a pretty good trading strategy that'll suit you. And I think, sadly, around the world today, and Greece is in the news, there's a good example, Greece is not taking responsibility for their own mismanagement. So there's this tendency amongst a lot of various factions of society today to either blame somebody else or to expect somebody else to take care of some of their problems. There's less and less self-responsibility in society today. And I don't think that's leading us in the right direction at all. It seems to me that we're getting lots of governments around the world in trouble financially, more and more defaults. Argentina's not looking too good. Venezuela's a disaster. The United States is spending way beyond its means. We're just a little bigger and stronger, and so far so good. But this whole thing starts caving in, I don't know how the world reacts to that. It's going to end up being pretty messy because there's a lot of governments around the world that are going to be in trouble financially. And when people just stop giving them money through government bonds and loans and things, or they deflate or inflate their currency by just printing too much of it, the people are going to suffer in that country. And it's going to get nasty if people don't take responsibility and get the job done. So I think that's the whole thing about self-responsibility to me, is it gives you a little bit of that peace of mind, in that you have the ability to do something about it instead of having life kind of throw things at you and you kind of react to them and feel like life is throwing you hard turns, and it's this guy's fault for not giving me that promotion. It's that guy or that woman who cut me off today that caused me to veer off the road or whatever. I mean, if you try to take responsibility for everything that happens, then you're going to be a little bit better at reacting and doing what's necessary to lead your life in a good way and make positive contributions to society, make positive contributions to your trading strategy. All of those things are going to be enhanced by self-responsibility.
Yeah, for sure. I mean, you touched on so many great points there, but Tom, we should probably start to wrap things up here, but let me ask you one more question. And you like to say, enjoy the ride. You often end tweets with this and these three words. And while they're very simple, I feel like there's a deeper message here. Would you mind sharing that with us? And what's the significance of this phrase?
Well, the significance of it is sort of a philosophical one. Life is like a ride. You get your ups and downs and unexpected surprises and all that, and in the end you're dead. So you might as well enjoy the ride. I think people make too much of some things. I know all sorts of traders that can't quit because they're so addicted to it. They identify themselves as traders. They don't identify themselves as human beings that are fathers and husbands and neighbors to other people. They instead are just immersed in this thing called trading. Or you could say the same thing about people who are teachers or people who are, salesmen, people who install shades and blinds. There's all sorts of examples I can tell you about that I have friends that are well past normal retirement, but they just can't stop doing what they're doing because they identify with that. They haven't created an identity for themselves, outside of that. And the enjoy the ride thing is just basically to look at life like a movie, enjoy the ride. Just like most movies, there's unexpected twists and you laugh and you're emotional, and you should be able to enjoy all that because life's short, and why not do that? There's no point. There's no point to doing anything other than that, really. And I think the ups and downs of the market, when I usually get a signal change and all of a sudden people, I end it, enjoy the ride. It's like today we had the down signal come in at the time we're doing this interview. And it was just midday and I saw the hedges go on. So I got on Twitter and I put it out to everybody, and I get 5 new people following me, and it gets shared all over the place. And it's kind of weird from my standpoint. But in reality, I had a down day today monetarily. I didn't go down as much as the market did, so that was good. I guess I buffered a little bit of risk. If the market continues down, I'll look really good. If the market turns around tomorrow and goes up, I'll look stupid again. And that's fine because I'm enjoying the ride. I'm going to go, work on a beautiful dinner for tonight, and I'm going to enjoy myself during the evening, and I'm not going to think about it a lot. Tomorrow I'll do the same thing again, and I'll continue to enjoy the ride.
That's excellent, Tom. Again, awesome advice. So, well, this has been nothing short of incredible. And like I mentioned earlier, it's a true honor to be speaking with you. So, again, thanks so much for coming on the podcast today, Tom.
Oh, my pleasure.
And before we let you go, do you want to share with listeners perhaps where they can connect with you on and maybe your Twitter handle?
I'm at Basso, Basso, underline TOM.
Okay, good one. We'll make sure to put a link to that in the show notes at least.
The way to get a hold of me is actually on Facebook. Just put in Tom Basso, TOM and BASSO in Scottsdale, Arizona. There's only one of me.
All right, excellent. And we'll put a link to your Facebook profile as well, so people can connect with you on there. That'd be excellent.
Probably on Facebook, because my new granddaughter gets a lot of photos on Facebook, it seems. I'm probably on there more often than I am on Twitter. Twitter is linked to that. If I do a tweet, it automatically goes to my Facebook page, but it doesn't go the other way around.
Oh, right. Okay, it's all connected.
I tend to stay on Facebook more than I do. And the other thing you could always do if somebody has an involved question that's a little bit beyond normal messaging length, I've had people use the same old tom@trendstat.com, which is my old email address from back when I was still in the industry. I've kept the URL. It's still active. So TOM@TREND for trend following and STAT for statistics.com, Trendstat.
All right, excellent. Thanks a lot for sharing that, Tom. I'm sure some listeners will definitely have a few questions for you. So thanks a lot for offering that.
No worries.
All right. Well, again, Tom, thanks so much. Have a good evening, and let's talk to you soon.
All right, thanks, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up, team? Welcome back to another episode of the Chat with Traders podcast, and you're listening to episode number 31. Now, this week I spoke with Luke Cummings. He's an Australian equities trader with 14 plus years of experience on his side. After making a last-minute decision that journalism wasn't going to be a good fit for him, Luke went into a finance degree which led him to becoming a stockbroker, which then led him to becoming a trader. Nowadays, Luke remains an active trader, of course, and also operates a hedge fund based in Sydney. As well as this, he also runs a model portfolio service and trading blog, which goes by the name of The Long and Short of It. And we keep things fresh in this interview by discussing trading methods and strategies that haven't really been spoken about in previous episodes. Additionally, Luke shares some of the common traps that often catch entry-level traders and how you may be able to avoid the avoidable with some insight. For all the links and resources mentioned in this interview, all you need to do is go to chatwithtraders.com/31 and you'll be able to see all the show notes there. All right, guys, well, I hope you enjoy this interview. I'm Aaron Fifield, your host of Chat with Traders, and here is this week's guest, Luke Cummings. Hey, Luke, what's going on, man? How's your day been?
Hi, Aaron. Very well, thank you. Day's going well. Looking forward to chatting.
No doubt. That's good to hear, man. Thanks a lot for making the time to come on the show. It's really good to have you here. And there's a number of things I'm keen to speak with you about today. Of course, we all want to know about your development as a trader, sort of from day one to where you are right now. And I'm also interested to get into some details about a strategy which you regularly trade, which is a takeover strategy. It's something we haven't really discussed on the podcast in the past, and it'll be good to hear more about this. But let's kick it off with your introduction to the markets. So where did this journey as a trader begin for you?
Sure. Look, to be honest, I guess I kind of stumbled into trading somewhat. I'd had no real exposure to the share market in my younger years. Grew up in country New South Wales, which is the state of Australia for your American listeners, and moved to Sydney when I finished school, started studying at night, working in the daytime. And one of the first jobs I had just happened to be working for an international fund manager, obviously buying and selling shares and currencies and whatnot as part of their portfolio management. It was very much an administrative-based role, so my job was to help settle trades and move cash and reconcile positions and so on and so forth. So no direct exposure to the market as such, but we're certainly aware of some of the things that were happening in the office at the time. My next step after that was I took a job actually at an online broker, E-Trade here in Australia. I don't think I was quite 18, or maybe I just turned 18 at that stage. So I finished school reasonably young. And I was just working in their customer service division at E-Trade, which was very interesting. It was April 2000. I actually started there about a week before the NASDAQ tech crash happened. Which was quite eye-opening at the time, but really was there with no preconceived ideas about the market. I had read some books and had some, I guess, exposure at university to the market. Anyone who's kind of got a finance degree, I guess, one of the first things you get taught is that the market is efficient, at least relatively efficient. And at that stage, I really had no reason to think otherwise or to believe otherwise. Of course, having exposure to people who are trading online and they're calling in and they're asking questions about the website and their positions and different things, to I guess sense their emotions through that period of the tech crash was very interesting, because they sort of say you can tell a lot about a person when they're under pressure, when money's involved, and that was certainly an eye-opening experience. But a colleague who I worked with there took a job at a broking firm probably about 3 years after we'd been working there. I got on pretty well with him socially. I wouldn't have said he was a great friend of mine, but we'd always gotten along well, and an opportunity came up to go and work at the firm that he was working at. Part of the pretense under which we were lured there was, all of these client accounts that they had that were dormant and needed servicing, that weren't being serviced at the time. Seemed like a really good opportunity, and I guess the reality was when we got there that the number of clients or prospects that existed were less than we'd been led to believe. And we sort of figured out that, if we're going to rely only on broking commissions for our livelihood, that we probably wouldn't be doing too well. So we also had a bit of time on our hands because we weren't as busy as we had been led to believe. So we just sort of started looking at the market and doing a little bit of trading ourselves. Obviously, we have exposure to clients who are doing something similar. And, to be quite honest, one of my business partners who's still my the colleague that I was talking about, who's now one of my business partners, just stumbled across this thing one day and sort of said, look, I think there's an angle here And I was like, sounds great in theory, but, I've been to university and I've studied finance. I know that the market's efficient and, something that simple surely isn't going to work, or at least not consistently. There must be something we're missing. And, I wouldn't say we paper traded in the way that people, I guess, think about paper trading now, but we watched a couple of these situations evolve and, we're like, well, it looks like there's an angle here. And I guess we just sort of started to, systemically exploit that and to look for those types of situations. And it was actually a really profitable little niche that we'd found. And I guess, really that was the start of the process for me. I took that job without having any intention of being a trader. It just sort of evolved that way. And that was, I think, 2003 or 2004. And in one form or another, we've been at it ever since.
Okay, that's excellent. So I'm keen to sort of break that journey down a little bit more and touch on some of the points you mentioned. So just before I do that though, what was it about trading that actually appealed to you, or maybe not even trading, but just the markets in general? Because, I mean, when you're young, you have the opportunity to go pretty much any direction you like in terms of your career. What was it about the markets and trading that really got your attention?
Yeah, it's a good question. I actually intended to be a journalist initially, and that was very much my plan. Right up until the time I finished school, I was going to study journalism. And at the last moment, for whatever reason, I just decided that I didn't think I wanted to be a journalist. And I really was just looking for a job, to be perfectly honest. I knew that I wouldn't have the luxury of going to university full time without working. And it just so happened that one of the first roles that I stumbled across was the job, administrative job with the fund manager that I mentioned earlier. I think once I got a little bit more exposure to the markets, though, I just think it's a fascinating thing, and I'm not sure necessarily that I thought about it in those terms at the time. But you have this thing that every single day there's something different, as in there's no set pattern to how things evolve throughout the course of the day. You can be having a quiet day. Right now it's 2:15 in the afternoon here in Sydney. Something might be about to happen in 5 minutes time that I couldn't foresee or wasn't expecting, that could be one of the best opportunities that we have of the year. I think I was really drawn to the fact also that you can make money that isn't directly correlated to your effort, in the sense that in my school holidays, when I was still at school, I was doing some manual work like landscape gardening. My job was really to do the hard yakka, I guess, of the digging and the moving and the lifting and whatnot. And you come home at the end of every day and you're exhausted and you've earned whatever, $15, $20 an hour. But you can only earn more money by working more, and it's hard work. And then you have, trading, which, of course, you need to put effort into that. And as time's evolved, we've developed systems and whatever else. But the idea that a little bit of effort can make you a little bit of money, or can make you a lot of money, and that you don't necessarily know in advance which it's going to be, was certainly appealing to me. I think all traders probably at some level, are driven by a desire to have a better life or a better lifestyle, to have money. I think somewhere along the way, the money becomes less important, actually, probably once you start to, consistently make it. But I think definitely for me, I didn't grow up in a wealthy household. No one in my house talked about stocks. I'm not even sure that I knew anyone who was trading or investing in stocks, at least not directly. So I think the idea that, you could build a better life for yourself, and that it wasn't through manual labor as such, was probably, at least at the time, what appealed to me.
Yeah, I really like that answer. And I think a lot of people listening, including myself, can, really relate to that. So you mentioned there that you were at university, and was it an economics degree?
It was a finance degree, which I guess had an economics component, a finance component, accounting component, so on and so forth.
Okay, so you mentioned that they sort of taught that the markets were efficient, but when you sort of started trading with your partner, like you mentioned there, you were sort of saying that the markets weren't efficient. What do you mean by efficient and inefficient sort of markets?
Sure. So I guess, if you sort of think about university and finance or economics, we have this concept of the efficient market hypothesis. And really, in a nutshell, what that tells you is that in its most purest form, everything that should impact the price of a security, so whether it be a stock or otherwise, at any point in time is priced into that security. So the idea is that, by knowing information about, the PE multiple or the company's earnings, or, by looking at a chart or whatever, that there shouldn't be any discernible ongoing advantage by knowing that information because it's already in the price. Now, in its purest form, they teach you at university that, it includes all known information and all unknown information, and that's, I think, called pure form efficient. And then they have this concept of semi-form efficient, which is that all public information is in the price, but information inside information, I guess, is not in the price at that point in time. And I think sort of logically that makes sense. Certainly, if you've had no reason up until that point to think otherwise. At a fundamental level, to me at least, it sort of made sense. It's like, well, okay, if everyone knows that, the current earnings are this, or that this company's released a new product, or, that the economy is doing this, or whatever else, it makes sense that these things are priced efficiently. Now, I think as things evolve and as you learn, you realize that, that's an efficiency at a point in time is probably the argument that, that is making, or that concept is making. And of course, prices can move as new things develop. So, maybe an existing product's more successful than the company and the market had anticipated. Maybe it's less successful. Maybe, there's a currency impact for one of its earnings of one of its divisions. But I actually realized, very early on, or my partner and I realized that even that couldn't account for what we were seeing, because every day stocks are moving really with no discernible reason for them to move. So, you can make an argument that maybe information is evolving, or that someone who, has an incentive to buy or sell a security has learned something new that maybe they were previously not aware of. But I think that, in a lot of stocks, if they're liquid enough, that's probably not enough to account for the reason that you see some of these securities move in the range that they move on a daily basis. And I think, that combined with the fact that we'd sort of found this, little niche that we were exploiting quite profitably, it was really telling us that, well, the market's not efficient at all, at least certainly in some respects. So I think that, there are some instruments probably where you can make an argument that the market is reasonably efficient because there are so many people looking at them, and information about what drives prices is very readily available. But there's a bunch of stocks, and I'm sure other instruments as well, and stocks, I guess, is our area of expertise, that people just aren't looking at or paying attention to, or there are angles that they haven't thought of. And one thing for us, I guess, is that I've listened to some of your previous podcasts on the site, and I'm slowly working through the rest of them. But Tim Sykes was saying that you were talking to him about his edge and why he chooses small caps or penny stocks, and he sort of used the example of if you're going to play basketball, do you want to play against Michael Jordan, or I'm not sure it's politically correct, but do you want to play against a midget? And it's a funny analogy, because I kind of agree with him in that I think there are areas of the market that are harder to compete in. I mean, if someone like Goldman Sachs is throwing all of their resources at an area that I'm trying to compete with them in, I think that's very difficult. I think, where we try to play a lot of the time is in areas that, Goldman Sachs probably isn't paying attention to because it's too small in terms of, what it can add to their bottom line, or it's an area that, these guys go to the same universities and colleges that I went to that teach you that certain things are efficient or can't exist or aren't possible. And I think that leads to them ignoring a lot of areas of the market that can actually be exploited. And I suspect that of all the people you're interviewing who are trading for a living, I mean, they all at some level believe that the market, and probably have proof that the market's not efficient, because if the market was efficient, you can't make your living trading, like they do and like I do. So that was a real eye-opener for me, I guess, is that, one of your other interviews someone mentioned, stages of development, and one is, you're making money, but you can't figure out why. And then you're not making money, and you can't figure out why, which is maybe worse. And then, you're not making money, you know why, and then you're making money and you know why. And I think that's the thing. Like, if you're making money and you really want to make a career out of trading, I think you really need to be able to put your finger on, pretty quickly, at least at the point where you're going to scale up in terms of the time and financial resources that you commit to it. You've got to understand why it is that you're making money and where that advantage is coming from, because randomness can account for a lot in the markets and in life, right? You do a trade that makes money, doesn't necessarily mean it was a good trade. You do a trade that loses money, it doesn't necessarily mean it was a bad trade. I think people confuse the end result of what they did with the intent that they had, or the reason for them taking the trade in the first place. And I think that was important to us early on, was to try and figure out, hey, are we just lucky here, or have we actually found an inefficiency in the market? And sitting where I sit now, and for some time, I definitely believe that the market isn't efficient, at least in some areas.
Okay, yeah, that's a really great answer. And thanks for really expanding on that too. So all in all, would you say your degree from university and your experience as a stockbroker, did you find that this had any benefit to you when it actually came to trading your own money?
Look, definitely. Maybe not for the reason that I would expect, though, or that listeners would expect. I mean, the university component, I think, was really great. One, for exposing me to things in terms of terminology and concepts and whatnot that I just wouldn't have had exposure to otherwise. But once you get past that, initial fundamental knowledge base, I think it's really great, looking at it in hindsight, to know or understand what everybody else in the market, at least who are finance professionals who are working as portfolio managers or prop traders or whatever they're doing at all these firms. I think it's great to understand what they're taught and why their belief systems are, what they are. So from a university perspective, I think that was really great. From a broking perspective, I mean, I think outside looking in, you think about a customer service role at an online broker. It actually sounds like a pretty terrible job. But I have to be honest, that the two business partners that I have, we all came through, E-Trade at similar times. We didn't necessarily work together, but we all had that grounding or that base coming through E-Trade. And the cool thing about that was that you're not getting paid very much, but you're going to work every single day and you're learning about the market. So you're learning about how the market actually physically operates and some of the rules and regulations that govern it, and some of the idiosyncrasies of the market in terms of the market itself. But then you also have the benefit of seeing human emotion in operation more or less in real time, because you're talking to these people over the phone who are having problems, or have questions about whatever, but you can't help but figure out I guess what their emotional headspace is, and you get some exposure to the types of trades and things that they're doing. So I actually can't imagine being in the position that we're in right now had we not had that education, in online broking, because it's basically like getting paid for 3 or 4 years to do an apprenticeship or an internship where you get to learn everything about the market. And I think, the alternative to that would have been trying to learn all of that stuff at night or on weekends or before work, or, in addition to having other jobs. I think would have been really difficult. Moving on to when I became an actual broker and was giving advice to people and looking after accounts. Also very interesting, I think, the way people react to making profits, the way people react to making losses, the amount of opportunities you would call people with and say, hey, look, here's a really great trade. Here's the downside. Here's why I think you should do it. And, their reasons for not doing it or whatever, I think is very interesting. So, yeah, if I had my time again, I think the path that all three of us took to get to where we are now was really perfect. And the other cool thing was that, in the year 2000, online trading hadn't existed in this country for very long. It hadn't existed in any country for very long. A lot of the customers at E-Trade were still using dial-up internet and couldn't talk on the phone at the same time they're using their internet. And it was sort of just, a crazy time. And it was kind of nice because it's not like coming into an industry where there are people with 30 or 40 years worth of experience that you don't have. At most, there's probably people with a couple of extra years experience trading online than what I had at that time. So I think timing was beneficial in that regard.
Yeah, right. That's really interesting. You kind of mentioned a little bit earlier, you talked about once you did start trading, you and the partner who you were trading with came across sort of a niche or a little area, a type of trade or strategy that you could exploit, and you were making decent money from this strategy you discovered. Can you talk to us a little bit about maybe how you discovered that strategy, and are you still running with that strategy today?
Yeah, sure. Look, this credit for finding the strategy definitely goes to my partner at the time. I've actually never really discussed it with him in detail. I presume he just sort of stumbled across it by accident. We sort of found a way to exploit a loophole around capital raising in typically smaller cap stocks. To get access to discounted securities. That some of these companies were offering. Of course, depending on the company, sometimes no discount, frankly, is big enough to want to give them money. Other times, the opportunities are attractive. So, sadly, the loophole we were exploiting no longer exists. The rules were changed such that the way we were obtaining access to them at the time no longer exists, which is a shame. But we basically went through the process of doing this ourselves. And because we were somewhat capital constrained at the time, there were really two forms of leverage for us. One was to share those opportunities with our clients, which we certainly endeavored to do as much as we possibly could, and had a lot of clients who made a lot of money from that at the time. And the second way was for us to get our hands on more capital ourselves. I mentioned to you when we were chatting earlier that the way that we did that at the time, which I definitely do not advocate to anyone under any circumstances, is we actually use credit cards because we're young guys. Like I was only probably 20 or 21 at that stage. I didn't have any money. I probably still had a little bit of consumer debt from university and buying a car and all these things that you sort of do. So we sometimes are making 5, 10, 15% a month from some of these trades pretty consistently. So even if you're having to pay a bank 15, 16% a year in interest, which sort of sounds crazy saying it now, but it was a smart thing for us to do. And we'll probably get to this later on in terms of how our trading strategy has evolved through time. But one thing that, or a couple of things about that was, one, we needed to be pretty damn sure that we could make money consistently, given that we were using someone else's money. But it also made us, I think, very mindful of risk, and sometimes that it's just better to take the fat, easy part of profit out of a trade without a lot of risk, rather than really going for the entire amount of profit that might be in the trade. So I think if you use a baseball analogy, sometimes a base hit or a double is better than a home run if you could get that base hit or the double more frequently than you would get the home run. So that was what we did. But I actually think, and I don't have proof of this, but I think the strategy we were running and the extent to which we scaled it amongst our clients, and it sort of became a reasonably well-known strategy, certainly at least within a niche in the Australian market, probably was what at least partially contributed to the subsequent rule change about that. So it was a cool little thing. And one thing we don't really know now is whether or not maybe we should have kept it a little quieter and we'd still be trading it now, because it just wouldn't have become such a prominent thing. But onwards and upwards, no regrets. But it was a cool thing. If we hadn't found that, I don't think that we'd be doing what we're doing today, and we wouldn't be talking about this. So that was pretty cool. And I guess the interesting thing is that, sort of a long way to answer your question, but you sort of think about how people become traders and the preparation they do, and maybe they go to a course. I've listened to your own interview about starting out with GAN and going to a seminar and learning about that. And some people read books and learn about fundamentals, and you've spoken to people on this podcast who are crazy into programming and backtesting and different things. It sort of seemed a bit surreal that we kind of just stumbled across this thing that no one was really talking about, and it wasn't particularly sophisticated, and it was just really easy to exploit it for profit at the time. That was sort of weird, because even things like having a trading plan and things, I mean, all those things come after, but all of the things that you think that you should do and that you need to know in advance to start making money in the market, we weren't doing any of those things. And some of our friends and colleagues who were working at other firms and things like big name financial firms sort of knew what we're doing. They're like, you guys are crazy. Like, what are you wasting your time on like all these small ridiculous trades for? Like, what's the point? I felt, and I think probably my business partner at the time probably felt a little bit of an inferiority complex, where it's like, we're not really serious, as in no one's taking us serious. This is kind of a small strategy that is a bit of a niche, and it was almost embarrassing to talk to people about it. But it just became such a big thing, and we made so much money from it. And it's funny now, looking back on that, and some of the people who at the time were like, you guys don't know what you're doing, you're just lucky, and loophole's going to close and that'll be it, you guys will have to get other jobs and things. Some of those people now are like, okay, what else have you guys got? Like, tell me some other strategies, what should I be buying, or whatever. And I think that's been an interesting process to go through. I wish I could say that we set out with intent to become professional traders and did all these cool things, and that we're super smart and great at math and all these things, but it just, for us at least, hasn't really worked out that way. And I think if I look back, the fact that we weren't doing what everyone else was doing, and that you couldn't just turn up somewhere and learn what we were trading in a course or read it in a book, it's actually probably what made it work in some ways, because we just kind of found something that no one else was looking at the time.
Right. Okay. So right at the start of that, you mentioned you were sort of purchasing discount securities. What do you mean by discount? Just so we understand before we move on.
Sure. So looking in a purest example, which is not the strategy we were using at the time, but in Australia, Westpac Bank owns a fund manager called BT, or partially owns a fund manager called BT. American listeners can look it up online briefly if they want to, but we did an offer recently where they sold down part of their holding. Westpac sold down part of their holding in BT, and the reason they did that was because in Australia they're talking about changing some rules around the level of capital that banks have to hold, and the penalty from a capital perspective of them continuing to hold BT, I guess in the bank's view, was greater than the benefit of continuing to have the shareholding in BT that they did. So, very basic level, Westpac says anyone who's an existing BT shareholder or who is an existing Westpac shareholder will have the ability to buy BT shares at a fixed price of $8.20. Now, this is for existing shareholders only. So if you don't hold shares in BT or you don't hold shares in Westpac, and that announcement is made, then there's no way for you to participate. Many years ago, if you didn't already own those shares, sometimes they would say anyone who's a shareholder in a week or two's time, or 3 weeks' time, whatever it's going to be, will be entitled to participate in that offer. So in the case of BT, which is sort of underway at the moment, BT announced, or Westpac announced, they were doing that sale when the share price was $8.20 about 2.5 weeks ago. Of course, we've had a lot of market volatility in that time, but the last week or so, the market's rallied pretty hard. BT shares as of yesterday were almost at $10. Today they're, I think about $9.50 or something. It's quite a big price gap there, right? So if you have the ability to buy BT shares at $8.20 and they're currently trading at $9.50, it doesn't really matter what you think the outlook is for BT. You don't need to want to own BT for any great period of time. You're basically being offered something that's worth $9.50 today for $8.20. As long as you think that between now when you buy BT and when you're able to sell them, when your new shares are allocated, that's sort of a no-brainer transaction, right? Like, it's like me saying to you, give me $8 and I'll give you 10. It's like, well, what's the catch? That seems a bit too good to be true. But it exists, and the thing is now there's no exploitable angle because the window is closed by the time that's announced. But previously, that window wasn't closed, and that was something that we took advantage of as much as we could when the rules existed in that format. So what we're basically trying to do is figure out, how do we buy $10 for 8, or how do we buy $5 for 4, or whatever the case may be.
Okay, sure. Yeah, that makes perfect sense.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Let's fast forward to current times now and talk about how you're trading these days. So give us an overview of your approach to the markets that you apply, in current times today.
Sure. So I think at a fundamental level, the premise hasn't changed for us in that we're not trading the same strategy that we were back then. But one great thing about that strategy was that the reward on offer was outsized relative to the risk that we were taking. So I think you're always taught, and we talked about that, my university degree earlier, the idea is that to get more reward, in theory, you have to take on more risk. And I think fundamentally that's pretty well accepted. What we're really looking for are situations where we think that the reward on offer exceeds the level of risk involved in us taking that transaction. And that maybe sounds a little strange or a little crazy, but the idea is the same as that loophole we found before. There are other things in the market that where that exists, I think, and we really have a couple of different components to our business now. So the original business partner or colleague at the time that I mentioned, they started working with more than 10 years ago, is still one of my business partners today. I have a second business partner as well who joined along the way, and the two of them primarily are focused on really short-term stuff. So non-client facing stuff, typically day trading. We try and be pretty flat at the end of every day. And it's time intensive. They're every day, at least while the market's open, sitting glued to their screens, looking for opportunities and trading. So there's that element of our business, and I'm not, really actively involved in that these days, just because it's so time intensive. And in order to do some other things, within the business, it's difficult to do that if you're glued to a screen all day. So that's one part of what we're doing. The second part is, we have a managed fund or a hedge fund, which trades, longer term type strategy. So, day trading isn't really appropriate for that vehicle. So, our takeover strategy, which you mentioned earlier, fits within the fund, plus some other, kind of longer term scalable type strategies. And I guess the more recent, development there is the blog that we've started to share some of our ideas, some of our more simple ideas in the takeover space that retail investors are capable of implementing themselves without it having to be through our fund or needing any special help to do. But the one thing that drives all of those areas or all those business divisions is this idea of risk reward. So what we're really trying to do in the first instance is make sure that we really strongly understand the downside in each situation. And I guess upside is secondary to that. I think one mistake that a lot of people make when it comes to trading is they're really thinking about, what's my potential reward here? How much money can I make? And their position sizes are really dictated by, what they're imagining their profits are going to be if things go in their favor. We're the complete opposite of that. We're really trying to figure out, okay, we're happy to risk X amount per trade, for a stock standard, what I'll call opportunity. And that really dictates our position size. And I guess we'll cover the takeover thing in a little bit more detail shortly. But some of the opportunities in that space are more interesting from a risk reward perspective than your standard opportunity. So we have some discretion to vary our position size accordingly in that situation. I think if you're pigeonholing what we're doing, it's I call it rules-based discretionary trading. So we have a fairly fixed framework around what we're looking for in all situations, and lots of alerts and triggers and things that alert us to opportunities. But all of it has human intervention. So it's always someone looking at that saying, is that opportunity as good as it appears to be? Yes, it is, let's take it. Or alternatively, no, it's not for X, Y, and Z reason, and therefore we're not taking it. And look, probably the best example I can give of a trade where I think that the reward is outsized relative to the risk. It's one we did recently for our fund and through our newsletter, or through our blog. And that was in a stock called Panos, Australia PNA was the ASX code. And the history of Panos, very briefly, was that they had a copper mine or several copper mines. Major shareholder was a Chinese company, had made a couple of approaches to Panos previously about taking them over at higher prices than where the takeover subsequently happened. At the time, Panos board said, no, we're not interested. The price isn't high enough. We really went through that period of 6 months or so of commodity price corrections. And the major shareholder, Chinese shareholder, comes back and says, we're making another takeover offer. Takeover offers can vary quite considerably in terms of how they're structured. But the cool thing about this most recent offer for Panos was that the price at which the takeover was being made was guaranteed. So it's basically called an unconditional takeover. And I think $1.71 from memory was the takeover price. We trade so many of these, I can't remember exactly, but let's call it $1.71 for argument's sake. As soon as that takeover is announced, Panos is trading at $1.72. So you can basically buy Panos as much as you like, more or less, for a number of days at $1.72 or thereabouts, knowing fine well that no matter what happens, so if there's no improved bid, even if the market tanks during that time, you're going to be able to sell that stock at $1.71. So that's really your hard stop loss that you've got in place, at least for the period that the bid exists. But it wasn't a crazy thought to think that Panos might get an improved bid, maybe not a competing bid from a different shareholder or a different company, given the reasonable shareholding that the Chinese company already had. But the bid that they'd pitched most recently was about 20 or 30% below where the bid had been pitched previously. So it wasn't ridiculous to think that the bid could be improved by 10 or 15% above its current level. In order to get board acceptance and get shareholder acceptance. So, the way that looks is that if the takeover price is $1.71 and it gets a 10% bump, the new price becomes $1.88. If you look at that, what you were risking in that situation, you're really only risking that 1 cent per share because you can get that $1.71, yet you have the potential to get $1.85 or 88 or more, potentially $2. So for us, I love that trade because I know exactly at the outset what my downside is. I've got that locked in. I can position size accordingly. And if the trade works out, then the multiple of reward relative to risk that you get is very, very great. The headline percentage, it might only be a 10% return on the capital invested, but if you look at your return on risk, if you get a bump in the share price or in the offer price, it's almost unheard of. So that's not to say that Panos was definitely going to get that better offer. It's very possible that the Chinese company just says, look, that's our best and final offer, too bad, and we lose a cent a share. But at the outset, that's a nice trade for us to take. And as it turned out, they got a bump of almost 10%. I think $1.85 ended up being the price that it was taken out on. So, we made 8 or 9% headline return on the trade, but had a very big position size because we had that downside built in, and we really got about 14 or 15 times what we'd risked as a return on the trade. So that, in a nutshell, is probably the best example I can give you of what our holy grail trade looks like.
Okay, yeah, that's really interesting. So, I mean, you obviously sort of talked a lot about an example there of sort of the takeover strategy, but if we could just sort of take it back to step one, what's the general objective of this type of strategy? So let's focus in on your actual takeover strategy. What's the general objective of this?
Look, so the general objective really is, which applies across our whole business, is to try and take lowish risk trades with good payoffs. The great thing about the takeover strategy specifically, from our perspective, but also from our investors' perspective, is that takeovers have generally pretty low correlation to the market. So once a stock is under takeover, depending on the level of conditions attached to whether the offer is likely to proceed, more often than not, it's no longer trading in line with the broader market. So you don't need to worry about having a position that you wake up tomorrow morning and the Dow is down 5%. Your takeover positions just aren't going to get sold off, or if they do, they shouldn't be, and it corrects itself pretty quickly. So it's a really low volatility strategy for us in terms of it has low market beta. And that's part of the reason that we actually decided to put it in a fund, and that we've rolled it out through the blog, because I think there are a lot of people out there, certainly in Australia this is evident, maybe less so in the US, but I presume it's a similar issue. Lots of investors who have had share market risk previously or have it now, and they really don't want the volatility that goes with that. The share market's great in terms of being a trader or being an investor, holding managed funds, whatever, when it's going up. But people don't want those massive drawdowns that you get in the GFC, in an extreme example, even the hit that our market took, and that I guess a lot of global markets took last week when we had the dual issues of China's market falling over, and also these issues in Greece. I think people don't like that. As much as in advance they may think that their risk profile is that they're happy to take some risk in order to get the upside. I don't really think that fundamentally that's the case. But at the moment, these people don't really have the choice to not be in the share market, because the returns on deposits in bank accounts are so low at the moment that, especially if you're a retiree or you're getting towards retirement and you need that income to live, it's just not on offer. So what we do or aim to do with the takeover strategy is show people how to get share market like returns with much lower volatility or downside risk than what that would usually entail. So we definitely have strategies that we can make more money with, but the returns are more volatile. You're going to experience larger drawdowns and probably more frequent drawdowns. The cool thing about the takeover strategy is you don't really tend to get those drawdowns or big drawdowns, because you're not linked to the market as such. There are other factors at play, and if you're pretty good at figuring out what those factors are and only taking those trades where you're comfortable that the risks are minimal, you should have pretty low market beta using this strategy. Okay, right. So how do you find out if a company is about to be taken over, and how do you sort of know how true that is? Like, is it possible that it could be a false rumor? Yeah, well, the great thing about the strategy, at least as we run it, is that it doesn't require knowing in advance. So our strategy actually is that we wait until the takeover has been announced and it's formal, and then we buy the shares. And that might seem counterintuitive because, what you think about is you want to buy a share today that gets a takeover bid tomorrow at 40% above its current price and you make money. The thing about that is it's very hard to predict. So, of course, there are rumors. If it's a genuine rumor and you really know the information, then, you have it illegally at that point. And so that, kind of rules out that option. If it's a rumor, you're undoubtedly not the only person who knows that rumor and who knows how true it is. And, if you're just buying stocks purely because they're perhaps going to be subject to takeovers, you don't get that smoothness of return or that lack of volatility that I was talking about earlier. And there are definitely funds out there who buy stocks that they think could become subject to takeover. What we're really interested in is buying stocks that are already under takeover that may get an improved bid and or a counter bid from another party. So if you think about it like an option, I guess, anyone who kind of has basic knowledge of options knows that there are various factors that go into pricing an option. One is volatility of the underlying security, obviously the time that, until expiry of that option, interest rates play a factor, and so on. But we're taught that time value that time has value in an option. And the great thing about these takeovers is that you're buying this option, it's a synthetic option, over future upside in the share price because of an improved or competing offer. But you're not really paying for that in the way that you would normally pay for an option. So if you find like a listed option, over a security, they're pretty efficiently priced, right? There are market makers in that market, and everyone knows the Black-Scholes formula, and there's not too much variation in terms of it. It's hard to buy cheap options, but that's one way that we can buy options, synthetic call options, very cheaply over a takeover situation. And I think if we're really boiling down why the strategy works, that's it, because we're getting the ability to participate in an upside quite cheaply, which isn't to say that you always get a better offer or that you get a competing offer. You definitely don't. But you get enough of them, and in some instances the offers or the subsequent offers are so good that you only need 2 or 3 great trades like that a year, a bunch of okay trades, and you make more than enough money every year from that strategy. So at a fundamental level, that's what we're doing. So we're not trying to anticipate who's going to be taken over. We just wait for the announcements that someone is being taken over, make sure that we think it's a credible target, a credible bidder, that the downside is known and limited, and then position accordingly in the hope that something else is going to happen.
Right. Okay. And with this particular strategy, what's sort of the time frame we're looking at from when we get into a position and when we exit completely? What's the sort of holding time of one of these trades, generally speaking?
Sure. Look, I'd say probably minimum a month, and 6 months. Get 6 to 9 months would sort of be the maximum time period typically, and I'd say about 3 to 4 months on average. So if a bid is made today for a company and there are no further developments, meaning that there's no improved bid, there's no competing bid, usually they take about 3 months to come to a natural conclusion. If the share price improves in the interim, we may look to exit the position early if we think that the risk reward is no longer in our favour, or that the additional benefit by waiting those extra months is now not sufficient. If you start to get competing bids or improved bids coming in, as part of the trade, usually would get bumped out to 6 months, maybe 9. But the good news is typically that the longer the trade's going for, the more money you're making along the way, as in a trade that you have open 6 months from today doesn't have the same bid level that it had when you took the trade. There's chances are being 1, 2, 3, 4 improvements in the bid along the way. Right.
Okay. No, that's really good. So what I might do is, but obviously before the interview, you sent me through a PDF document which had sort of a bit of an overview of the strategy we've just sort of discussed here, the takeover strategy, and it had a few case study examples in there as well. So I might put a link to that in the show notes. So if anyone wants to find out more about this, just go to chatwithtraders.com and you'll find it in the show notes below the interview. But let's keep this moving. So I'm keen to ask you just kind of some general advice. So, from your experience, what are some of the common mistakes you see new traders making when they come to the market?
Look, I think there's a few things. I think a lot of people maybe think that it's easier than it is, depending on what experience they've had up until that point in time. So, you're at a barbecue and, your buddy tells you about some stock that he bought 3 weeks ago and it's up 25 or 30%, or someone else who's in your family who, has been day trading. I guess this was a big thing around 2000, who's, making $3,000 a day and they've quit their job or whatever. And I think you're looking at those people going, wow, this is, pretty easy. Maybe you've bought a stock or two yourself, same thing, you're making money. And then all of a sudden you're not. And usually that's because, people are making money without necessarily knowing why they're making money. Luck is definitely a factor, right place, right time. Obviously, if the market's going up, generally and going up strongly, then rising tide lifts all boats, and it's sort of easy to make money. Somewhere along the way, inevitably that reverses. I think some people, if they're trading a specific stock, maybe they paid 50 cents for it and saw it get as high as 70, and now it's back to 35. So it must be great buying now because it's been to 70 before. I should buy more. I should hang on to my existing position. Whatever. And then they lose money. So I think that's sort of one thing is that, and I think in life generally, it's easy to look around at other people and assume they're having more success than you are, or that they've got something that you don't. And I think it's as they say this about gamblers, right? You always hear about gamblers' winnings, but you never hear about their the times that they lose. I sort of feel like, not necessarily intentionally, but family and friends, maybe, and even brokers who don't have your best interest at heart are telling you about all the times that you missed out on making money because you're not trading shares. So I think that's an element of it. Not necessarily having a plan around downside, like how much money am I willing to lose on this position or on a series of trades before I revisit what I'm doing. Where's my stop loss on this trade? Like, where am I wrong and where am I getting out of it? What flows on from that is, getting stopped out of a position because you're supposed to, and you've had the discipline to be stopped out. And then you watch the share rebound strongly to, higher than where it was trading before. So then you think, oh, well, if I didn't have that stop loss, I'd be making so much money now. So, maybe I shouldn't have stop losses in future, or maybe I should not pay attention to my stop losses. And then it all becomes a bit wishy-washy because it's like, well, okay, I've got this stop, but how do I decide whether I'm executing it or not? Is that just something I decide at the time based on how I feel and my intuition? Or so look, there's that. I think so. On one hand, I think that's people underestimating how difficult it is to consistently make money. But I think the flip side of that is that you look at the market and you think about the people who are participants in that market. So I'll use Goldman Sachs as the gold star example in terms of at least their profitability and their resources and whatnot. All the way down to smaller, day traders or swing traders who are individuals who do that for a living. I think you can assume that can be really difficult, and you can go to a lot of these courses you go to. That I've had exposure to in the early years by going along and watching them. I've had exposure in my later years by being one of the presenters or speakers at these events, and some of the things that these people talk about when you pay for these seminars, it just sounds so complex and so difficult, and you can walk away thinking that if you can remember those 300 different chart patterns that you're definitely going to make money, or if you can, master the 50 fundamental analysis ratios that, you read in the book, that you're going to be able to make money, or, and that if you can't do those things, then that means you can't be successful. I think that's a big mistake for beginners as well. I think, either assuming you can do what everyone else is doing, and it just works out is, I think, a mistake. But also assuming that it's impossible to do what the very best are doing is a mistake. And I think, probably fear and greed, drive both of those things, as they do, in the markets generally. I think, if I was giving a new person advice, I mean, obviously you have to learn somehow, right? So you learn by reading, you learn by going to seminars. Sometimes you learn by doing and maybe losing a little bit of money. But I think it's all part of the journey to try and understand. I listened to the interview that you did where you talk about GAN and how much time you spent kind of studying that in the early days and reading the books, and you've been to seminars and whatever. And then somewhere along the way, you just kind of figured out that maybe it wasn't all that you thought it was, or maybe it wasn't for you. And the good news is, by the sounds of things, it didn't really cost you much in terms of dollars, maybe a bit of time to get to that point. And I think that you need to learn and have some exposure to all of those things. But I think you just need to understand that nothing is as great as it seems from the outside looking in, as in there is no perfect thing in the markets that is always going to make you money, that you can master and then that's it. It just doesn't work like that. And unfortunately, I think that in our industry there are some people who are holding themselves out as experts who are anything but. They're experts at presenting courses and providing education and really know the ins and outs of the 300 chart patterns and systems that they referred to earlier, who either haven't really traded a share a day in their life, or they have but not particularly successfully and they figured out that it's better for them to be educators. And I have no problem with that if it's on a disclosed basis that you're not holding yourself out to be something that you're not. But I think that's a big trap for new people, is that you want to grab someone and hold on to them as the person you need to be like. And it's definitely important to have role models and mentors and whatever else. I would just say that attaching yourself probably to the right people is important, but kind of just being a little bit skeptical about everything. I'd like to think I'm an optimist in life generally, but I feel in the market you have to just be a little bit skeptical and a little bit neurotic, because sometimes things that look too good to be true, actually are too good to be true, and sometimes things that look too good to be true actually are real and can be exploited. But at the start, it's hard to figure that out, and you sort of don't want it to cost you too much money, real money, to kind of get to that point and figure it out. So I think, thinking that you can just turn up and do a course or two and become a great trader is a pipe dream. But, alternatively, you don't have to be a mathematical genius or, the smartest person in the room to be able to make money from the markets, because there's lots of different ways. You just have to, get to the point where you understand how you're going to make money and what's going to stop you from making money.
Yeah, absolutely. I mean, that's such a good answer, Luke. Really, really good points you hit on there. Let's just do one more question, and then we should probably wrap this up. So, I'm interested to know. This is a little bit different. Besides your blog, of course, the long and the short of it, are there any blogs or resources that you yourself frequently visit or use to stay in tune with the market?
Yeah, look, there definitely are lots of, I guess, different resources. It's probably one thing about my job that I think people from the outside wouldn't appreciate is how much time you just have to spend reading things and learning about things, most of which ends up, just to be perfectly honest, being completely useless or non-usable, at least at the time. But you can only uncover things by going looking for them. And sometimes you'll maybe pick something up today that you can't use, but in 6 months or 12 months, you'll be able to use them. So, look, in Australia, definitely the Australian Financial Review, I read every day. The business section of all of our major newspapers, so the Australian, Sydney Morning Herald, I read the New York Times, Wall Street Journal, Financial Times, Bloomberg, CNBC. I get a bunch of kind of emails daily that summarize financial news and whatnot. And then just ad hoc things that maybe I'll come across depending on what sort of trades we're working on at the time. But I think being well read in terms of regular content, but also some of those great classic trading books. I mean, I know you interviewed Jack Schwager a couple of weeks ago. I think if I think about my favorite trading books, Market Wizards and New Market Wizards would be amongst the top 5 undoubtedly, just for the insight you get to other people who are doing things that, for me, really helps solidify that there are a million different ways you can do things, different personality types, different strategies, and they all work. So, I think understanding other people's journeys, where they went wrong, what strategies they've, used successfully, which I guess is part of what you're aiming to achieve with this podcast, right? You're giving people exposure to different traders who have different strategies and systems. who can talk about what works and what doesn't, and maybe you learn that way rather than having to learn for yourself, which takes more time and can be more costly.
All right, that's a really great, another great answer there, Luke. So thanks a lot for doing this. And I mean, I've certainly picked up a few things from this discussion, and I'm sure anyone listening has also. But before you go, do you want to share with listeners where they can go to find out more about you and your trading methods?
Yeah, sure. So, look, definitely, people can visit our blog, which we just recently established. So it's just www.longandsshortoфit.com.au. I'll get you to put that in the show notes, perhaps, so people can easily find it. Also, we have a managed or a hedge fund that I mentioned earlier. So that's just www.789assetmanagement.com.au. Just getting back to the blog, actually, we'll set up a promo code so that anyone who's listening today who thinks that maybe they'd like to trade the takeover strategy, have a bit more information sent to them. We'll do a discount there, 20% off our usual subscription, so that anyone who's interested can take advantage of that. It's actually a 14-day free trial anyway for people to have a look around before they commit any money. And then anyone who uses the promo code can get an ongoing discount on their subscription.
Good one. So what's the promo code?
It's a good question, actually. We'll put that in the show notes if that's okay. We've got one set up. I just don't have the details of it at hand.
Okay, sure. Yeah. Well, of course, the promo code will be in the show notes. All the links will be also in the show notes. And are you on Twitter or anything like that?
Yeah, I am. So on Twitter, personally, I'm just at Luke Cummings 81. And our blog, we're set up at Long Short of It as well. So anyone can reach out to me that way. Obviously, get in contact via either of those websites if they'd like to do so.
That's really good. All right. Well, thanks a lot for doing this, Luke. And until next time, take care, and we'll talk soon.
Thanks, Aaron. Appreciate it. Really good to chat to you.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
All right, what's going on, guys? Welcome back to another episode of the Chat with Traders podcast, and this time you're listening into episode number 32. So let me just say to start this off, I've actually received a lot of requests for this week's guest in recent months. Maybe it's because he's a straight shooter who doesn't mix his words, or maybe it's because he's bounced back from multiple harsh failures to become an exceptional trader. Whatever the reason may be, I know for certain you're going to appreciate the raw honesty and insight of this week's guest, Dan Shapiro. Coming up from humble beginnings, Dan called on the neighborhood loan shark to fund his first trading account, which got him through the door to one of the largest prop firms at the time. This is where he rubbed shoulders with many phenomenal traders who helped shape him into the trader he is today. In this interview, we ultimately focus on the mental and psychological aspects of trading. So we discover some of the darkest moments from Dan's trading career, how to handle losses and grind through slumps, trading the setup and not your P&L, and why you should care more about trading right rather than being right. So all in all, Dan was really great to talk to, and I trust you'll enjoy this episode. And actually, it may even be worthwhile for you to play this through twice, just to ensure you don't miss anything. And of course, all the show notes and links, everything that's mentioned during the interview can be found at chatwithtraders.com/32. All right, guys, I'm Aaron Fifield, your host of Chat with Traders, and here is this week's guest from New York City, Dan Shapiro. Dan Shapiro, welcome to the podcast, man. How are you?
It was a pleasure, Aaron. Thank you very much for having me.
Thanks a lot for coming on. How's your day been? Was it a good day trading?
It's a good day. We're all alive and kicking. Everything else is a cherry on top.
I like it. Look, thanks a lot for coming on. I've actually had a number of listeners mention that I should get you on the show, so it's really good to have you here. And
I appreciate it, man. Thank you.
You're welcome. And I know you've got an interesting story to tell. You're well experienced and speak about trading in a very raw and a very honest way, which I certainly appreciate. And I'm sure everyone listening is about to also. So don't hold back with your answers. And let's just start from the very beginning. So share with us how you initially got started trading. Where did it all begin for you?
Cool. So just very briefly, I know some of you guys know my story, some of you guys don't. I am in the New York City area. I grew up in Brooklyn. A lot of my friends, were stockbrokers. If you guys remember all that crap that was going on in the 90s. A lot of them went away to camp for a little bit of time. The rest of us who were fortunate enough that weren't good at it, we had to do something else. So I went into the restaurant business with my dad and some other guy, and that business basically blew up in about a year and a half. And I kind of needed some direction. I really didn't have any direction in my life, which was kind of sad. I mean, looking back at it, it really is sad. And one of my friends who, unfortunately, 2 years ago passed away from cancer, he was also a stockbroker at one point, and he started trading in a place called Generic Trading, Carlin Financial. And for all your listeners, if you Google Carlin Financial or Generic Trading, and if any of you guys have heard my interviews with Lucci and Pete from the Lucci Group, St. Lucci Group, Carlin Equities / Generic Trading was one of the biggest prop shops from about 1999 to about 2000 and whatever it was, 2005, 2006, and then they sold their business to the Royal Bank of RBC, Royal Bank of Canada, one of those, RBS or RBC, one of them, for exorbitant amounts of money, basically for their execution system and all that stuff. But so my friend was there. He was there for 2 weeks. He blew out of his account, and he told me about it. And I was like, hey, you know what? Let me give it a shot. I don't know why. I had no money. I literally had no money. I borrowed money from a neighborhood loan shark, which probably wasn't the smartest thing to do. But again, where am I going to get the money, right? I really don't have too many choices. So I went to Generic Trading, and I got hired by one of the partners. His name is Ron Shear. If you guys Google Ron Shear, he's just a pretty known, respected guy. And that's where I met Meyer Hoffman. And Meyer turned out to be one of my mentors. And then from there, 1999 rolled in. For the first year, I made money the first month and then didn't see a check for the next year or so. And then the internet craze rolled on. Just to kind of fast forward the story, it was pretty damn good, pretty good. We did all right. We did all right. I made a lot of great lifetime friendships with some of these guys who, if you Google, they've turned out to be huge fund managers and just a great group of core guys that we met along the way. Learned a lot from each of them. Try to take a lot of attributes from all of them. The driving force behind my early success was definitely Meyer Hoffman, probably top 5 best traders of all time from the prop world. Guy made hundreds of millions of dollars. We all traded together. It was pretty awesome. And like I told the Lucci interviews, I was a byproduct of the internet craze. And at first it was great. But the reality is nobody knew how to trade back then. We were all products of the sidewalks that were paved with gold. All we did was buy dips after 3 days of buying, and stocks would gap up 20, 30 points, and that was for about a year and a half. And then the reality struck that it was just more to that, because after 9/11, everything changed. And I said it before, and I'm not ashamed of it. I did very well during the dot-com era, but then 2001 rolled in, 9/11 rolled in. I had an office of generic trading when NASDAQ was at 5,000. And when the planes hit the building, my business completely fell apart. I lost a lot of my own money. And it took me basically about 2.5 years to figure out what trading was. And I didn't make money for 2 years. And that's the reality. I didn't make any money for 2 years. And the one conversation you never want to have with your spouse, and I'm sure a lot of your listeners will really appreciate this, that conversation. Well, Dan, you did all right. You did all right during the internet craze. It's 2 years later. You haven't taken home a single check. It's time to do something else for a living. You know what I'm saying? And when you're a trader and you hear that and you had some pretty decent success, the last thing you want to have is that conversation, because reality really kicks in. I mean, the reality really kicks in. And bad enough during that time, I was incredibly depressed. The best parts of my days and nights were going to sleep. I used to literally certain nights just sob myself to sleep because I couldn't believe how fast I completely crumbled down to the earth and had no control of trading, because there was no path to profitability. There was nothing. There was no guidelines. There was no blueprint. There was nobody there to help me, because everybody was in the same shoes as me, because everybody was, again, the products of the dot-com era. And again, when people ask me about how great those days were, yeah, they were great. It was great also when I was 16. I'm not 16 anymore. I'm 41. And, as much as I'd like to reminisce when I was 16, as much as I'd like to reminisce during the dot-com era, the reality is it's a completely different market right now. And the greatest thing about the dot-com era, those 2 years that I didn't make money, it really made me appreciate what happens when you actually go on a good run. So when I finally started making money once again, roughly around 2000, in the middle of 2003, towards the end of 2003, once I started making money again consecutively, that's when I really, really appreciated what I went through. And a lot of the new traders, I'm sure a lot of you new listeners are going through the same thing. And I always tell the people in my live webinar every single day, there's no difference between me and you. There's absolutely no difference. Trading is a byproduct of your process. I don't care who you are. You could trade credit swaps. You can trade derivatives. You can trade bonds, E-minis, whatever you want to trade. Okay, you are a product of your process, and there's nothing the market can do to you that you can't do to yourself. So once I started really figuring things out, it kind of clicked for me there. And trading, for me, in my opinion, you don't need to go back to the drawing board every single time. It's more about tweaking. It's more about recognizing what you are doing wrong and just completely stopping it. I know for a lot of people, they're so emotionally attached to trading, and that's a whole different story. They're so emotionally attached to trading, they can't see what they're doing wrong because they're so absorbed by what they're seeing on social media, how fantastic it is. People are on vacation, trading off their iWatches, trading under a pool. I mean, who knows what they're trading? And the sad part is there are a lot of really great people out there that will show you things, but you have to let go of all your bad habits. And that's pretty much the first stop for kind of cutting yourself off, cold turkey and starting to the road to prosperity.
All right, that's excellent. So what we'll do is, since you've recently done a few interviews with the guys at Sang Lucci, I'll link to those in the show notes. So if you want sort of a deeper insight to Dan's journey, sort of from day one to current times, you can check those out. So they'll be in the show notes at chatwithtraders.com/32. Definitely check those out. They're awesome interviews. But I'm really keen to sort of not recycle old information and get into some sort of the meat of this interview and get into some actionable advice. So let's not brush over those few years which you talked about how you just lost money. So you were day trading, you were showing up every day to trade, and for 2 years straight you just lost money. What motivated you to keep going, and why did you keep going and not quit to go find something
Here's the deal. Once you taste, because you keep this in mind, okay? I grew up very, very poor. Okay, I grew up in the Brighton Beach section of Brooklyn, and it is predominantly middle to lower class people. That's the reality. And my mom was a manicurist. My dad was a waiter. My dad eventually left my mom. My mom was on welfare. So I grew up very, very poor, incredibly poor. All my friends grew up incredibly poor. And the one thing that I never wanted was to be rich. I just wanted to have enough money so I can eat. That's it. So when you go back to those 2 years, and I caught my first bit of pretty decent amount of money during the heyday, it was discouraging that I couldn't figure out how to get back to there. So it wasn't much of motivation. It was more of I didn't have any other options. You know what I mean? I didn't have any other options because I couldn't quit a business that I've tasted a very good amount of success in such a very, very short period of time for that year and a half run. And that's all it was. I mean, for a lot of people listening, .com wasn't 10-year run. It was 15 months. That's all it was. It was 15 months of the greatest euphoric. I mean, people look at it now and see, like ITK goes from 5 to 18. They're like, oh my God. When you have 25 ITKs a day, you know what I mean? They're all giving up ranges of $15, $20 a day. So it was more of desperation, man. I was hanging on for dear. I had no plan B. So my plan B was killing myself. I mean, that was my plan B. I mean, just to keep real talk, that was plan B. This didn't succeed. I was going to take myself out. And that's where the emotional hate started coming out of me. And I really took this business for what it is. It's not this euphoric love fest that everybody thinks they're in love with. It's torture. Every single day to this day, there's vomit coming out of my mouth, and these are on good days, because there's always something that agitates me about trading. And when you finally come to the realization that trading is nothing but a job, okay, you're going to treat it like a job. And that's why there are no highs, there are no lows. It's work, okay? Whatever the market gives you is the market takes, because I am a swing trader by nature. In the last 2 years, I haven't seen a run that went straight up since the bottom of 2009. So this was all new to us. Okay, this is all new. The last couple of years, this whole unicorn effect, this whole QE, it's all new to us. So we don't expect the market to keep going. So at some point, about a year and a half ago, I just stopped putting on positions. I had two positions on, 3 positions on, 5. But I used to have 10, 12, 15 positions on all the time. Rinse, repeat, rinse, repeat, rinse, repeat. So going back to kind of what my motivation was, it was a pure act of desperation, because if I didn't succeed, we probably would not be sitting here. And that's, completely real talk. I've spoken to many traders that went through mentally and psychologically the same scars that I went through. And the most important part is to be strong enough to kind of wake up the next day. I mean, that really is the strongest part about it, because it's depressing, man. It really is depressing when you go from highs to lows, and you can't get back to that. You can't get back to that top of the heap again. Basically, that was my motivation. Just if I couldn't figure it out, me and you are not having this conversation today.
Yeah, right. No, I appreciate you being so honest with that. So, how do I say this? So you were making money initially, and then you went through a period of 2 years when you lost money consecutively. What was
every day?
Yeah, what was it that changed so much?
Well, first of all, it was that kind of wake-up call by my wife, and she's like, "Listen, you got to get a real job. We have bills. The bank account is depleting. So you got to get your stuff together." And one night I remember I just opened up my I forgot what system I was using before. Was it Reuters or whatever the hell it was? And I just started looking at charts, just thousands of charts. And I wanted to figure out, what am I doing wrong? What am I not seeing? Where's the correlation? Where is the advantage? Where's my edge? Where's the ability to find something and hone a process and absorb a process that can get me, forget about to where it was in 99, to get me where I can make $100, okay? Take home that check $100. Because people ask me all the time, how do I make $5,000 a day? How do I make $10,000 a day? How do I make $20,000 a day? And my answer is always the same. You have to figure out how to make $100 a day first, okay? So my goal was figure out a process. Figure out the process. Figure out in the charts, okay, what is going to be there that I can make $100. That's it. Where can I make $100, and we'll go from there. So I started looking at a bunch of charts, and I started backtesting thousands and thousands of charts. And I noticed something back then, which is so ironically it's kind of the backbone of the whole hashtag PS60 theory. I noticed that stocks, and I didn't use the word supply back then or demand back there, but I noticed stocks used to trade in intervals. Okay, just like climbing upstairs. So, if you're going to go to the top of the Empire State Building, you're not going to jump from step 1 to step 15. You're going to go step 1, step 2, and you're going to stop, take a breath, right? Step 3, step 4, take a breath because you're tired. On and on and on and on. And I started looking at all these things that I heard people talk about. Moving average. Well, what the hell is a moving average? I used to buy .com. If Yahoo went from 260 to 220 in 3 days, I buy it at 220. Henry Blodgett would upgrade it with Merrill Lynch, and this thing would be 250 the next day, 260 the next day. So there was no such thing as technical analysis. So I started looking at all these things. So what are these moving averages? What are they? What is this? Why are people using these things? And I put it on my charts, which I never used before. Again, it was. I mean, we looked at charts just to see the direction where a stock can go, but it was never an instance of, well, if the RSI goes to 90, it's overbought. If the MACD cross, I don't know what these things are. I still don't know to this day what MACD and RSI are. I'm not that smart enough. Okay, if a stock is up 12 days in a row, I don't need to know that the RSI is at 95. The stock's up 12 days in a row. I could tell it's overbought. So back then, it was more of, let me figure out what these things mean. Okay, and what I started noticing were that stocks go, and again, I didn't use the word supply back then, but I started noticing that stocks go from supply to supply, which we use in modern day now, and stocks go from demand to demand. And the only way they ever have a clear path to the goal line is if all these moving averages, all these supply zones, all these linear regression lines, all these Bollinger Bands are out of the equation. Other than that, they are all stocks that are trading within ranges. And people hear that all the time. Stocks are trading within ranges. The problem is a lot of new traders can't tell the difference between a stock trading in a macro range within a micro channel or a stock that's naturally, organically coming out of a channel. And that's why you see a lot of stocks hits supply. You don't even realize it because, again, nobody's ever explained that to you. Hit supply, get rejected, bam, bam, you're out of your money again. Again, you sit back and you sit to yourself, well, I'm the dark cloud. Something, the evil bug is on me. Somebody is putting a voodoo doll on me. It's not that. It's just, again, majority of stocks, they're not tradable. It's just the reality. Most of the stocks are not tradable. They all move, but they're not tradable. And the problem with most traders and most traders tell me is, number one, they have no patience. Number two, when you're a young trader, and it doesn't mean your age, you have pretty much no bank. Let's be honest. When you have, not everybody borrows money from loan sharks to trade. Okay, so normally you don't have any money. Normally you don't have any pain tolerance. Normally you don't have any technical education. What you see is on social media, which is 90% of it is all a gimmick. Let's be honest. I'm trading 16 years. I've traded with some of the most phenomenal traders out there, and I know when they're struggling, when I'm struggling. I see some 22-year-old kid talking about he's hit the last 60 trades in the same market I'm trading for. It's comical, but it's okay. It's okay. I wish everybody the best. But the ironic part of trading for me and the whole mental cycle was trying to really desperately figure out what everything meant. Okay. And I just went countless hours, and then I figured out what the common denominator for stocks that were working and stocks weren't working. And what I came to find was there was an arbitrage, and that arbitrage turned out to be supply that was confirmed years later by a pivot, which I use now, and is confirmed on a 60-minute cycle, which has been kind of a godsend for me where we are present day. But yeah, man, that was I don't even remember what the question was, but mentally, man, that was it. I mean, that was that was a kind of a big deal for me at that time, out of pure desperation.
Yeah, no, that's an excellent answer. And just while we're on that subject, and you were looking through these thousands of charts, day after day, what were you actually looking at? So if someone's listening and, they're, not yet profitable, they're still losing money most, let's just say months, struggling to find a way to exploit the market, and they go through looking at all these charts, what sort of things can they look at on these charts to try and find some common denominators that might lead them to profitable trades or help find an edge?
Well, here's what kind of my open-ended question, everybody. Number one, and I talked about this on my original interview with Pete Lucci. Number one, you have to figure out who the hell you are. That's number one. Okay, you can't be somebody else, and that's why I believe all these alert services are probably the worst thing that can really curb the progress of a new trader. Okay, because they're looking at social media, and one guy is making everything look so phenomenal. So when they can't duplicate the results, again, emotions kind of kick in. But you have to figure out who you are, okay? Do you want to be a swing trader? Do you want to be a scalper? Do you want to trade E-minis? Do you want to trade options? Do you want to trade, pairs? A lot of people trade pairs. They're very, very successful. Do you want to be a rebate trader? I know guys still to this day trade rebate and still do very, very well. What do you want to be? I mean, what do you want to be? And the magic answer to that question is there's nothing on a chart, okay, on a specific chart that is going to jump off the page and say, this is the right thing to do. Okay, there's nothing. Everything is trial and error. So I can tell you, hey, Aaron, look, here's what I look for, right? In a normal uptrending market, here's what I look for. I look for a stock that puts in an initial move, bases out for at least 5 days, and once it gets above that initial move, I buy the stock. Okay, fantastic, Dan. You've done everything what every other trader has done for the last 25 years. Okay, great. But here's the problem. When you look at a chart, okay, you're looking at a very gray area. You look at the top of the range, you look at the bottom of the range. In between, there's a lot of moving parts. There's a lot of gray areas, which I've discussed in nausea. There's thousands of moving parts within a little bubble, okay? And the problem is you can't just look at a chart and say to yourself, well, if the stock breaks 25, because that's the high for the last 7 days, I'm going to buy it. Here's the problem. If you don't know, okay, where your supply zones are, there could be a supply zone, right, at $25.06. Okay, stock hits that supply. And for all you guys who are new listeners who have never heard me talk about supply and demand, supply zones are, let's just use it to the upside, okay? Supply zones are where emotional buyers meet technical sellers, okay? And if you don't know that supply zone is there, you are going to get rejected 90% of the time, and then the stock is going to fail, and you're going to say to yourself, well, this doesn't work, or again, the Antichrist is in me. There's a poltergeist in my room. Something's wrong because everybody else is making money except for me. So the very bare essence of a chart will never paint the picture, okay? Because again, there's so many different grenades within that chart, within that cycle, within that channel that you're looking at. If nobody's ever sat down with you and showed you what those things are, you will never be able to even anticipate that there's a monster coming in potentially out of the closet, and you will lose money consecutively and eventually, again, roll out that revolving door that many traders, unfortunately, have to face reality and go out of. So it's a very tough answer. You know what I'm saying, Aaron? It's a very tough answer. It's not as simple as, well, here's what I look for, MACD cross. Well, Dan Shapiro doesn't know what a MACD cross is. So how can I explain to you what if a stock MACDs, right? Yeah, man, there's a lot of moving parts. I mean, there's a lot of moving parts. I think the longer you do this for a living, I think, and it kind of using a poker analogy, I think the more hands you see, okay, the more chances then you'll figure out that how the movie ends, okay? And I say this all the time: the new trader, the modern trader, the whole renaissance that we've seen in the last several years, that everybody's kind of jumping back into day trading. The reality is they're not prepared. They're not prepared for all these moving parts. They're just not. It's just a scenario of looking at something black and white, and taking it for fair value. But with all these different scenarios that are out there with high frequencies and different hedge funds placing different. I don't want to go into that, but there's a lot of moving parts, and I think what a trader needs to do is watch a lot of hands, play a lot of hands, but play the premium hands. Okay, so not every single day is tradable. As my second interview with Meyer Hoffman, he said, this market, you could sit 2-3 days and not catch a wave. And on the fourth day, like the stars and the moon, everything aligns and you'll make your, X amount of dollars. So it's a different tape, man. It's a different tape. It's for, it really is for responsible traders, responsible adults. You could be the nicest person in the world. And I say this all the time. This is the only business in the world that, you could want it bad enough. I hear it all the time. Do you want it bad enough? Yeah, you could want it as bad as you want. It doesn't translate into you being successful. It's like, I want to be 6'2", but if I don't put on, my wife's 4-inch heels, I won't be 6'2". So you can want it as bad as you want. The reality is, luck does play a big part of it. I'm not going to deny it. Being in the right place at the right time, gave me basically a couple of years that I bought my time. I basically bought my time. You have to look at premium setups once you figure out, who you are, what type of trader you want to be. And then you really have to avoid, shooting yourself in the foot. Because again, I say it all the time, there's nothing that somebody else can do to you that you can't do to yourself. And once you figure out what not to do, I think you'll be okay. I think you'll be okay. And the most important part is it'll buy you time. It'll buy you shelf life to figure out where your specific edge is.
Okay, I really like that. That's an awesome answer, Dan. So,
are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, tastytrade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. tastytrade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
We've talked about how you lost money, throughout that 2-year period, in quite depth. So let's talk about how you go through losing periods these days. Sure, they're not quite as dramatic as 2 years at a time, but you still go through losing periods. I mean, everyone does. So how do you stay in, good spirits? How do you keep your head up through losing periods, and how do you break out of that?
Yeah, that's a great question, Aaron. As we previously discussed, I get tons of emails all the time, and they're never asking me, well, what do you think about this chart? Again, what I think about a chart is irrelevant. The question always is, how do you make it through, man? How do you do it? How do you mentally stay afloat? And there's a great answer to that. Number one, and here's my advice. Number one, guys, turn off your P&L. Turn it off. Turn it off. I don't even know where my P&L box is on my platform. Turn it off. And the reason why you have to turn off your P&L is, number one, this whole business is all emotion versus reality, right? The more you're emotionally committed to a trade, the more chances than not you're going to completely mistrade it, and everything you're going to do in this trade is wrong, and then everything is going to happen after the trade is over is probably going to make you angrier and angrier, because eventually the trade will probably work out your way, okay? So the first thing to do is turn off your P&L, okay? Number one, and here's kind of relevant advice here. Also, you want to turn off your P&L, because if you're having a good day, and I hear this all the time, Dan, I have a $30,000 account, okay? What should be my goal for the day? And my answer to that is, your goal for the day is to make it to the next day, okay, which has nothing to do with your P&L. And what happens is, when you're trading well, okay, if you look at your P&L and you say to yourself, well, my goal is $1,000 for the day, okay, and you hit your goal within the first hour or so, and then I know a lot of traders, they'll shut off their day, right? They'll completely shut off their day and they'll leave. Here's the problem. The day that you can make their $1,000, $2,000, $3,000, $5,000, whatever it is, whatever interval you trade, whatever tier size you trade, the day you can make that money really, really quickly, you don't realize it, but you're playing a premium hand. You're playing the kings, you're playing the jacks, you're playing the aces, you're playing the queens, okay? So that day is turning out to be a premium hand. And what you're doing is, you're taking a pair of aces and you're putting in a bet of $50. That's basically what you're doing. And you're telling the guy on the other that's playing against you, I'm all in for $50. And once you hit that pot, you say to yourself, okay, I'm done for the day. So you're losing out on a premium hand. Every professional trader will tell you, what we're looking for is premium. We're looking for those pocket aces. Okay, so the day that you can make $2, $3, $4, $5 for the first 30 minutes, 45 minutes, you're in a very, very bullish scenario, playing a premium hand. So the last thing you want to do is say to yourself, well, I'm up $1,000 for the day, I'm done. And you don't realize that $1,000 could turn into 3,000, could turn into 6,000, could turn into 10,000, because you're riding that euphoric hand. You're riding those pocket aces. And I don't care how misguided you are, everybody eventually plays pocket aces. And the most important part is if you remove the P&L box, those pocket aces really turn out to something. On the way down, it's even more important to turn off your P&L. I already know on my tier size. On my tier size, and let's just use let's just use 1,000 share lots. Just make it easier. I already understand if I'm putting on a trade and the stock goes $1 against me. I know mentally. I mean, I know I can do the math. Put on 1,000 shares, down a point, you're down $1,000. Okay, but mentally, if you see it, visually, if you see it, that 1,000 turns into 100. Might as well turn into 100,000 because your next trade, you don't want to get down 1,200. You don't want to get down 1,500. So what you're going to do is you're going to trade the P&L and not trade the setup. Okay, so you could be looking at a 5-star setup. A stock comes out of a 2-month range. Comes out, takes a 20-30 cent spike, comes back into your, comes back into your entry, goes down 10-15 cents. You're already down $1,000. You're mentally already distraught. You sell the position at a 10-15 cent loss. Next thing you know, 35 seconds later, the stock's at the highs of the day. So you're mentally already destroyed. You're done. You're done. Once you're trading your P&L instead of the setup, you might as well wrap it up for the day because nothing good is ever going to happen when you're trading the P&L. And the more deeper and deeper you get into the day, the more erratic mistakes you're doing, the more eager you are, the more if you're a man, the more testosterone levels are rising, okay? And all you're doing is committing further and further into emotionally protecting your P&L and not trading the setup the proper way. So that's my first tip. Everybody goes through slumps. Okay, everybody goes through slumps. I had a week 2 months ago. Okay, 2 months ago, I went from having one of my top 3 biggest weeks the prior week to just not getting anything going. I mean, I went through Monday through Thursday. I couldn't make a dime. I wasn't really losing any money. I just couldn't make a dime. Like everything was wrong, right? Everything was wrong. Stocks were snapping back breaking down out of bottom channels on shorts. Stocks were getting rejected on longs. There was reload sellers on my longs. There were reload buyers on my shorts. Just nothing went right. Nothing went right. And I sat there a couple of days and I just started laughing. Eventually start laughing. You can't take this business. You can't take this business to heart. Okay. You can't think that this is every bad thing is pointed at you. Okay, you'll go through these horrific times that you can't get anything going. You'll go through these horrific times. Like perfect example. I last year, about a year ago, I don't know if any of your listeners remember, there was a huge run into the close on these ag stocks, these potash and Intrepid Potash and all these stupid things. And I took Intrepid Potash overnight. And the whole group was like down 25% the next day. I mean, it was just, I was like, what? Wait a minute. You're telling me there's no specific company news and I'm down $4 on this trade, which is insane. And mentally I was like, well, I could try to make this money back today. Okay. Let me see what the market gives me today. Okay. Let me see, because I've learned long enough. The revenge trade does not work. Okay. Anytime you have any type of raw emotion going into a trade, you're going to mess it up. Okay, so what I learned a long time ago is there's not one bad event in your trading career that should be able to take you out of your game. Okay, things happen all the time. Stocks get downgraded, bad, FDA news. I try not to trade a lot of biotech, especially overnight, because they blow up all the time. But the most important part of everything is I understand the highs and lows of this business because of what I went through after 9/11. So for me, when I go on a really big hot streak, I'm not impressed because I expect to make money. Obviously, every trade that I put on, I feel like I'm going to make money. I feel there's certain days I can walk on water, and then there's days I can't get anything going. You know what I mean? And those days you just say to yourself, you know what? It just wasn't meant to be. You don't need to keep on piling on positions. I could figure out within the first 30 minutes if I'm going to have value in the day. So if I'm wrong in the first couple of trades, what's the point of me keep on piling it on, right? Because it escalates. It escalates very, very quickly. You could go from being down $3,000 to be down $8,000, $8,000 turns into 14, 14 turns into 21. What's the point? Cut yourself off. Understand you're not getting a premium hand. Okay. Emotionally, there's nothing you can do. You can't cry your money back to you. Okay. But the most important part when you go through a slump, okay, just realize that, sometimes the easiest thing to do is just take a step back. Okay. Take a step back. Just watch the market. Watch the order flow. Sometimes order flow won't translate into what's going on the surface. It just won't, because order flow most of the time will not be organic. Okay, and that's where social media, that a lot of these people, tout and hype these stocks for everybody to jump in, all that stuff. So you got to just take a step back and just say, hey, look, it's just not my day. Maybe it's not my 2 days, but you know what? I know what I need. I know what I want. And until I get those premium hands, there's no point to do it. The problem a lot of traders have is just they can't accept defeat. Okay. And there's a big picture there. Okay. And you go back into the theory of war, right? There's plenty of battles that are lost, right? Plenty of battles. Battles are lost all the time. The most important thing is to win the war. So I could lose a battle, right? I could fight with Tesla, and there's a reload seller sitting there at the top of the range, and the guy won't let go. The guy won't let go. And you know what? I'll figure that part out. Once it breaks the range, I'll get out. I'll take my loss, but I'm not going to lose the war on one trade. And I see it all the time that many traders are so fixated about being right instead of fixated about trading properly. And that snowballs into day after day after day until they realize, you know what, this is just not for me. And the saddest part about the whole trading cycle is most people will never trade up to their potential, okay, because they won't give themselves a chance to playing those premium hands. And they take everything to heart, and they believe that everything they do is the result of bad things, just everything bad. Somebody just has this evil eye on you. And the reality is, the market most of the times won't give you what you want. Most of the times it won't celebrate your existence. All the market wants to do is take your money and take your confidence. Because remember, I could go on, and this is a very important point. I could go on a run 3 weeks in a row, right? 3 weeks in a row, have a magnificent run. And this is how fragile us traders are. You can go 2 days without making money, and you've completely lost your confidence. Think about that. Think about how many times traders have done that. You could go on a 3-week run doing the same thing every day, every day, every day, every day. You lose money 2 days in a row. You start questioning everything you did for your whole career. Okay? And I say this all the time. You don't lose your confidence. It gets transferred to another trader. Okay? It gets transferred to another trader. Okay? Because you can't lose something that is obviously shown you promise or prosperity in the past. You're just a product of what's happening in the moment. And just sometimes we can't control what we see in the markets. So instead of snowballing it, letting it go out 2, 3, 5 days, take a step back. Do something nice for yourself. Okay? Get a massage. Okay? Go to the beach. Go to the pool. Go to the sauna. Do something nice for yourself. Okay? And when you clear your head, you come back, just watch the order flow. Is it telling you the same thing that it told you 2 weeks ago? Is it telling you the same thing, that it told you 2 days ago? What's different about this tape today that wasn't different from a week ago? Okay? And little by little, when you take the step back, you finally kind of see it in a weird way. You kind of see it. And once you see it, you can start making adjustments. And remember, at the end of the day, everything we do is all adjustments. It's one big adjustment, because I say this all the time. The stock market has been around God knows how long. What was it, 1887, 1897, whatever it was? But trading, the art of physically trading for yourself, is less than 25 years old, okay? So we are all still looking for answers. Think about that. We're all looking for answers. Everybody's in the same boat. The market changes all the time. The nuances changes all the time. Technology is changing by the second, okay? Chart patterns get obsolete. Strategies go away, okay? So we're all in the same boat, man. We're all looking for that next edge. The problem is most traders are fixated on what they think is the right thing to do. And I say it all the time. If 90% of the traders are losing money, why would you be in the same boat as them, right? Why would you be looking at the same thing? Why would you be looking at the same indicator, in the same studies, in the same matter, hell, in the same stocks? So slumps are controllable, okay, for most of my friends. Like I don't hear anymore any of my buddies for years that, you know, are going through something more than like a month. Like you can have a bad month. I mean, I mean, knock on wood, I've been doing, you know, pretty well for the last several years. But, you know, it's very common that you can go on a big run and then just things don't work. It just happens. And I think mentally you just have to get away. You know, go on vacation, take a couple of days off, go to the Hamptons. You know, it's summertime. Take your kids to the park. Do something. You know, do something that's for you, that has nothing to do with bids and offers. Get mentally centered, man. And I tell people all the time, like I used to listen to music every single day. Certain days I want to be depressed. Sometimes I trade better when I'm angry. So I'll listen to Sade. And that woman gets me depressed as hell, right? Can you imagine listening to Sade before the bell rings, right? Some woman in Somalia with no shoes. My God, man. You know, I don't want to hear this, but, you know, it gets me depressed. And sometimes I trade better when I'm angry. Some people, you know, do yoga, meditate, right? Take Pilates, go for a run. Do something that mentally is going to make you happy. And slumps are there. They're part of the business. It's the cost of doing business. But at the end of the day, everybody goes through it, okay? Everybody absorbs them eventually, but they embrace them at the same time because it makes you go through your adjustments. And again, at the end of the day, the modern day trader or the modern trader in general is just one adjustment away from being from not being profitable to being profitable. And once you get that one edge, you ride it until it stops working.
Absolutely. No, that's an awesome answer, Dan. Thanks for really going deep on that. That was really cool. So I'm keen to ask you about another topic, slightly different from what we've covered already, and that would be routine. How important is routine on a trading day? Like, do you have a routine that you follow?
Yeah, I have. Absolutely. Here's the deal, kind of putting how, generally how I look at a day. Well, number one, when there's a uptrending market, I don't even want to day trade. I couldn't care less about day trading. Day trading for me is subsidized cash flow. That's all it is. I make my money as a swing trader when there's a trending market. There's defined ranges. Everything is moving in a direction. So for me, just managing my book is the most important part. That's it. I don't care about day trading. It doesn't make a difference to me. There's scalp, Apple, Google. It's irrelevant. My core positions are my core positions. I trade around them. When they're down, I try to protect them. But in a market like this, which I believe right now is a phenomenal cash flow market, I think the ranges have been just phenomenal. I think the consolidation of these ranges have been great. My routine every day, every single day is, number one, I used to hear this, and I think a lot of traders hear this also. There's an old adage, and it says that dumb money trades in the morning and smart money trades in the afternoon. And I used to sit there and I said to myself, well, that doesn't make sense to me because I trade in the morning. And again, as I joke around all the time, I might be the self-proclaimed king of the idiots, but I'm not stupid. So by somebody telling me that the dumb money trades in the morning, I didn't understand that. Okay, I didn't understand that. But if you break that down, if you break down that statement, think about this. There's two kinds of people, there's two kinds of traders. The one that was profitable the day before and the one that lost money, right? There's nothing in between. You either lost money or you made money, okay? So the psychology behind this is the guy who made money can't wait, right? You see her all the time. Oh, is it, I can't wait for the next day. Again, which is completely ridiculous. But that person, okay, is already emotionally committed because he or she feels that they've turned the corner, right? They turned the corner and they're waiting for day two to start trading, start putting together a winning streak. The trader who lost money is waking up and say, well, it's a new day. Forget about what happened. It's time to redeem myself, baby, right? Today's turnaround Tuesday, right? Today's turnaround Tuesday. Today's the day. So they're gung-ho. This is good. This goes for a lot of new traders, a lot of young traders, a lot of young men as well. You got your juices flowing. Again, your testosterone is off the charts. 9:30 rings. You are ready to jump out of your shoes, right? That damn opening bell rings. You're ready to go. So the emotional money always flows in the first 3 hours of the day. Okay, one guy is playing catch up. One guy is trying to increase or add on to what he did the next day. So the candles, if you notice, the first hour and a half or so, 2 hours or so, the candles are much more exaggerated to the upside and to the downside because people are chasing the rainbow. Okay, one guy is trying to play catch up to get his money back. The other guy is trying to extend his gains. Okay, so they're trying to jump on the hot stock, or jumping on the hot trend, or the hot range, or the hot news. And the biggest exaggerated moves are for the first 3 hours. So I try to, if I'm trading cash flow, number one, I already have an idea what I want to do. I already have an idea from the night before. If I'm trading G Pro, if I'm trading Apple, if I'm trading the IWM, like for example, tonight, I already have a specific plan, course of action for tomorrow. So if we gap down tomorrow, right, and the market starts going red to green, look, I want to buy SPYs, I want to buy IWM. So I already have a course of action. So I feel that if more, for example, like specifically for tomorrow, so if I feel that if shorts are caught on a washout, and they capitulate on the bottom of the range and all the volume is, we're going to have this snapback dead cat bounce. So my mental approach for the next trading day, specifically for tomorrow, is, okay, I know what I want to happen. And if the dumb money, right, as we were all taught that the dumb money trades in the morning, if the dumb money starts chasing that specific course of action, everything should be fine, okay? And that first 3 hours will give you the biggest emotional commitment to the market by traders. Whether they're uneducated or whether they are educated is a different story. But that first 3 hours is the most important part for me. Now, 90% of my cash flow day is done by lunchtime. Maybe I'll do a trade here and there in the afternoon, but the afternoon, it's more of a positioning period, okay? Because traders, a lot of traders, they're positioning for the next day. So if you notice, a lot of stocks, and I talk about this in the live webinar all the time, a lot of stocks are pinned or pegged to their specific range breakout level. So that's why a lot of stocks, people will buy these stocks in the afternoon, and they'll go up a little bit and they'll crash, and only to see them go up the next day. Because think about it, a stock usually will put in 95% of its range in the first 3.5 hours, okay? So by the time the afternoon rolls around, it's exhausted, right? It's like you're climbing the Empire State Building. They say, hey, you just climbed 60 stories. And you're like, oh, great, I did it. It's a victory. Oh, by the way, you got to climb up another 60 to get to the top, right? You're going to be exhausted. And that's exactly what the stocks do. They get exhausted by the afternoon, and most traders will not recognize this, and most traders will commit to the afternoon session realizing that there's no money there most of the time. There's no money there unless you're trading the fades, because a lot of stocks do give up gains towards the end of the day, and that's where a lot of the stocks really get washed out, that especially high flying throughout the day, that are starting to put in lower highs on several channels. But the interval in the morning is the most important part for me. I can make my day in the first 2.5 hours and kind of babysit my positions from the morning going to the afternoon. If I have a good runner, I'll keep it overnight. But it's very, very important to me not to play catch up, okay? Because if you miss your window, like if I miss my window in the morning, knowing that the biggest emotional commitment is in the morning, I don't play catch up. I don't need to play catch up in the afternoon. I don't need to see my P&L green for the day, because you know what, tomorrow's the next day. Tomorrow's another day, and if I get the premium hand the following day, then fine. I mean, what premium can I possibly expect if I miss my first 3.5 hour window, 3 hour window? Where's my premium in the afternoon, right? If I know everything's getting pegged, where's the premium in the afternoon? There is none. And you go from playing premium cards to playing the 2-9 offsuit again, and most traders just don't know that. So routine is a very, very important part. Some people love trading pre-market. Somebody loves trading aftermarket. For me, I look at it and say, look, if I can't make money for 7 hours in the day, what the hell is the point of me trading for another 3 hours? Okay, I have young kids. I'd rather spend my time with them. So a routine is very, very important. I think you can't compromise your process. I think you can't prostitute your account, okay, and put it to the fire. Trading is not a sport. It's not supposed to be fun. It's not supposed to make you happy. It's not supposed to give you a boost of adrenaline. It's supposed to be boring, lethargic, very orderly, and just treat it like a business. So routine is definitely important. Just the way a restaurant opens up every single day, they set the tables. The lunch crowd comes in, and if somebody orders a 10-ounce filet mignon, they don't put it out on a paper plate, right? Because they're not going to prostitute their business for the sake of going through the motions. So same thing as trading. Trading is a business. You want to make sure it's functioning properly, and like every other business, you have to recognize that, number one, just to use the restaurant analogy, your crowd on the Monday afternoon or Monday evening or Tuesday evening will be a lot slower than it will be on a Thursday night, Friday night, Saturday night. And you go with that approach. And you don't subsidize. Okay, you don't subsidize to the point of clicking a mouse. You do what you have to do to make sure you're around tomorrow. And I say this all the time. I don't care what your process is. There's not one trade out there that is more important that will compromise what you've been doing as a process as a whole. So again, like when we talk about there's a lot of moving parts, there's tremendous amount of moving parts. And again, the more you're exposed to the markets every single day, the more you'll see them, and you'll kind of have an idea how the movie is going to end at the end.
I like it. Awesome answer, Dan. So let's just do one more question, and then that'll probably take us through.
Sure.
I mean, I have to ask you about your mentor. So Meyer Hoffman, who you mentioned briefly at the beginning. What are some of the standout traits and maybe the characteristics that you believe make him such an insanely successful trader?
Well, here it is. Meyer, we had some notable guys with us. We had also another guy that, for all you guys who are exposed to the prop world, there was a guy that I started trading with years ago. His name was Jason Lieber. Okay, Jason was a disciple of Meyer. Okay, a lot of us were a disciple of Meyer. He was a partner at this place called Schottenfeld Associates that he left, started a hedge fund 4 years ago. He took the hedge fund from like $4 million to $100 million. Okay. And he used the principles what Meyer taught us. And Meyer, and here's the one misconception. Okay, here's the one misconception. Meyer was never a guy who would sit you down next to him and say, this is what you should be doing. He was more of, you're being a putz. And what you're being a putz used to mean was, you're completely doing something that is outside of your personality. So Meyer believed in the idea of stocks will go higher after they go lower, right? So your complete principle of, well, Warren Buffett, right? You buy low, you sell high, okay? Meyer's thinking was, if a stock is high, it's going to come in, and then it's going to go much higher, okay? And considering the environment we were in, time will make you right, okay? So there wasn't a specific thing he ever sat me down and said, hey, Dan, you know what? You should be doing this, or you should be doing that, or avoiding this. Because remember, we were all products of the internet craze. But what he did teach me was something very, very simple, okay? You're not smarter than the market. You're not, okay? If something's going higher, okay, it's not overbought. I don't care it's up 35 days in a row. It's not overbought. You know why it's not overbought? As long as somebody is willing to pay that price, okay, and there's a fair and orderly market, that means fair value for the stock is that price. So what Meyer used to tell me is very simple, and people used to say this all the time. When the market was finally coming in, right, when the market was coming in, and he said, whatever goes down should go lower. So in other words, Cisco, people saying all the time, Cisco is at 150. There's no way Cisco will go to 120. No way it goes 100. Won't break 100. Breaking 75? Breaking 50? No way it goes to 20. I'm a buyer at 15, right? So the reality of what Meyer's greatest influence, and I think what I what I really absorbed back then was price action dictates everything. Okay, my opinion means nothing. Means absolutely nothing. I could look at a chart. I could grab all the data. I could analyze it 12 ways through Friday. Okay, my opinion doesn't matter. If price action is saying something that's different than my thesis, then price action is the king. And I am not smarter than price action. As my wife says all the time, you're an idiot. You don't know anything, right? I don't know how to do anything. I would have to pay 3 people to screw in a light bulb, okay? But I did figure out this game a long time ago. And the greatest gift that Meyer taught me was that don't fight price action. Forget about the trend. Don't fight price action. Okay, price action is everything. Bad news comes out, the market absorbs it, takes it higher. Don't think about it. The market is screaming at you that they're embracing bad news. That's bullish. Good news comes out, the market is embracing it as bad news. Don't try to fight it. Okay, don't try to analyze a headline. If people are selling a headline, that means they're selling the headline. That means the stock goes lower. So don't overanalyze. Be proactive. Whether that's sitting on the sidelines, that's up to you. Because I see it all the time now in this specific tape. Well, you got to be patient. Every day you got to be patient, right? The biggest bull markets, you got to be patient. Oh, you got to sit on your hands. Why? Sitting on your hands is for lack of process, right? Lack of strategies. And that's why there's a big difference between what a stock picker is and what a professional trader is. And there's nothing wrong with being a stock picker. If you're a long bias guy, this is probably not the market for you. But there's nothing wrong with it. But at least proactive. Be proactive about it. Own up to it. Say, you know what? This is just not for me. And it'll be an easier day down the road. But price action is king. Meyer was a phenomenal trader. Phenomenal. I mean, he would be managing 30, 50 stocks at a time. His P&L would be up, $1 million here, $1 million there for the day. It'd be insane. And I used to, to be all honest, I used to get depressed looking at it because, you see $1 million, you're trying to get back and you're up like 20, 30 grand, and, which is, again, nobody's complaining. But when you start making decent money, and then you obviously get to the pinnacle of your session when you see a guy making $1 million, it depressed you. Never motivated me. Depressed the crap out of me. Holy crap! How's this guy making $1 million a day? Not every day, obviously, but he used to go on these runs, and he was awesome. He was awesome. Again, a lot of us were disciples from his tree. Listen, again, I've never been embarrassed to say that I was fortunate enough to be a byproduct of the internet craze. But the sad reality is I went through so much mentally, emotionally that, scarred me for many, many years. And the ironic part of it is I started trading in the end of 98, start of 99, but I became a trader roughly around 2004, middle of 2003, 2004. So, it's not easy, guys. It's not easy by no stretch of the imagination. But the one piece of advice I will give to you, if you are committed to this business, turn off social media. Read good blogs. I'm not talking about some 19-year-old kid that made $3,000. Read, and there's nothing wrong with that. I encourage young traders. If I started trading at 19, man, it would have been great. I'm so jealous of these young kids, 19, 20, 21 years old. They're making all this money, and it's phenomenal. But, read depth. Read what, veteran traders have done. Guys like Barton Biggs and, guys like, what's that guy's name, man? A lot of these older guys, anyway, I'm skipping. It's getting late in the evening. I'm skipping a lot of names, but just read what people have gone through. Read their experiences, and not the good experiences. Nobody cares about the good experiences. Read what people have gone through. Personal lives. Every trader I know has blown out. Every trader I know. Meyer blew out 3-4 years ago from First New York. I mean, it's the reality. Everybody knows it. So everybody blows out. Everybody has rough patches in their life. You have to have good people around you. No leeches, no bloodsuckers, no yes men. no salesman. Really understand the nuances of this business. Try new things. And I hear people all the time, well, I'm only an option trader. I don't believe in equities. Well, but you trade weekly options. Yes. Well, you do realize weekly options 75% expire worthless. Well, I didn't know that. Well, yeah, they do. Try to expose yourself to different things. Try to trade options. Try to trade E-minis if you can. Try to trade small caps, mid caps, large caps, high beta. ETFs, which I'm a very, very big believer of. Haven't really traded too much ETFs in the last couple of months, but try everything. And if you want it bad enough, sometimes it's just not good enough. It's the reality, man. I never sell dreams. I only talk reality. You can want it as bad as you want. You could be the nicest human being, but you really commit yourself to omitting all the bad things that you're doing to yourself day in, day out. And if you have a good mentor or somebody that you respect, just keep asking questions, keep on spamming them, keep on